I need him to score. I mean, people have to understand that this is so much fun. But these guys, number one position in the U.S., Q4 2023, Sportsbook to 51% share. They have, to date, the company reported fourth quarter revenue of up 15%, finished the year with 13.5 million average monthly players globally. This is a powerhouse company. Quarterly revenues increased 26%. Powerhouse. I like this deal.
We can't wait to talk to Rob in a minute. Jim, Dow's being led by IBM again, and Salesforce right behind.
IBM's quarter was really monster, and IBM really does have a great role that they can play in AI. You know, look, if you're obviously connected with AI in any way, it's moving things up. Salesforce has terrific AI. That's their. You know, they've got this Einstein product. He can ask trillions of questions. I know AI seems to hype, but there are a few companies. Like, look, we had ServiceNow last week. That's a good AI story.
Between IBM, now SAP, we're moving beyond the picks and shovels, are we not, Jim?
Oh, my. I think that you're now in a world, I got Supermicro tonight. They're tremendous AI. You're now in a world where I think that you're starting to see real benefits if you use it. I think that there's so many use cases where it just makes a lot of sense. And I think that we're still not, I know that Jensen will say, look, it makes people more, Jensen Huang, CEO of NVIDIA, well, it makes a lot of sense, and you'll make people more productive. He is not in the belief that there's going to be a lot of layoffs. So far, there hasn't. It's made people more productive. I wish the banks had talked more about AI. They did not. The consumer products companies did not talk about it. But other tech companies really do talk about it.
Yeah. As for layoffs, they're anecdotally, again, Lockheed's a good example today, 1%. We try to track them as closely as we can. Jim, over the weekend, Goldman, Jan Hatzius, sticking by their call for a March cut, and one of the lines in the report was that the labor market may start to issue clues as to why you would want to cut sooner rather than later.
Well, look, the untold story, I was trying to figure out from all the different websites how many immigrants there are, and whether people are going to look the other way on the green card issue. Or this is a very tricky issue for employers, just to be sure. But I think they're going to put a lid on wages. I think the immigrants are going to put a lid on wages. Now, we could ask the labor secretary, and they will just, it's way too third rail. But we have had a lot of immigrants come in, and I think that, unfortunately, I hope they get the minimum wage, but I think, unfortunately, there's a lot of companies that pay less than you'd think, and jobs are full.
Well, how about this piece about banker pay, bonuses? Down again, and it stings this time, says the Journal. Flat is the new up.
And you got to be really careful when you say stings, because they make so much more than everybody else. But yeah, I read the piece. I understand. And rents have been down now for 6 straight months. Yep. There's a lot of things that, like Timur said from the Journal, a lot of things go in the Fed's way, but not enough yet. We still have disinflation, no genuine deflation other than a Costco.
Yeah, core goods. There's sharp deflation in core goods.
Yes,
but then again, then you wake up and these 3 troops in Jordan, Jim, worries about the Red Sea. Everybody asks about what it's doing in terms of traffic. Norfolk Southern had bad numbers last week, and some people felt that they're not getting the business they used to. I don't know. I got 3 downgrades at Norfolk, by the way.
Oh, my.
Today.
Geez, the long knives were out for Norfolk. I thought that was way, way too negative. I just don't think that it's really as dangerous as people think. I like the transports, too. Lockheed Martin's incredible. All the defense, Northrop Grumman price target cut. I think people don't realize there's a lot of people just betting the Republicans are going to come in, and that's the end of the Ukraine spend. And so you want to get away from these stocks. And look, I don't know. It's pure political. And I don't offer political advice on this. It's
hard to read. Another policy question, Jim, is the border. The president's comment on Friday night that if he had emergency authority that he doesn't have, he would use it on the day he signed the bill. Are you watching the rails through that lens?
I'm looking at everything through that lens. I think you have to. I think it's an untold story. We were paying above minimum wage in New York. Forget that. I mean, you have to hope that there are people who are willing to play by the rules and not offer 12 instead of 18. It's around the country. Minimum wage is back. It means a lot because the immigrants want jobs, and I think that's an untold story too. You know, all the things, every time you mention immigrants, like, I wish it weren't hot button because something has to be done. But right now we have 1.3 million people that I believe came in the last year, and then 1.3 the year before. Enough that more people came in last year than in 4 years of Trump, and they're going to work. And that's what I think is going to keep wages down.
Jim, a lot of news on Boeing. We got some MAX 9s back in service. This report that United's chief went to Toulouse to talk to Airbus about maybe if we don't get the 10s, could we work something out?
You know, there's no planes. I mean, that's a nice thought. Maybe they want a discount. I mean, if Airbus had planes, believe me, you wouldn't have a war between these two carriers. They don't make planes. I know United wants to. No, forget it. I mean, it's a nice thought. Boeing is still in the driver's seat. Why is that stock not at 170? Because they have the planes.
And you got Ryanair saying, hey, anybody doesn't want their 10s? We'll take them.
That was a great interview, by the way. I love you come in early enough to get some really cool stuff.
I know you were tweeting early this morning about Philips and sleep apnea.
Oh,
FDA.
my. I mean, look, you have to understand, this is sleep apnea. It's a duopoly between Philips and ResMed. And Mick Farrell has had great numbers to begin with. The stock was down, RMD, because the GLP, even though he said the people who take GLP-1 are using it in conjunction to ResMed. So go buy ResMed. Its numbers are way too low.
And you got this decision on Bayer, $2.2 billion, this Philadelphia court. That's the biggest penalty yet.
Bayer bought a company that could sink Bayer. Monsanto was just, it's the gift that never stops giving you downside surprises. Terrible buy.
As for some sell-side research, Jim, got an upgrade of American over at Citi. They go to buy to 20 from 14.
Yeah, they had the best upside, and the stock had been down basically where it was during the pandemic. I think that deal makes sense. My favorite, how much is American Express up? That was the one that was just so much better than expected. Ooh, opportunity. Stock was down. They had their multiples going higher. American Express had the best quarter so far this year. Best guy.
Yes.
Steve Squeri came in. I mean, I was listening to that call, and I'm like, are you kidding me? Can you really?
Kind of got over. Capital One's comments kind of got overshadowed because they had some pretty positive things to say about real wage growth, Jim.
Capital One is such a great lender. I know people say that they charge too much, but obviously they make it so a lot of people can get credit. And then people say, well, listen, people default on it. But if you take a look at that chart from 2000 to now, other than a big dip in 2008-9, and they came right back, and then they got overused during right during COVID. But that's a great a 20-year chart on this thing shows you that Fairbank has been able to figure this out. Very smart guy, really smart. Don't mess with him. He'll find your phone number and he'll tell you what an idiot you are, but he won't use that word.
A big piece in Business Week over the weekend about Lilly, Jim. They quote an analyst saying that the saying among analysts is JBL, just buy Lilly.
I'm not going to disagree.
Really?
Huge position from my travel trust. One day there'll be enough GLP-1 Mounjaro in New York City but right now it's so in short supply. It's short supply everywhere. Are you kidding me? And North Carolina plants, they can't get them open fast enough. Now, I know that, look, there's an issue here. There's always going to be an issue. Are there problems? Who will pay for it? All I can tell you is that when you have a product that you can't make enough of, you're going to be able to make a lot of money.
Yeah. They do say Zepbound's likely to be the best-selling drug of all time.
Zepbound will be the best-selling drug of all time. Maybe you put all the cholesterol drugs together, maybe it doesn't, but no, Zepbound is going to be the #1 drug of all time. And I've been saying blood pressure is unbelievable. Too much drinking, you take that, they'll never get that passed. They'll never do a study on that. But this thing is just, it's not a fountain of youth, but it's a fountain of hypertension and heart. And that's why everyone's going to pay for it, because hypertension goes down dramatically and your heart risk goes down dramatically. And that's what Medicare wants, and that's what the system wants. They'll pay for it.
Finally, Jim, Tesla holding 185. We got CapEx guidance above $10 billion. The street is slightly below that.
Well, look, it's at a level where we've got some people saying, you know what, let's take a stab at it. All I can tell you is I drove a Rivian on Friday.
Oh, that's right.
Holy cow, the Rivian's cool. It's cool.
It's really cool.
You know it's cool.
Super cool.
Yeah, it is super cool. But you're not endorsing it. I found something you're not endorsing.
That's a first, brother. That's a first.
Oh, my God, he's the best. He's the best.
Rob, welcome. It's great to have you. It's been a while. Good to have you back.
Yes, it's been a while. Thank you guys for having me on. It's a pleasure to be here once again. The atmosphere here is just fantastic. It feels like game day right now.
Have you slept since I saw you yesterday?
Yes, I was actually, last night I was at the game in San Francisco doing the pre-show, the post-show. Yes, it was great. And we just ended, that was the last one of the year because we don't have the Super Bowl this year. And that was my rookie year, so I completed a rookie year and it went very well. And I'm just proud to be on that panel with those guys doing the pregame show. And then I took a plane right after the game, landed and came right here. So I'm on about about 3 hours of sleep. I got about 2 more hours left in the tank of fuel, and then I'm going right back to bed.
By the way, you are crushing it on television. Congratulations. It's going amazing. Talk about this, because we've had you on many times to talk about the phenomenon, but this is sort of a moment, isn't it?
This is definitely one of the coolest moments of my life. I am actually an ambassador, and I represent FanDuel, which is Flutter's one of their biggest brands here in the United States of America. And today, it's Flutter's big day. The New York Stock Exchange is finally welcoming Flutter from London here to the U.S. to hit. And today's the first day it's opening here on the Stock Exchange, Flutter. So I'm just glad to be a part of it. I'm glad to be their #1 ambassador. We do a lot of cool campaigns. I'm sure you've seen our commercials. I'm doing the Kick of Destiny 2 before the Super Bowl this year. Last year I missed, but I missed on purpose so I can have redemption kick. So everyone pick that I'm going to make it, because if you pick that I'm going to make the kick this year for Kick of Destiny 2, you get a piece of the pie, and the pie is $10 million in bonus bets, baby.
Wow.
Yes.
All right.
You seen him on the motorcycle in the desert?
Well, I watched his career ever since he came on my show when we went to San Francisco, and you were so kind to come on, which means I have to ask you, which one do you take? Because the line is very tight, San Francisco, KC.
So what is the line? I haven't seen it yet.
KC getting one.
What, KC's getting one?
Yeah.
I think that's appropriate. I mean, it's going to be a great game. It's a Super Bowl rematch. What, they played 4 years ago?
Yes.
4 or 5 years ago it was. If I'm correct.
2020?
2020. And San Francisco was supposed to win the game, but Kansas City came through. So it's the Super Bowl rematch. It's one for the ages once again, because San Francisco, they've been to the championship, NFC championships plenty of times, also to a Super Bowl, but they haven't won it all yet. And Kansas City, there's a lot of talk about them that they couldn't do it again. You can't repeat 2 times in a row. It's really tough. They almost have a dynasty going. If they win, I'm sure they're going to start claiming that they have a dynasty. So there's big implications on both teams. It's going to be a great game once again.
Now, you've got someone coming to the booth next year that we can't wait for. We can't wait for. How successful will Tom Brady be?
Tom Brady will be just as successful in the booth as he was on the field. The guy knows the game of football like no other. He can break down a defense at any given time, at any given moment, even during his sleep. And then on the offensive side of the ball, he knows what player is going to do what guy's going to be open at what given time, where to throw the ball. He knows all the good stuff about the game of football, and it's going to be great that he's going to give that insight on TV for Fox, and he's joining his ex-teammates, myself and Julian Edelman as well, once in a while, as an analyst. So we can't wait. It's going to be so much fun. It's great to always get the band back together.
And the TV stuff is just practice, right? The mechanics, the timing, that kind of stuff.
Yes, you got to get used to it, and the TV stuff is live, so we strive when it's live. 4th and goal, you only get one opportunity as well. We love to be under pressure as athletes. That's when it brings the best out of us. So you got to also practice as well. Practice is key. You got to prep in order to be ready for those situations.
Talk about how active are you when you bet? And how do you tell newcomers how to do it?
Yeah, so what I love about FanDuel and Flutter as well is that they're all about gaming. They're the #1 online sports betting company in the whole entire world. And they love to do it responsibly as well. So you want to bet responsibly. There's no doubt about that. You don't want to be putting your whole check on the line, even though some people do, and then it gets really intense. But that's not the way that you're supposed to do it. You want to do it responsibly, and it intensifies the game that much more. I remember I betted on an NBA game last year, and I'm literally yelling at the screen every second for everyone to shoot a 3 and make it. So it just intensifies that game, and you're just so much more into it. So that's what I love about the aspect of it as well. And FanDuel, they're just #1. So if you're going to make a bet, do it at FanDuel.
Now, I happen to love daily fantasy. I think it's one of the most exciting things in the world. So I got to ask you, do I take Kittle or do I take Kelsey?
Man, so how does it work? So what do you mean? I mean, the draft already happened in fantasy.
You get a mythical.
Are you talking about next year?
Daily fantasy on
daily
sports.
Fantasy. Okay,
it's so
you're
much
playing
fun.
daily fantasy.
It's so much fun.
I'm going to go with Travis Kelce in that situation. George Kittle's an unbelievable tight end. He's the best complete tight end in the game. And last night, if you saw George Kittle pancake Aiden Hutchinson,
wasn't that a
and
hit?
that's absolutely beastly to do as a tight end, to pancake a defensive end, and that's why that team's in the Super Bowl. And tight ends are transcending the position. I mean, you got to have a good tight end now to reach the Super Bowl. George Kittle, myself over the years, Travis Kelce, it's just known that you have to pay these tight ends if you want to get to the Super Bowl. But Travis Kelce, on the other hand, he's the best receiving tight end of all time. He showed up the last 2 weeks. He's putting up numbers, and he's going to be ready to go. He's already proved that he's already shown it that he can play in big moments. He's going to probably be the best guy to take for fantasy.
Do you ever think that Mahomes could challenge Brady's GOAT status?
I would say he definitely could challenge. If anyone could challenge Brady's GOAT status, it's definitely Mahomes. I mean, he went to 4 Super Bowls now. This is his 4th, and he's the quickest to ever do it in this span of time. And he's the youngest to ever do it as well, to get the 4 Super Bowls that quick. So Mahomes got a long way to go. Yep. There's no doubt about it. He's an unbelievable player. But to reach Tom's status, I mean, a lot of things have to go right. I'm not going to say he's going to reach it, but if it's going to be anyone, it's Patrick Mahomes.
Finally, a question about you and your brand ambassadorships, AARP, USAA.
Yes, USAA.
And Flutter. How do you choose what to be associated with?
You know, I love to choose things that I truly believe in, and what's fun as well. And being here with FanDuel, they're fun. Like, we're doing the kick of Destiny number 2. I love training. I love, activities, and they got me kicking. That's fun. Also, USAA, it's fun doing the commercials, shooting them, and me trying to get in so I can get the insurance, even though I never served, or my parents didn't serve either. So I just love the fun aspect to it. I love the troops as well. USAA all has to do about, with our troops and our military. I'm always giving back to the military. Without them, they're true heroes of our world, of the United States. And without them, we wouldn't have this freedom to be here right now. I wouldn't have had the freedom to go out there and just play the game of football. So those two just align with my brand so much, and I love being a part of them.
And Belichick not coaching, huh?
Belichick, not coaching, which, something, I think that's happening for a reason. I think Coach Belichick needs a year off. He can go back into it next year. The guy's been coaching for 50 years straight, and coaching's stressful. It's 15 basically hours a day. It's great to see him take a break, if he's going to take a break. Take a year off, enjoy your time, go find some things that you love to do, and then come back next year, Coach. I mean, everyone wants to see him coach again, but some time off is probably good for him.
Robert, it's great to see you again, man. Congrats.
Yeah.
Get some rest.
Thank you, guys. I'm going to. I got about an hour and a half left in my tank, and then I got to fill it back up with a little power nap. Yes. You guys are the best, man. Thanks for having me on again.
Come back soon.
Make that kick, too, by the way. It's going right through the uprights.
Rob Gronkowski.
Take care.
As we go to break, check out bonds. The data today is going to be a little bit light compared to the rest of the week, but we'll get some numbers mostly shaping up on Wednesday with ADP, some productivity, jobs number on Friday, 10-year 411. Be right back.
According to traders, Ural's oil prices rise amid stronger Brent and softer freight rates. So the Bank of England sells £799.9 million of bonds in auction and receives £1.98 billion in.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%.
courses.
Market definitely on the hunt for more examples to add to the AI trade, Jim. Adobe is going to lead the S&P, or the NASDAQ at least this morning.
They're Firefly product. My daughter's on all the time. I cannot believe the AI. I cannot believe how great it is. That's another good example. It's incredibly powerful.
Meantime, Dow's up 41 to start a very busy week. Don't go anywhere.
Five.
Jim, what's on Matt tonight?
Gronk. No, sorry. Super Micro, I love Super Micro and NASCAR. And I can't wait. NASCAR will be good. By the way, Super Micro, but, you know, America loves Gronk.
They really do, and you can see why. Yeah, exactly right. Jim, we'll see you tonight.
Yeah.
Mad Money, 6 p.m. Eastern Time. When we come back, SoFi, one of the big gainers of the morning. We'll talk to Anthony Noto. Don't go anywhere.
become a member.
Good Monday morning. Welcome to another hour of Squawk on the Street. I'm Carl Quintanilla with Leslie Picker, Mike Santoli, live at Post 9 of the New York Stock Exchange. Sarah and David have the morning off. Busy week taking shape. Obviously, a lot of it's going to involve macro prints with the jobs number, Fed decision, a lot of earnings. Mega cap tech's going to roll in. Also keeping an eye on some geopolitical tensions with oil touching 79 overnight.
Yeah, markets currently in wait-and-see mode. We're 30 minutes into the trading session. There are still some big movers we are watching, starting with Amazon terminating its planned acquisition of iRobot, sending shares of the Roomba maker plunging down nearly 10% right now. iRobot also saying it will lay off 31% of its staff and that its founder and CEO would step down. Keep an eye on Tesla as well. The company out with its 10K annual report filing saying it expects CapEx to top $10 billion this year and sees between $8 and $10 billion in each of the following 2 fiscal years. Those shares up a little bit as well. And shares of SoFi rallying after swinging to a profit in the fourth quarter. Revenue jumped by more than a third as the company added to over 500,000 new members. And SoFi's CEO, Anthony Noto, joins us this hour to break down the numbers and give his outlook for the company, the macro environment, the state of the consumer as well.
As we said, investors getting ready for the big week ahead. Santoli's been looking at the dominance of quality names and this recent rally, the premium being placed on them, Mike.
It explains a lot of why we're here, why the S&P 500 is at 4,900, why we're at 20 times forward earnings. And it really gets one layer below the clustering of attention on the Mag 7. It's part of that. It's adjacent to that trend. But quality stocks, this would be defined as strong balance sheets, high returns on equity, wide profit margins, predictable earnings growth, all the stuff you think you want out of blue chips. They have vastly outperformed, and it's beyond just tech. Berkshire Hathaway is at an all-time high. That qualifies in almost every respect as quality. It's also at the upper end of its price-to-book value range over the last 15 years. So it shows you people are paying a premium for the perception of not just quality, but predictability. And the question, I think, now is exactly is that a defensive tactic, or is it something that says we actually think this can persist in a good economy? I think it also reflects mistrust of the macro to some degree, and it's also fascinating because you see here the premium of the quality ETF relative to the S&P 500 at a high, is that it's something that bulls and bears are both on board with, and I get a little bit nervous when everybody agrees that this is the way out.
At this point, how much of the S&P 500 is considered quality, given just the recent outperformance of some of those?
You've seen some estimates that it's almost like 70% of the market cap is essentially quality, and that's why some people say, well, that's why we can have a higher valuation on the index, and that's why it's less cyclical, etc. We'll see. I mean, anything can be taken too far, but I think it's related to this: do we broaden out or do we not trend if we get more comfort with how the economy is going to persist in here?
Meantime, we're going to wrap up January in a few days, and there's been some thoughts about the January effect over the weekend.
Yes, so that whole January indicator, I saw some work that says, yep, we didn't get the Santa Claus rally. The first 5 days weren't positive, but if January's okay, then maybe you kind of offset some of that. Not too caught up in that, but I do think the market's pretty well situated in terms of reacting well on good news. It's taking credit for a lot, I think. It's taking credit for a soft landing. It's taking credit for an easier Fed. We'll see if we get it all.
All right, as we said, it's shaping up to be the busiest week of earnings season. We'll talk more about that in a little bit. Results so far, about a third of the S&P is in. Almost 20% is reported so far, including 5 mega caps this week: Microsoft, Apple, Meta, Amazon, and Alphabet. Let's get you set up for the week ahead with Piper Sandler Chief Investment Strategist Michael Kantrowitz. Has an S&P rating of 4950, joins us this morning. Michael, how do you gauge the results we've gotten so far?
From earnings or just from the market
from
year
earnings.
to date? From earnings. Well, there's a couple ways to look at that. We look at earnings surprises. We also look at guidance, and I think guidance typically is where you want to focus. We at the beginning of every quarter, we put out an earnings risk screener, and the companies that we believe that we're most likely to miss thus far, I think we've seen 75% of them miss, with about a median earnings miss of about 20%. So, I think it's bifurcated. There's obviously been some companies with great reports that have beaten. Some of that's been coming from pricing, which is still a lagging story. So, I think it's been mixed. But expectations for the S&P 500 as we sit here today are for 2024 are at about $242, which is the lowest they've been over the last year and a half.
Do you believe that any hopes for a bond rally have started to flatten out?
I think that's going to be data dependent. I think the market's in a show me mode. 2.5 months ago, when everyone was tripping over themselves talking about how high yields were going to go, we got some soft macro data in November and then again in December in payrolls and PMIs. Then we got some good inflation data, and then we had Powell presumably pivot. So we had all of the stars aligning for a bond rally at a time where people were really worried about yields. I don't think we have that same sentiment today, and I think it's going to be a show me with the data that's going to drive yields higher. So we think yields will end the year lower than where they are now, but it's going to be on the back of softer data from inflation and macro.
Michael, we were just talking in the prior segment with Mike Santoli here about kind of the interplay between quality and uncertainty, and the fact that there was so much uncertainty in 2023, it drove up some of the high quality names. I'm curious your thoughts in terms of 2024. Do you feel like we're in a more uncertain environment currently, just given what's going on abroad, in China, in the Middle East, geopolitical tensions and the like, or because it seems to be now common, the market is pricing in that we've essentially gotten to this soft landing place, that there is more certainty and therefore quality won't be as big of a part of people's portfolio in 2024?
Yeah, when I speak to clients, there's certainly a lot of things to be uncertain about, but none of those issues are really front and center and currently creating a lot of fear in the equity market. And the two variables that did do that over the last 2 years, inflation and the Fed, the market has largely priced out that risk or that uncertainty. And so that's what gave us that big rally in November and December last year, that the Fed's done and they're going to cut rates several times this year. But what has not changed going back to earnings is the earnings estimates and the earnings outlook. We've not seen a sharp improvement in earnings estimates from the bottom in the equity market in October of last year. And that's going to continue, I think, to weigh on some of the more riskier, lower quality names in the equity market, particularly if you don't have bond yields falling lower at your back.
I guess the question is, Michael, can the market live with somewhat of a downward revision to forward earnings estimates, let's say for the second half of this year into next year, because that's the normal course of things? Typically, they start high and then go lower. Or do you actually think that it's going to manifest in weaker prices across the board? Or how's the market going to be able to try and metabolize all that?
Sure. Yeah. On an average year, estimates fall by about 6% from where they start the year. And can the market hold in there? I mean, that's exactly what it's been doing. Tech is the only sector that, that surged to an all-time high. And that's true with respect to earnings as well. So given how big the weight is in the Mag 7 or in the growthier areas of the equity market, the S&P 500 specifically, the market can hang in there. Where we're focused more with clients is, okay, that's fine for the market call, but you all have to buy stocks and position and try to beat the market. Where do you want to be and where do you not want to be? And that's why we still like quality coming into 2024 after it being our top pick for positioning in 23.
Hey, finally, Michael, within the Mag 7, is it fair to characterize the ladder now with Tesla at the bottom and Google Meta at the top?
Yeah, we did a report a week ago, and to us last year, when we came into 2023, there was the market was trading in a very macro way. So we saw all of these stocks take off after getting punished in 2022. I think we're going to continue to see much more differentiation within the Mag 7, i.e. fundamentals are going to start to matter a lot more than just the macro backdrop for these stocks. And so we like Google and Meta. Those rank most attractively on our long fundamentally driven models. Don't really show up as any concerns in our short models, whereas Tesla has ranked both poorly in our long model, which looks for quality, profitability, lower risk, and high free cash flow yield. And it also ranks poorly in our sell model, which looks for accounting irregularities.
Yeah, it's been on some lists of earnings quality toward the bottom in recent months.
Yeah.
Michael, appreciate that very much. Good stuff. Michael Kantrowitz over at Piper.
All right, the Fed also front and center this week with a rate decision in Powell's news conference on Wednesday. Policymakers expected to hold on rates, but open the door to cuts by removing the tightening bias in its statement. Let's bring in Point 72 Asset Management Chief Economist Dean Mackey. He joins us on the CNBC Newsline. And Dean, I mean, if you lay it out there, it feels like the eat whatever you want and never gain weight economy, right? Growth better than anticipated, inflation coming down faster than the Fed had projected, and now the market position for the Fed to essentially formalize an easing bias. Can we have all that come Wednesday?
Yeah, I think it's sort of the best the Fed could really have hoped for at this point. You know, they've wanted inflation to come down. They thought it might take a lot of pain to do so. But in fact, actually, growth has sped up rather than slowing down, that, accompanying that lower inflation. So I do think the Fed's in a very nice place right now.
And so how do you think, in practical terms, on Wednesday, the Fed will try to convey the message of its current stance? I mean, you know, a lot of Fed officials, of course, don't want to be too proactive in saying we did it, inflation is taken care of, yet they still have a tightening bias, and the markets are somewhere around 50-50 for rate cuts beginning in March. So what's Powell's job on Wednesday?
So really, I think Powell's job is to keep the market roughly where it is. He doesn't want the market to fully price in a March cut. He doesn't want to fully price it out either. So I think what the Fed will do is take away that tightening bias. You know, they won't have a particular bias at this meeting. I think he will just speak cautiously. He'll talk about how they're going to respond to the totality of the data. They're going to be data dependent going forward. And he really wants to just keep all their options open.
And I suppose in this instance, the data that matter really is just inflation at this point. I mean, it seems as if we're past the time when they were targeting other secondary influential factors that would get inflation they thought where it needed to go, correct? I mean, can we have, you know, 3.1% real GDP economy in the fourth quarter, if that's what we really had, and still have inflation go the right way and the Fed say, you know, we might back off?
I think it's an open question at this point. You know, the Fed's models tell it that policy is quite restrictive right now, and that's why they're thinking about cutting rates this year. On the other hand, the economy is not acting like the Fed's really restrictive right now. The economic growth has been speeding up, not slowing down. And in fact, if you look at the past, when inflation comes down, that tends to be accompanied by strong economic growth, not weak growth. And so the risk for the Fed is if they do what the market's saying and cut multiple times this year, you know, 5 or 6 times like the market is priced in, and the economy is speeding up, you know, that could tighten the labor market, cause wage growth to pick up, and cause an inflation problem down the line that they really wouldn't have had to create. So I think they're going to be a little bit cautious about cutting aggressively this year. They want to see some evidence that policy is actually slowing the economy down, and we haven't really seen that in any significant way so far.
No, certainly not. Dean, thanks so much. Appreciate the time this morning.
Great. Thank you.
As we head to break, here's a roadmap for the rest of the hour. The big bet on America's gambling boom, FanDuel owner Flutter making its NYSE debut today. Flutter CEO joins us next.
Plus, Tesla kicking off its Cybertruck tour in China. What's riding on it? We'll head live to Beijing.
And shares of SoFi soaring on the back of its earnings. Anthony Noto is going to join us with his outlook for the company. Big show still ahead. Squawk on the Street is back after the short break.
What I love about FanDuel and Flutter as well is that they're all about gaming. They're the #1 online sports betting company in the whole entire world, and they love to do it responsibly as well. So you want to bet responsibly. There's no doubt about that. You don't want to be putting your whole check on the line, even though some people do, and then it gets really intense. But that's not the way that you're supposed to do it. You want to do it responsibly, and it intensifies the game that much more.
Super Bowl champ Rob Gronkowski with us in the last hour talking about his partnership with FanDuel and the growth
So we're looking now to the Fear and Greed Index. It's currently sitting at 75 out of 100, which indicates extreme greed. And the Crypto Fear and Greed Index, 55 out of 100, which indicates greed.
Peter Jackson, the CEO of Flutter, you were just standing there at the top ringing the bell. What an exciting morning. Here's my question. If you're #1 in market share, if your revenues are growing so substantially, and you came out with the trading update that showed that, why does it matter?
We're very excited to be launching on the New York Stock Exchange. I mean, our US business, the FanDuel business, has been growing enormously in the last few years. So to be able to bring the opportunity for US investors to buy FanDuel and also buy our international business is something we wanted to do, and we were delighted to ring. I was delighted to ring the bell this morning. It's very cool.
Just before I came up on set, I checked where the stock under the ticker symbol FLUT is trading. Looked like it was about 208. What are your expectations for the way that this excites U.S. investors, institutional investors, but also I know you've been missing out on a big share of earned media that DraftKings gets because it's publicly traded.
Well, look, that's exactly why we wanted to have our stock listed here, and so to make sure we could take advantage of some of that, media coverage. And I think from our perspective, I've met a lot of domestic US investors who've been wanting to invest in Flutter. The higher levels of liquidity you see on the New York Stock Exchange in comparison with the European exchanges is something which they said will be very attractive, and we hope to benefit from that.
Right now, this is your most important market, the US, for revenue, for growth. When does it also overtake the rest of Flutter's international business, European business, and elsewhere in profits?
Our international businesses have grown revenues between 5 and 10% historically, so it's been a very solid performance. We've added to that with M&A that we've made in time. Here in the States, it's all been about growth. I mean, clearly we were the first business to become profitable last year, and we're the #1 operator here in FanDuel. And I think that from our perspective, there's opportunities to keep growing FanDuel and our international businesses.
I'm curious about seasonality. I assume football is far and away the biggest revenue generator, but there's more frequency in basketball and baseball. I wonder if you see any, if that smooths out over time.
Look, Q4 and Q1 are the most important quarters for us. Everyone knows that the FanDuel business is synonymous with the parlay product, and that's particularly relevant for the for football and for basketball. And so when people can play those same game parlays, that means that our Q4 and Q1 quarters are much bigger for us than the other quarters in the year. Now, outside of the States, though, and this is where you get the benefits of our diversification, of course, you'll see horse racing, soccer, all the other sports that come to fore in the rest of our markets.
Peter, wondering what you think the ultimate size of this market is, domestic sports betting, and whether, in fact, the largest first movers have an ongoing advantage. I mean, I try to think of other sort of network effects type businesses. It doesn't necessarily mean like you need more users to have a better experience as you would for social media, for example.
I think for our business, data does help us, right? When I think about the amount of bets we'll have seen flowing through our systems in that Lions game last night, it means that we can get sharper with our pricing, which means we can offer even better value to our customers. It allows us to offer a broader range of markets as well that we can be more accurate with our pricing on. So data definitely helps us there. And we're like other digital businesses, that the economics flow disproportionately to the scale player because of the operating leverage we get into our business. So, look, we are a long way, in front, in comparison with a lot of other operators in the market. Our technology, we get a lot of advantages because we leverage our European teams and their expertise to help us here in the States. And I'm sure that we can stay ahead of the competition.
When Flutter came out with the trading update, it was clear luck went in the way of the customers in the fourth quarter to the tune of some $300 million, I think. DraftKings also reported a similar hit. I'm just wondering about the Super Bowl. Now the Chiefs go back in it. You've got the Taylor Swift effect. What are you expecting in terms of the game itself and what that means for the overall performance of the sportsbook?
Yeah, look, I mean, we gave $343 million to our customers in Q4, so we definitely helped the US economy out. Yeah, and look, we know that the Super Bowl is going to be a big event. It was our biggest event, last year, but actually, the game last night was the second biggest game we've seen. So we know that the Super Bowl will be the biggest this year. We have no doubt about that. It's a fantastic opportunity for people, to try and beat the book, right? They can figure out, who's going to score the touchdowns. Think about all the different markets we have available and try and beat us.
What's next?
The euro extends
there's always
forward
things
to
that are happening in Flutter, right? The business never stands still. We just closed the acquisition of a business in Serbia called MaxBet. And there's lots more growth opportunities for us in our international markets. But look, the team here are very excited about March Madness, and FanDuel is going from strength to strength.
I can't get to March Madness yet because I'm heading to Vegas for Super Bowl. Everything in my head is about Super Bowl and whether I'm going to run into Taylor Swift somewhere like strolling. Well, it could happen.
That's two Taylor mentions.
Well, is the Gron going to make or miss, right? That's the other question.
Oh, that's
right?
the other one. Well, my bet is on May because you can't miss 2 years in a row. That would just be too much. And Leslie, I know, is betting on the Chiefs because that's her hometown team.
Yeah, my dad was like, I put $100 on the Chiefs last night and made 90. So he is
fantastic. That's the way to do it.
Yeah, we were just talking about that.
I hope it was with FanDuel.
He didn't tell me. He didn't say where he made the bet. He just said he made the bet.
Thank you for being here today, Peter. It was a lot of fun.
Thank you.
The band and everything, right?
Oh, yeah.
Oh, yeah. Not a Taylor Swift band, but a different one.
Whatever.
It's fine. Up next, Tesla kicking off its Cybertruck tour in China. What's at stake for Tesla as it tries to grow its footprint there? We'll head live to Beijing after this quick break. Stay with us.
At 10:30 a.m. Eastern Time, we get the Dallas Fed Manufacturing Business Index, forecast -11.8 on the prior -9.3. U.S. Defense Secretary Austin says neither he nor Biden will tolerate attacks on U.S. forces and will take all necessary actions to defend them. So Defense Secretary Austin expresses outrage over deaths of U.S. troops in Jordan drone attacks.
Tesla begins its Cybertruck tour in China, and it's been getting a lot of social media buzz there ahead of this trip. Our Eunice Yoon joins us live from Beijing with more on what's at stake for Tesla. Hi, Eunice.
Hey, Mike. Well, the Cybertruck is on display at the Tesla store behind me. This weekend, the company started showcasing the futuristic new vehicle in 8 Chinese cities, including here in Beijing. Now, Tesla continues to be a fan favorite among EV drivers here, despite the fierce competition by local brands. One of the criticisms, though, of Tesla is that it doesn't refresh its models quickly enough, especially when compared to some of its Chinese rivals. Now, for this Cybertruck, Tesla has not officially announced that the Cybertruck would come here to China. In fact, Elon Musk has gone on record as to say that it's going to be difficult. And one of the issues has been the regulatory environment, especially around trucks. But one point that was really interesting and picked up upon by a lot of the fans is that the name of the Cybertruck in Chinese avoids the word truck. So that's seen as a way for Tesla perhaps to eventually launch the Cybertruck here. Guys?
Eunice, I wonder, aside from just sort of the names and what the implications are, I mean, in the U.S., of course, pickup trucks are the most popular type of vehicle. What's the case in China in terms of that ready kind of appetite for something that, you know, even vaguely looks like a pickup truck?
Right. Well, it's interesting because here you really can't get a pickup truck, or if you do, you're not able to drive into the city, like into some of the kind of more packed areas. So there are a lot of regulations around it, and that's why it's interesting that in the name, people love to see these big cars. They love driving them. That's what they were talking about. Is that everyone's impressed by the size. They love the look. They were talking about how it looks like an armored vehicle. People loved it. But the regulations are such that they don't allow what would be considered a pickup truck into the kind of more packed parts of the city. So the fact that it was called an urban traveling wagon, maybe not so catchy, but maybe it could get you around some of the regulations.
Urban traveling wagon. We've got some country singers that may want to alter their songs out here. Eunice, I just wanted to pivot, if we could, quickly to another story, of course, that's big news in China. That's, of course, the liquidation order from the Hong Kong court of Evergrande. What is the sentiment currently right now on the ground in Beijing as it relates to this, and how is it kind of the seminal moment for the property sector there?
Right. Well, in terms of home buyers, it's just seen as another big weight that's been put on the property sector. People are wondering, what does all this mean? I don't know whether or not I should continue to go ahead with a purchase of Evergrande. If people even were, there are a lot of questions about what this means for its ability to finance its projects. The company's CEO has been trying to calm people down by saying that for sure they are going to deliver on these homes, that they're going to be business as normal as much as they can. But from from an investor perspective, for some of these creditors, I was talking to one earlier today, and they said, one of the main issues at this point is whether or not the court decision in Hong Kong is going to be recognized by the Chinese courts. And will they cooperate with the Hong Kong decision? Because there are so many political reasons why the Chinese government, which controls the courts, would not want to have what would be perceived as an outside decision being kind of forced upon the Chinese system, especially when it could potentially create so much instability in the property sector at a time when there's just so much instability among investors and in what's going on in this economy.
Hey, finally, Eunice, we had Tesla earnings last week, and as part of the call, Elon Musk did say that China EV makers would, quote, demolish American EV companies without trade barriers. I wonder how that resonated in the country, or whether or not his calculus in China is getting tougher.
It was actually championed. I was reading that a lot in state media. People were quoting Elon Musk saying that China was going to demolish the U.S. EV makers or car makers. And one of the ways in which China feels proud is that they are pushing out a lot of these cars. But I think at the same time, several car analysts who I speak to say that this is something that U.S. automakers should be concerned about, as well as European automakers should be concerned about, because there is so much overcapacity over here when it comes to EVs as well as other types of cars. And a lot of that is getting pushed out overseas.
Fascinating, Eunice. Appreciate it. As always, covering a lot of ground for us today. Eunice Yoon in Beijing. Still ahead, shares of SoFi soaring right now. The company blows past estimates thanks to some surging loan volumes. Anthony Noto is going to join us first on CNBC with his outlook for the fintech giant. When Squawk on the Street continues in 2.
Humanly possible.
Welcome back. I'm Silvana Henao with your CNBC News Update. Political pressure is mounting this morning for President Biden to respond to the killing of 3 U.S. troops in Jordan. Dozens more were injured Sunday in drone strikes by Iran-backed militants. White House officials say the president is now working through his options, but stress the administration does not want a wider war with Iran. Meanwhile, negotiators from Israel, the U.S., Egypt, and Qatar agreed on a framework for a new hostage deal in Gaza. A source familiar with the talks tells NBC News the deal would see the release of the remaining American and Israeli hostages in phases, beginning with women and children. That would be accompanied by phased pauses in fighting in Gaza, along with the exchange of Palestinian prisoners. The source says the deal will be presented to Hamas today. And Kate Middleton is out of the hospital nearly 2 weeks after undergoing planned abdominal surgery. Kensington Palace says she will now take a prolonged period of rest, putting her normally busy schedule on hold. Carl, back to you.
Silvana, thanks. Meantime, elections around the world will be front and center this year. More than 45% of the global voting population We'll head to the polls. Our next guest has a new op-ed in the FT today discussing why political leaders are so unpopular right now. Rockefeller International Chairman Ruchir Sharma joins us this morning. Ruchir, it's great to have you back. Fascinating piece. You look at 20 democracies all around the world and try to explain why their overall approval ratings are so low.
Yeah, Carl, Joe Biden's approval ratings get so much attention here, and rightly so, because they're close to record lows. But what I find remarkable is that if you look at the approval ratings of leaders across the developed world, they have rarely been this low. In fact, they are lower than even Joe Biden's approval ratings. There's not a single leader across the developed world where the approval rating is more than 50%. And most of the approval ratings are trending down. So there's something deep going on here as to why leaders are so unpopular around the world, and why so many of them are probably bound to lose their re-election bid. As I point out in the piece, that normally being the incumbent gave you the advantage. 70% of incumbents would typically end up winning elections when they stood as the head of government. In the last few years, only 30% of people standing for re-election have been coming back to office. So that's what's really going on out here, which is very unpopular leaders, and most voters are deeply unsatisfied with what their choices are.
It's easy to look at social media and sort of the Yelp effect where being negative kind of sells and engages, but are you on the lookout as a result for policy volatility around the world?
Yeah, I think that the big market implication and the economic implication of what's going on, given this, is that the temptation on the part of leaders is just to spend more, to spend their way out of trouble. Typically, in an election year, leaders tend to spend anyway, and I think in a year like this, they are going to be even more inclined to spend because that's the easiest way, they think, for buying votes. The problem is, as you know, in many countries, the budget deficit levels are very high today, much higher than they've ever been. So I think that we are setting up for this tussle here where the politicians need or think they need to spend more, and yet you have the bond markets. I think we'll start worrying about the budget deficits again. Those worries were there last fall, and they faded as the rate cut euphoria set in. I suspect sometime this year, concerns about the wide budget deficits and what unpopular politicians are going to do to try and win their way back, I think is going to be an important clash that's going to happen.
Interesting. So there's a direct correlation then, you believe, between incumbents with low approval ratings and the deficit spending that they tend to run up potentially in their final year in office. So given kind of the overall mantra around the world, what do you think that means? And just to kind of follow up on Carl's question, particularly as it pertains to volatility as we get closer and closer to some of these key elections?
Yeah, I think that the bond markets are going to demand a higher term premium for sure, because in terms of the fact that, once this disinflation trade fades and people factor in the 2% rate that they have, as the Fed's target, I think that rates just don't go back down like they did in the past in disinflation cycles. It's possible that even in a recession this time, the 10-year in the U.S. doesn't fall much below 3% or something. So I think a much higher term premium is what the bond market's going to demand. And politicians, I think, are going to learn the hard way that if they're going to try and spend too much, the bond market's going to revolt against it because the levels are so high. The deficit levels everywhere are so much higher, and the U.S. is obviously Exhibit A in that.
Ruchir, if that's the cost, though, of this level of deficit spending around the world, that in a recession, maybe we don't have inflation and yields go as low as they did in the past, is that an acceptable one, do you think, to the markets even? It seems as if we've tried to find a new equilibrium here with, let's say, U.S. 10-year around 4 and around the world a little lower than that.
Yeah, but as you say that, we are finding a new equilibrium because, given where inflation is headed now, in terms of, back to 2% for now, I'd say that, people are getting very excited about how much more yields can fall from here. And my point is, I'm just not sure that yields can fall that much more, that the sensitivity has changed. So a much higher term premium is what I expect. But of course, there are many factors which determine what's happening in the bond market. But the US, I think, is really, this is where I think that even the fiscal impulse, which has been helping growth in the US, is possibly underappreciated. But I think that the really problematic case is this for Biden and other political leaders, that the connection between good economic data and their political support has broken down. Given where inflation currently is, given where unemployment currently is, you would expect their approval ratings to get a huge lift. It's just not happening, and it's not the US, anywhere in the world, in the developed world, it's not happening. Now, very interestingly, a nice side story here is that in emerging markets, leaders in many countries are still relatively popular. There's still faith in the system, but I think that the problem here is that given the problems of income inequality, lack of social and economic mobility, a feeling of an unfairness in the system, this connection that you historically had between economic data, near-term economic data, and political support has broken down.
Yeah, sentiment indicators are broken in many ways. Ruchir, it's a fascinating piece in the FT. Everybody should take a look. Thanks for the time.
Thanks, Scott.
Coming up, SoFi shares surging after reporting its first ever quarterly profit for Q2, currently up 22%. CEO Anthony Noto joins us next. Stay with us. SoFi reporting its first profitable quarter, surpassing analyst expectations that the company would break even. Shares popping double digits on those strong results, almost up 23% right now. CEO Anthony Noto joins us. Anthony, thanks for being here. Big quarter for you all. Profitable one, record revenue across the three businesses. Solid profitable outlook as well. What are some of the key drivers that you think led to these results?
Well, Leslie, thank you for having me on. You know, I'd say the strategy overall has really come into play and delivered exceptional results for the quarter. 6 years ago, we embarked on this very ambitious strategy to be a one-stop shop for all your financial services needs. When I joined the company in February 2018, we were primarily just a lender in 2 products. Today, we offer not just 4 types of loans, including home loans, but we also offer SoFi Money, which is a modern checking and savings account, SoFi Invest, SoFi credit card, insurance products, and we also power 140 million accounts across the fintech industry through our technology platform that we outsource to our partners. This quarter really reflects the fact that the financial services segment is now profitable and growing quite meaningfully. The tech platform business is also profitable with accelerating growth, and that's really the drivers of growth going in 2024 and less so the lending pieces. So it was a combination of that strategy over the last 6 years being invested in and then coming to fruition in 2023 with record revenue of over $2 billion and record EBITDA and actually hitting our long-term EBITDA margins at 30%. And as you mentioned, GAAP profitability for the first time, which will sustain in 2024.
Yeah, and of course, this all comes against a macroeconomic backdrop that for a lot of lenders remains uncertain. And you have a pretty conservative outlook for 2024, baking in a 5% unemployment rate, 4 rate cuts, which is, of course, fewer than the market is pricing in. So what are you seeing in terms of customer spending trends, portfolio quality that is helping to inform your outlook for 2024?
Yeah, you know, as you mentioned, we did take a very conservative view on the lending part of the business for 24. We are expecting 75% year-over-year revenue growth in our financial services segment and 20% year-over-year revenue growth in a tech platform, and really no growth in lending because of that conservative view that we're taking. We do expect credit to normalize. We're seeing those trends across the industry as well as at SoFi, and so we're taking a very cautious view there. In terms of underlying spending trends within SoFi Money, we had $1.6 billion of point-of-sale debit spending in the quarter. That's annualized at about $6 billion. It's up 3x from a year ago. We're seeing strength within existing accounts, but we're also adding new accounts, so it could be a little bit misleading. In addition to that, we have been observers of the broader market dynamics. We've seen some levels of liquidity dry up in certain markets. In addition to that, the largest banks have seen an increase relative to 7 and 10-year highs in write-offs, delinquencies, and then the provisions for losses of one of the largest banks were up 50% sequentially. So we're really bullish about our financial services segment, which is growing quite well, 75% for next year, and tech platform, but conservative on the lending side.
Hey, Anthony, some of the macro stuff that got commentary in the earnings last week was about real wage growth rising again after 2 years of shrinking. Is that starting to make itself felt within the metrics?
We're not actually seeing an impact on spending. We are obviously seeing a normalization of credit back to pre-COVID levels. So that's where it's showing up on the spending side. That is still strong, but the credit side across the industry as well as at SoFi is definitely normalizing, which is why we're taking a conservative view. The unique thing for SoFi is that in 24, 50% of our revenue will be from technology platform revenue and financial services, and 50% from lending. In previous years, it was as high as 80%. So we've gained scale and profitability in those 2 segments just in the right time as we enter 2024 and the concerns on the credit side.
Yeah, with the technology business in particular, we're nearly a year out from the select regional bank failures that we saw last spring. What's been the impact on your business as we kind of think about the overall impact from those failures and how the reshaping of the way that the banking system operates?
Sure. Our technology platform services enable not just fintech companies to provide services through payment processing core technology, but we're also enabling large brands that want to be in the financial services sector. But the thing that we've seen the biggest surge in is the demand from traditional financial banks, the largest banks in our company. It's clearly a trend of them having to upgrade their technology, to upgrade their core technology and their processing technology so they have better real-time asset and liability management. Having the real-time asset and liability management we have through our technology platform is an advantage. And I think some of the liquidity issues that we saw in the spring of our largest banks were a direct result of not having that technology capability. And so we're seeing robust demand and RFPs from the top banks in the country, in addition to the other pockets of strength that I mentioned. These things take quarters, not months to get through, but we're in the RFP process with a number of large banks. We were fortunate earlier in the year to win one small regional bank deal but it's going to be an added growth vehicle for the tech platform.
Interesting. Definitely a space to watch. Anthony Noto, thank you very much for being here, CEO of SoFi, on today's earnings results.
Thank you, Leslie.
Coming up next hour, shares of consumer products company Philips falling after halting sales of its sleep apnea devices in the U.S. and the settlement with the FDA over faulty medical equipment. We will hear from the CEO next hour on Money Movers. In the meantime, Dow's gone red, down 18. Stay with us.
Asset.com.
Welcome back. Let's get over to Dom Chu. He's tracking today's biggest analyst calls. Good morning, Dom.
All right, so Mike, let's focus on mega cap technology. We'll get through as many of these analyst calls as we can. Starting with Meta Platforms, it's getting a little help from the team at Jefferies. They raised their target price for the social media parent of Facebook and Instagram to $455. It was $425. They keep the buy rating. They cited things like expectations for revenues to come in at the higher end of previous guidance for both the last quarter and the current one as well. So watch those shares up 1%. Jefferies is also, by the way, reiterating its buy rating on Microsoft. The business software solutions cloud computing AI giant is also getting its target price raised to $465. It was $450. They cited things like being the beneficiary of improving cloud computing trends, also those in artificial intelligence. That's one member of the trillion-dollar market cap club, up 1.5% right now. And of course, the other one is Apple. But this morning, analysts at Barclays have reiterated their underweight or sell rating on the iPhone and app services giant. They cited things like what they view as lackluster iPhone 15 sales with expectations that it won't change with the iPhone 16, alongside overhangs from regulatory risk, also an elevated valuation compared to the S&P 500. So those shares down fractionally 0.75%. Leslie, I will send things back over to you.
Dom, thank you. And a quick programming note, don't miss my sit down with Citadel's Ken Griffin. We'll be live from the MFA Network Conference in Miami. That is tomorrow morning at 10 a.m. Eastern.
Meantime, Money Movers begins after a quick break with former Richmond Fed President Jeffrey Locker. Don't go anywhere. Good Monday morning. Welcome to Money Movers. I'm Carl Quintanilla with Leslie Picker here on the floor of the New York Stock Exchange. Today, former Richmond Fed President Jeff Lacker on why the market is pricing in too many rate cuts this year.
Plus, the #1 retail analyst on the street, appropriately named Matt Boss, joins us. After a year on the sidelines, he's turning bullish on Dollar Tree. He'll make his case ahead.
Consumer company Philips getting hit as this new FDA deal will mean it can no longer sell its sleep apnea machine. The CEO is going to join us to break down what's next. Take a look at the markets, though. Bit of a tight range as we brace ourselves for everything that's headed our way. The macro data, the earnings onslaught, the jobs number on Friday, the Fed decision on Wednesday.
It could be the busiest week of the year so far.
Yeah, looking forward to that. But for the time being, NASDAQ is the sole index in the green. A lot of narratives for investors to focus on this week, including that highly anticipated Fed meeting. While no one expects a cut this week, the market is expecting more than 4 cuts for the rest of the year. Our next guest says those expectations may be too high. Joining us this morning, former Richmond Fed president and senior affiliated scholar at the Mercatus Center at George Mason University, Jeffrey Lacker. Jeff, welcome back. It's always a pleasure.
Thank you, Carl. Great to be here.
We've been sort of taking in commentary from former Fed officials, I think Evans and Bullard. Give us your take on where you see market expectations right now.
I think there's an excessive optimism that's spread in the market. And I think that some of that may have spilled over to the committee itself. I think that the Fed was very fortunate last year to have inflation come down as rapidly and as far as it did. But they're by no means done yet. You've got strong real spending growth, as shown in the third quarter, and now the fourth quarter GDP report continuing. No signs of recession. Wage growth is still not consistent with a 2% inflation rate. You'll see average hourly earnings numbers in the employment report on Friday, but those are contaminated by very serious composition effects, composition shifting over time in a way that distorts the number. The indicators that back that out, like the ECI and the Federal Reserve Bank of Atlanta wage tracker, show wage inflation still not consistent with 2% inflation. And it's still not obvious that inflation expectations have come down all the way to being consistent with 2%. And they're certainly not anchored. So I think standing pat should be the watchword. That should be the default scenario, at least through the middle of the year, barring any sudden big surprise shock to the economy.
The equity bulls are entranced by this 6-month annualized figure where it shows we've essentially been at target for whatever it is, 6 or 7 of the past 7 months. I'm looking at a note this morning warning us that sometimes those figures can be revised higher as they were back in 2003. Is that something to watch?
Oh, yeah. I mean, there's a big CPI revision coming, and that data is the groundwork for the PCE inflation number. In addition, you have residual seasonality. You have to worry about. The process of backing out seasonal factors is imperfect and sometimes gets a little polluted from time to time. And a set of months in the year can be stronger or weaker than average. So, yeah, and besides, it's going to take a year or two for them to feel confident about inflation having returned to 2%. So, yeah, again, I think that the markets are getting a little ahead of themselves here.
Jeff, what do you think in terms of a recession this year? Do you believe that we have averted some sort of hard landing at this point? And if so, is it still likely that we get so many rate cuts as the market is anticipating?
So I don't see any signs of a recession on the horizon. I'm wary of aeronautical metaphors, all metaphors really for monetary policy. To paraphrase an old saying about the price of freedom, I think that the eternal vigilance is the price for a central bank of maintaining price stability. So I think that's especially true given the episode the Fed's come through. This was a significant failure of monetary policy to have inflation deviate so far and for so long from target. I think the Fed's credibility is damaged. I think that they should avoid declaring victory or declaring that they've landed and are taxiing to the gate or any of that stuff. I think the watchword for them is going to have to be reestablishing their credibility and re-anchoring inflation expectations. And it's still, for the foreseeable future, their credibility, and the anchoring of inflation is going to be a tentative matter, and they're going to have to be on their game, and they don't want to reverse course. So I think they're going to be averse to cutting rates too soon.
Not to continue the metaphor that I know you despise, but if you kind of think about the different bolts on the doors and the key indicators that you think they should be watching, that you're watching, what would they be?
Bolts on the door. Is that another aeronautical metaphor to a Boeing
well, I was thinking,
door or something?
With regard to Boeing and...
Yeah. Well, at the end of the day, it's about the inflation numbers and then them coming in, on a sustainable basis, very close to 2%. I think if they come in around 3%, and that seems plausible and consistent with the current outlook, if they come in around 3% for a year, they're going to need to think about whether they need to take stronger action. And so I think they're wary of things getting entrenched a bit above 2%, maybe not 5%, but 3% inflation for a while. And I think that would be a hard case for them towards the end of the year.
Hey, finally, Jeff, over the weekend, the Journal quotes Esther George just talking about the labor market, how it's often tricky, and when it does stumble, it tends to stumble hard. Goldman, which, by the way, is in the March camp, wrote over the weekend, the labor market could still provide additional reasons to cut sooner rather than later. I mean, how vigilant do we have to be on labor weakness?
Oh, always. But you look at initial claims, you look at vacancies relative to unemployed, and there isn't any sign of a break, of a dip coming in labor market conditions. So, yeah, I think things look fine on the labor market front.
Yeah, hard to argue when claims roll in every Thursday. Jeff, appreciate it very much as we await the decision this week. Jeffrey Lacker, former Richmond Fed president. Thanks.
Let's turn to the airlines. Ryanair backing Boeing this morning. Meanwhile, the JetBlue-Spirit merger remains in limbo. Phil LeBeau has more on both of those stories. Phil, never a dull day on your beat.
No, and it's been busy, particularly lately, Leslie. Let's start first off with Ryanair, which reported its results early this morning. And while the results were shy of expectations with regard to the last quarter, the company also gave some guidance, narrowed the profit guidance, but didn't lower it. They just narrowed it. And then there's the question of what happens with Ryanair's 150 737 MAX 10s that they have ordered. It's a huge order that they start taking delivery in 2027. As you take a look at shares of Boeing, we should point out that on the conference call today, Michael O'Leary, the CEO of Ryanair, has been emphatic that they stand by Boeing. And then on Squawk Box this morning, the CFO, Neil Sorohan, listen to what he had to say about their confidence in Boeing.
I think that Dave Calhoun and Brian West are doing a very good job in turning things around in Boeing. I think quality, while it needs to go further, has improved. We've always been willing and able to take aircraft if the price is right.
All right, let's shift gears and quickly talk about JetBlue as you take a look at shares. Remember, they report their quarterly results tomorrow. We bring this up because they put out an 8K on Friday saying that they are evaluating their merger options and that the window for them to make some type of a decision if they want to alter it or end that agreement, that opened up on Sunday, but we have not heard anything from the company since then. By the way, once they made that announcement on Friday, Spirit put out an 8K saying, we plan to stick with this merger and we expect JetBlue to stick by it as well. We'll see if they have anything to say about this when they report their Q4 results tomorrow morning. JetBlue reports its Q4 results. Leslie, back to you.
Potentially unrequited love there. Phil, thank you. Up next, more on the risks positive economic data pose to rate cuts and why one strategist says the U.S. is heading toward a recession.
Plus, the CEO of consumer products company Philips, an FDA settlement over the sale of sleep apnea machines in the U.S., weighing heavily on shares. We'll be right back.
The trial.
An executive departure at Goldman Sachs to report. Jim Esposito, the co-head of the firm's global banking and markets division, is leaving Goldman in the next few months after over 30 years at the company. Esposito was thought to be a part of a handful of senior executives that could one day replace David Solomon as CEO, but Solomon has indicated he won't be stepping down anytime soon. That, of course, is according to reporting in the Wall Street Journal, which I think could be the newsworthy aspect of today's story. This idea, as we kind of look across Wall Street, there was some chatter last year, amid all of that negative press that Solomon was receiving. Does he have the full confidence of the board? Does he plan to stay amid, all of this negative press and some kind of dicey earnings reports? And so the fact that things have really turned around, the fourth quarter earnings were stronger than many had expected, a pretty solid quarter overall. And now this news that he's indicated, at least to top executives, according to people familiar with the matter, that the Journal reported, that he plans to stick around for some time, I think is noteworthy for the street, at least. Goldman shares not really doing too much on this news, but certainly one to watch.
Although some two-year highs after the print a couple weeks ago. And then you had Ted Pick is in position at Morgan Stanley. This shuffle over at JPM last week got some eyeballs too.
Exactly. It's definitely that time of year, bonuses being awarded, and just trying to kind of figure out those succession plans on Wall Street, which aren't always easy. People look at Morgan Stanley, you bring that up, and rightfully so, because there were three contenders in that race, and only one got the job. Now, the three were awarded these special bonuses as being part of the process by which they chose the successor. But oftentimes you see this where if people are gunning for that top job, don't get it, they leave the firm. And so it's kind of a matter of who you want to keep close. I mean, Jim Esposito had been there for 30 years, maybe looking to do something else with the next stage of his career. But from a firm standpoint, it's definitely interesting. The different moving pieces of the chessboard.
Yes, that's one of the hardest things to do.
It is, indeed. Let's turn to the markets. Our next guest is betting that a rally is ahead for treasuries, and we could get a downside for equities. Joining us now, Kamal Srikumar, president of Srikumar Global Strategies and former chief global strategist for TCW. Thank you for being here, Sri. Explain that thinking for us. What would be the driver of those two markets?
$8.2 billion.
The driver is here, and I think the consumers are said to be a very strong part of the economy right now, Leslie. I put out a report on Saturday saying that is where actually a serious weakness lies. Consumer spending is supporting the U.S. economy, but consumer spending has been rising faster than income. And in the four largest U.S. banks, credit card loans rose even faster than consumer spending. So the consumers are essentially spending as a result of borrowing. And I think that is where I think the weakness lies. Second, I think the banking situation is still not stabilized. The bank's deposits, which fell after last March, are still continuing to be at relatively low levels. And that is a second area of danger. I worry about the commercial real estate situation. Any of those could cause a recession and could in turn cause the Fed to cut interest rates. The crucial point here is the Fed rate cuts are coming, but not because inflation is vanquished, but because something is going to fail in the system.
Sri, all of those different factors that you mentioned, some would have said a year ago could be cause for a recession, or 10 months ago could have been cause for a recession, but we haven't seen it yet. Why do you think that is, especially with rates where they are and tightening in the system? We haven't seen too much of a fallout from all of that yet, and some are wondering whether we ever will.
That's a great question, Leslie. What happened a year ago, say March? You would have expected something like a recession to follow from the regional banking crisis, but I think the Federal Reserve stepped in, stopped quantitative tightening, switched over in a big way to quantitative easing, and that in turn served the system. The question is, you can do that once, are you going to do it a second or a third time? Second point in answer to your question, we have had immense amount of monetary and fiscal stimulus. Toward the end of 2022, it was estimated that $1.5 trillion worth of excess fiscal surplus was in consumer hands. And that also supported the economy in a way it hasn't done in past recessions. Look at the fiscal deficit. Look at the amount of debt the U.S. government has. And that is what has supported the economy so far. But that's what you call running on fumes. You can't support that way indefinitely.
Sri, there's a good piece in the Journal today basically arguing maybe a little bit of easing now allows you to avoid having to ease big time later on. Is that the way you think about it, or is it more you want to save your dry powder for when emergencies do come and you need some room for an insurance cut?
Carl, I go with the second point. I read the Wall Street Journal article, and I think to ease now in preparation for not easing too much later on, which was the thrust of that article, to me is a very tough proposition. That in turn could not lead to the stop-and-go inflation measures that we adopted in the 1970s, and that is what makes inflation longer lasting. We did not have a good run in the 1970s, and there is no reason to repeat that now, as the Wall Street Journal would suggest that we do.
Yeah, that stickiness question, certainly a key one, Sri. Thank you.
Thank you very much, Leslie.
Meantime, one company not as concerned about a U.S. recession is LVMH, the high-end retailer pushing into a new market, showing it off at a giant mansion on Star Island in Miami. And no surprise, that's where we find our Robert Frank. Morning, Robert.
Carl, LVMH making a huge splash in Miami this week as part of its battle for the $30 billion luxury watch industry. We're going to take you inside the LVMH mansion and marketing machine. Coming up after the break.
At 11:30 a.m. Eastern Time, we get the US 3-month bill auction, prior high yield of 5.225% and a prior bid cover of 3.03%, and the US 6-month bill auction, prior high yield of 5.02% and a prior bid cover of 2.92%.
Welcome back. European markets edging lower this morning after hitting two-year highs in Friday's session as financial sector losses weigh on equities. Despite oil rising this morning, Goldman says prices could fall and in response cut their profit growth outlook for the blue chip stock 600 index from 3% to 3% from 7% for 2024. The equity struggle comes as ECB officials offer mixed commentary on when to expect rate cuts. Slovakia's central bank chief says that April or June is mostly likely there. Portugal's Mario Centeno saying cuts could come sooner than May, but will likely be more gradual. And the ECB vice president was more neutral, hesitating to offer a clear answer on timing. On the other side of the world, China Evergrande is being ordered by a Hong Kong court to liquidate. The world's most indebted developer with more than $300 billion in liabilities has been unable to offer a restructuring plan more than 2 years after defaulting on its offshore debt, with Justice Linda Chan saying, quote, "It's time for the court to say enough is enough." Kind of a remarkable chain of events with Evergrande, of course, this feeling like it's kind of coming to a head at this point. Shares down dramatically, double digits, 20% in Hong Kong trading.
Again, property indebtedness, unemployment, capital markets falling. China's getting it on all sides. We're watching it very closely. Meantime, bit of a waiting game here as the week really heats up in the coming days. Let's get post to post with Bob Pisani. Hey, Bob.
Carl, kind of a flat day. Not a lot of trends, but it's going to be a big week. We've got the Fed meeting on Wednesday with the announcement looking for direction on whether there'll be a rate cut in March. That'll be the big story. And then we've got about 20% of the S&P 500 reporting, including almost a quarter of the Dow. So we're going to have Boeing. We're going to have a whole bunch of different companies out there. Apple, Microsoft, Honeywell, Chevron. And this one here, Merck, which has just been a monster this year, it did not have a very good middle part of the year. Rallied in November, December, did hit a new high. It's at a new high, actually. It just went negative here, but this is one of the big momentum names in the S&P 500 in the month of January. It's up maybe 9% or so, so we'll get some comments from them. Then elsewhere, the trend still is up on big cap technology. So we have new highs on a number of these names out there. Microsoft as well, sitting there. Meta's at a new high. And I keep pointing out these big cap software companies that keep hitting new highs. ServiceNow, another one today at a new high. Big rare down day on Friday. It was down just a little bit. But generally, it's been very strong throughout the whole year. Historic high there as well recently. Salesforce, another one. Dow Components doing really well recently. That was at a 2-year high as well. So generally, the movement in big cap tech continues. Now, we had a new listing here on the New York Stock Exchange today, which we talked about earlier. We had Gronkowski on earlier. Hope you saw that. We have the CEO as well, and this is Flutter. This is not an IPO. People keep asking me about this. This is not an offering of new shares here. It's just a dual listing with the New York Stock Exchange and with London. So they're registering shares on the U.S. On the New York Stock Exchange. So foreign shareholders, you can easily buy and sell shares here in New York as well as London, but it's not an offering of new shares here. It's not really an IPO. Let's just call it an NYSE listing. The listings we've had recently have been some real disappointments in the IPO front. We had BrightSpring on Friday, and that was a little bit of a disappointment. We're going to have a big one this week. Amherst Sports here, which is one of the international sports brands, big sports brands, including Wilson, some of the other big ones like Arc'teryx, big outdoor outerwear maker. We're waiting for them. Should be trading on Thursday, pricing Wednesday night, 100 million shares, 16 to 18. So that's pretty significant. They'll raise about $1.7 billion, maybe have an $8.5 billion market cap. We'll see how that trades. But again, we are waiting for a big breakout. We hear people are interested in going IPOing. We have dozens of names sitting out there. But so far, the performance, aftermarket performance for most of these have been a real disappointment. Carl, back to you.
All right, Bob, we'll watch it. Bob Pisani, thank you. Let's get a news update as well this morning with Silvana Henao. Hi, Silvana.
Hey, Carl, good morning. Defense Secretary Lloyd Austin returned to the Pentagon today, nearly a month after being secretly admitted to the hospital for complications from an undisclosed prostate cancer surgery. He began a bilateral meeting with the NATO Secretary General by giving comments on the drone attack on a small U.S. outpost in Jordan that killed 3 U.S. troops and injured dozens more. Austin said he and President Biden will not tolerate the attacks. The former South Carolina attorney convicted of killing his wife and youngest son will make his case today to be retried. His legal team claims the clerk of court tampered with a jury that found him guilty in the murders. He was later sentenced to 2 consecutive life sentences. And French farmers snarled traffic around Paris today as they formed a blockade on major roadways around the city. They're launching a protest against government regulations and calling for an end to environmental policies they say are making them less competitive with other countries. Leslie?
Silvana, thank you. The CEO of consumer products company Philips is after the break. An FDA settlement over the sale of a sleep apnea machine in the U.S. weighing on results. Stay with us.
Shortly expecting the results of the US 3- and 6-month bill auctions, I'll lead with the 3-month bill high yield. Five spot 21%, 5 spot 21%, bid cover ratio 2.84, 2.84. The US sells $87 billion in 3-month bills and awards 58.75% of bids at high. US 6-month bill high yield 4.985%, 4.985%, bid cover ratio 3.14, 3.14. The US sells $77 billion in 6-month bills and awards 95.16% of bids at high.
Take a look at shares of Philips lower this morning after reporting a miss on both revenue and earnings in Q4. But the bigger story weighing on the stock, the company announcing a deal with the FDA to suspend sales of sleep apnea machines in the U.S. following a recall of millions of devices that began back in 2021. Joining us now to break it all down, Philips CEO Roy Jakobs. Roy, thank you for being here. So what conditions does Philips need to meet, and how long do you believe it will take for your company to resume selling these devices?
Yeah, so maybe it's good to start with indeed the news of today. And what we announced on one hand was strong results on full year 2023. We had very strong sales with 7% growth. We had strong EBITDA improvement of 310 basis points. And we had very strong cash generation of 1.6 billion in the year, versus targets that we set out early in the year, which were much lower. We also announced that indeed we agreed to terms that were set forward by the FDA for a consent decree on the Philips Respironics business in the US. As part of that, that gives us clarity for a roadmap to comply as well as to restore the business. So we will work diligently on that. And based upon the clarity on the consent decree, we were also able to reconfirm that actually the plan that we put out there for 2023 to 2025, we are fully committed to, including any consequences of the consent decree. So that operational overhang is included in there, and we committed to deliver 3 to 5% of sales growth in 2024, a further profit improvement to 11 and 11.5%, and a strong cash generation also in 24 of 800 to 1 billion of cash in the year. So we keep executing our plan, and that now includes the clarity that the consent decree provides us.
What about the devices that were sold in, say, 2022, 2023? Do you have to recall those? Are those safe for customers to continue using?
Yes, the devices that we are having in the market in the US are safe to use. And actually, we have millions of patients that we service every day. What's also part of the consent decree is that we will continue to serve them with patient interfaces, the masks, the tubes and accessories. What is part of the agreement is that we will not sell new devices until we have fully complied with the measures we agree with the FDA. So that's something that is a target that we will work through very diligently. We have a team fully lined up for that. But if you look to the totality of Philips, which is 18 billion, the sleep and respiratory care business is 1 billion out of that. And what we presented today with that clarity on the consent decree is that over the totality of the 18 billion, we will deliver the 3 to 5% growth next year or this year, and we will deliver the profit improvement and the cash that we early committed to. Of course, we will work through all the patient remediation, and actually in the US we have done 99% of remediation. So actually we did recall, we did replace, and we have many patients using our devices safely every day to help them in their treatment of their sleep apnea challenges. And we will continue also to service them. And outside of the US, we will continue to grow the business and service also new patients as part of the agreement.
So sales growth and margin and cash flow and all that guidance remains unchanged. Does it have any broader impact on perhaps R&D or CapEx budgets?
Now, what we did guide for is that actually it will have a cost implication of 100 bips in the year 2024, but actually that we have accounted for. So actually in the plan guidance that we put out for the 3 to 5% growth and the profit improvement and cash, actually this cost is included. Now, what is clear that we will put our resources aside to make sure that actually we fully comply, we restore the business, but most importantly, we really service the healthcare system in the US and the patients in the US with our best solutions. And the partnership deal that actually we agreed and also we published with NYU Langone Health in New York is a great example, because many patients in the US do not have the best access to care and to the right care at this moment. And our technology solutions, whether it's in diagnostic imaging, whether it's in monitoring and enterprise informatics, help them to provide better care to these patients in the US across all the states. And this is a great example in New York, but we will do that with many other customers and partners. And we will continue to really focus on making an impact on patients and consumers in the US, but also globally.
Given the school of thought that some GLP-1 drugs, some weight loss drugs, could have a range of effects on certain diseases, including sleep apnea, given what's going on with the FDA, how committed are you to stay in this space for the long run?
Yeah, great question. We are fully committed to staying in the sleep and respiratory care business. We believe that this is a patient population that needs to be served with great innovations, and CPAP and BiPAPs are still the prime solution for them. GLP-1 will help because obesity is a contributing factor, but the average patient that uses and has a sleep apnea device has 5 comorbidities. So actually this helps to take maybe or lesser one of those, but actually the rest does still need a lot of treatment. And also there's a great population out there that's underserved. So we keep focusing on getting them the best care. Hopefully GLP-1 will help. I think that would be great for patients because we want them to be in the best possible health condition. But we know that many will still need this, and therefore we stay committed. And also we serve many patients every day in that space already here and now, and actually we will continue to do so in future.
Hey, finally, Roy, Street's very much interested in supply disruptions, watching activity in the Red Sea and elsewhere. A lot of questions about supply chain preparedness and whether or not there are playbooks from COVID that are being implemented now, even though the disruptions might be not as large.
Yeah, it's a great question, and actually it's indeed very true that we learned from COVID to be better prepared for these kind of disruptions. So one of the parts of the plan that I put out last year was my second priority was improving supply chain reliability. So actually we did a lot of work of making our supply chain more resilient to be able to adapt in an agile way to these fast changing conditions that we learn, unfortunately, that can happen every day. And therefore the Red Sea implications are there, we are managing them, and they're part of our guidance. So of course they have an implication for the sea freight that goes through it, but actually we are well catered for alternatives and make sure that actually we can continue to provide and dial up also the growth for our patients, consumers, and customers globally, despite some of these challenges that will interrupt the supply chain globally. But we have the alternatives in place.
Roy, thank you very much. Appreciate you being here.
Thank you so much. Have a great day.
Meantime, JP Morgan upgrading Dollar Tree today. The Street's top retail analyst, Matt Boss, going to join us after the break on that call when Money Movers continues in a moment. Welcome back. A note from the desk of JP Morgan sending shares at Dollar Tree higher today. The firm upgrading the stock to overweight, target of 157. Store closures in a growing total addressable market, just some of the catalysts there. Shares are jumping this morning, but down about 10% in the past year. The analyst behind that call joins us this morning, JP Morgan's Matt Boss, who, as you know, is an institutional investor Hall of Famer. Matt, great to have you back.
Thanks for having me.
I hope you won't mind me starting with just your macro setup, which kind of sounds a bit constructive, no?
Yeah, look, I think it's interesting. You could not have had a worse backdrop for the low-income consumer in 2023. I think 2024 could be a year of stabilization. You think about the tax refund hit last year, the cut to food stamps, on top of the fact that you had double-digit food inflation for really 2 years for that low-income consumer. I think you may be seeing signs of inflation having peaked, as well as child tax care credit opportunity potentially from Congress. You are now through, as you exit the front half of the year, some of the student loan repayments. So I think you could not have had more uphill sledding for this low-income consumer, but now I think that's in the base.
And that leads you to some of the Dollar Tree stores. This is a function where you go to where the stressed consumer will look to shop?
So it's value and convenience, Carl. To me, that's really the playbook here. And what we're looking for is self-help. So the breaking the buck, the expansion of the multi-price points for Dollar Tree, I think sets up this concept very well to take share in the next couple of years. As I look across the space, Five Below, to me, has a very nice algorithm of new customer acquisition. We also like off-price, so TJX, Ross stores in Burlington. So it's that combination of where the consumer can find name brands, but at a great value that's also convenient. And I think what you're seeing is the potential where low-income consumer stabilizes, but middle-income consumer still looking for value. So I think you have that combination of trade down from the middle income, but what would be new would be more a stable backdrop at the low end.
So you mentioned kind of an expanding total addressable market for this group. How do they compete with, say, the Amazons of the world and some of the other lower price e-commerce retailers out there?
Right, so it's a good question, Leslie. So as you think about the lower end consumer, there is an absolute buy now, wear now, need now component to this. And so milk, eggs, and cereal is the consumable side of a Dollar Tree. What's new is the introduction of the multi-price points in that they benefit from the treasure hunt. You never know what you're going to find. That's also the off-price model, TJX, Ross, and Burlington. But what's new for a Dollar Tree is by bringing in the $3 or the $4 or the $5 items, you can complete a category. And so I think the share that you're seeing from Dollar Tree's side is actually the more affluent customer. The last 6 quarters, the fastest growing since breaking the buck has been the customer with a household income of $150,000 and up.
That the war council is discussing a 45-day
We were just talking with the
release
CEO of
35
Philips
detainees.
about, overall supply chain challenges. How about this group? Do they face similar supply chain challenges in order to keep their prices at a reasonable price point for the lower income consumer?
So I'm glad you brought it up, because inflation for the last 2 years has actually been a headwind for fixed price point retailers. That would be Dollar Tree and Five Below, meaning they actually had to work to get the price out the door, given that it's the same. They had to manipulate the margins on the back end, and so they had to discontinue some items, and some of those were high traffic driving items, or they had to change the quality or even the quantity that the consumer would get in order to maintain profitable margins out the door. The reversal could be the case in a scenario where we saw a moderation in inflation or even deflation, in that I think there's the opportunity to invest in quality, quantity, and provide the consumer more at that same price point. So I think it could be a nice top-line driver for Dollar Tree as well as for Five Below. I think to your point on the sourcing side, look, the Red Sea is obviously very hot button. You are absolutely seeing sourcing costs rise. But this back-end model, especially with the greater flexibility from a pricing perspective, as now with the multi-price point introduction at the Dollar Tree banner, it provides that company more flexibility moving forward than they did the last time around that we faced this.
Matt, does this call mean that you need to take a look at re-rating some of the names in specialty where ostensibly in an on-fire economy you would have gone to look for brands?
It's a good question, Carl. What we're looking for is value convenience, so that would be off-pricers, and then self-help on the discount side, and then best-in-class brands. And I think you can bifurcate that as well. Self-help for us within the best-in-class brands would be Tapestry, PVH, and Nike. And then I think for compounding continued growth, that's where I would put a Lululemon, a Birkenstock, a Ralph Lauren. So I think there's opportunity. I don't think the consumer was in as bad of a place as maybe 6 months ago the market perceived. But I also wouldn't run with some of the holiday numbers either relative to expectations. So that's why our focus continues to be on self-help. But I do think you may be seeing as a theme some potential stabilization at the low end in 2024.
Wow. When you say it, Matt, it gets a lot of attention. I appreciate you sharing it with us here on Money Movers. Thanks so much, Matt
Thanks
Boss.
for having me back.
Up next, from the dollar store to the luxury consumer, LVMH looks to the watch market for its next leg of growth. We're live in Miami. Plus, a look ahead to Alphabet's earnings report as another competitor tries to take them on in search. Stay with us.
A monster week of earnings for tech this week, with Alphabet set to report tomorrow after the bell. But Google's dominance in search might now be under some pressure as new AI-powered search startups begin cropping up. Our Deirdre Bosa has that in today's Tech Check. Hey, Dee.
Hey, Carl. Good morning. So Google search, let's be real, it's not going anywhere anytime soon, but hanging over every earnings quarter over the last year or so, basically since ChatGPT exploded onto the scene, is this existential question. Can Google innovate fast enough in the age of generative AI, or is Gen AI the first notable threat to search in decades? So that is front and center again when Alphabet reports tomorrow. BofA writes, with AI positioning as the top debate on the stock, we see 2024 as a crucial year for Google, which could help establish it as either an AI leader or at risk for further search erosion. Now, further search erosion, that'll be tough. This is what the market for search engines has looked like over the past year. Even a Microsoft ChatGPT-powered Bing search engine has barely dented Google's dominance, and others like DuckDuckGo, which offers better privacy controls, they have been unsuccessful. But there is a new crop of Gen AI native upstarts making a run at the king. That means that they've been developed and built in this age of Gen AI. They wouldn't register either on a market share chart, but they are reimagining search as a whole. We've talked about Perplexity, backed by the likes of Jeff Bezos and NVIDIA. Another one is Arc, which released Arc Search over the weekend. We tried it out this morning, searching Paris Olympics as an example. Here it is, reading 6 web pages and then neatly laying out dates, host city, new sports, among some of the other facts, no ads, and a pretty clean user interface. Let's also show you a traditional Google search on a smartphone. You've got at the top a list of Twitter or X accounts and a lot of the same information when you scroll down, but it is notably more cluttered and harder to find. Now, Google's generative AI experimental search, which is available for some users, it does give you a much cleaner response, similar to that of Arc's and Perplexity's. But the point is that Google isn't willing to go all in yet and potentially cannibalize its business, its search business, before it figures out how to incorporate advertising, its golden goose. So the street is expecting Google to report $65.8 billion in ad revenue this past quarter, and that is nearly 80% of total sales. So that alone tells you how important it is. And as Microsoft is putting some hard numbers on its AI product, Copilot, investors, they're going to want the same from Google. TBD if we get it. We do have the most advanced version of Gemini coming out, which could be interesting. But Google still has kind of a prove-it case, has to prove it to Wall Street.
It's pretty remarkable, Deirdre. I mean, especially when you consider, remember Ask Jeeves, all of the search engines that went to the wayside once Google took dominance there. How much commentary do you expect on the conference call as it pertains to this product? Do they give kind of concrete numbers on expenses and what they're looking forward to in terms of applications for Gen AI?
Well, expenses is kind of like the magic word this quarter, right? Because as we start off 2024, no one has been as sort of cutting as much and as efficient as Google is trying to be. We've got rounds and rounds of layoffs, and there's this idea that it's marshaling resources towards that generative AI shift. But in terms of revenue, what they're actually going to show for it, that's certainly what the street wants. I expect lots of questions in that regards. Will Google actually give something? I'm not sure, because they're not really charging for Bard. It could show up in the cloud numbers. They will charge for that highest version of Gemini, so that could be something there. But that's really, like BofA says, that's kind of the debate for Google this year. Can they actually turn what they've been talking about and this leadership they've had for years in generative AI into actual numbers?
Yeah, it's interesting. Everyone said 2023 is kind of like the possibility year. 2024, okay, let's put this into practice and see it actually trickle through into margins.
When the rubber hits the road. That's absolutely it. People want apps and they want numbers.
So we'll see how much more patience the market has. Deirdre, thank you. Turning to the luxury retail sector, LVMH looking to the watch market for its next leg, I guess, or wrist of growth, we should say. Robert Franks on Star Island in Miami with a closer look. Hi, Robert.
Leslie, LVMH renting out this $50 million mansion in Miami as part of the global watch wars. Global sales of luxury watches reaching $28 billion last year, expected to reach $37 billion over the next decade. LVMH already owns 10 watch brands, including Zenith, Hublot, and Tag Heuer. What they really want to do is join that top tier that includes Rolex and Patek Philippe. Like most of luxury right now, it is the wealthiest consumers, the very high end, that are spending the most and are the biggest targets.
And therefore, the high end has been really one of the main drivers of our growth. I think the wealthy people, more than ever, are eager to invest into authentic, reputable, and timeless brands.
Today marks the start of LVMH Watch Week, the first ever here in the U.S. All the executives, CEOs for each of the brands are flying in to launch their latest models. They range from $2,000 to $2 million. So we're going to see a lot of those watches today. And interestingly, guys, the fastest growing part of luxury watches right now are women's watches. So that's a big theme we're seeing with all these new models.
Hey, Robert, we just had LVMH's numbers, 10% organic growth. We got good stuff out of Remy. How do we square that with things that are, like, for example, that Burberry's saying about the global economy?
Yeah, Carl, it's very company specific right now. You've got those that are executing well, that really justify the prices that they're charging for their products. And then Burberry, which just launched a new line with very high prices, untested yet from a design perspective. And then even within segments, watches is sort of one of the weaker sectors right now, but jewelry's doing well and leather goods are. So it's really company and sector specific right now. But by and large, the luxury consumer globally, even in China, is holding up well.
Yeah, remarkable to hear that about China in particular. Robert, thank you so much. Tough assignment for you, but we appreciate the effort out there in Miami.
Although he always looks so smooth that he fits right into that party scene,
He
right?
really
Yes.
does.
Star
I'm always
Island.
surprised he comes back to New York afterward.
Things are going to heat up tomorrow with Conference Board. We'll get some industrial earnings. Of course, we mentioned the big mega cap tech earnings tomorrow. Let's get to the judge in the half.
All right, Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour, the critical week ahead, the busiest of earnings season. 5 mega cap techs, Fed meeting on deck, jobs report, our investment committee sizing up all of that for you. Joining me for the hour, Joe Terranova, Bill Baruch, and Steve Weiss. Take you to the markets. We're green across the board. Maybe a little bit of a wait and see, not doing all that much, but we do have so much ahead, Joe, this week. You want to tell me what you think is really at stake for this entire market this week?
I think it begins with Microsoft. I think Microsoft is absolutely critical, that earnings report. Let's be clear that the expectations for all of these mega cap companies is incredibly high. They have a high bar to exceed. In terms of the impact of the market, I think that there has to be something within the earnings report that is so overwhelmingly disappointing that it will reverse a lot of the positive momentum in the market. I think a gentle miss, a small miss, I don't think that's enough. I still think there's enough entrenched buying in the marketplace for these companies. So I think Microsoft sets the tone for the week for sure. I don't think we should make too much of the fact that this could reverse the rally. I think it's going to be very difficult to reverse the positive momentum that's in place.
Although, Bill, you know, it's interesting. You've had a reversal of sorts already from broad to back to the mega caps. So maybe to Joe's point, that only increases the pressure because now the money's been flowing back. Year-to-date performance on everything but Apple is, I mean, you go off the charts. Microsoft's up 8%, Amazon's up 4.5%, Alphabet up 9%, Meta's 12.5%. Nvidia doesn't report this week, but it's up 24%. So the gains have been substantial over the first 3.5 weeks of this year.
Yeah, I do think there is a big deal in the fact that we've seen a lot of the expectations being built into the price action that we've had. And that was, you know, one of the reasons why I look at it with a little bit of caution. I mentioned last week on Nvidia and AMD, but I'm looking at, I think Microsoft, to your point, is the biggest one. They are the leader bringing AI to the marketplace first, and they're monetizing it. And by monetizing it, the revenues are flowing to Nvidia and AMD. So I think a lot is going to be tied onto that. Are they monetizing it properly? And then Alphabet number 2. Then, you know, where's the cloud direction? So there's a lot out there right now. I mean, if they miss a little bit, like you mentioned, I don't think it's going to be market over. But if there's a big whiff somewhere, there's going to be a lot of fear that it could show up somewhere else too.
Weiss, is it all about Microsoft? You know, tomorrow after the bell, because look, Dan Ives thinks it is. Said it's the most important earnings report and conference call of this season. Barron's says, okay, Microsoft's now the most valuable company. Now it has to prove it can stay there. From a valuation standpoint, it has expanded greater over its 10-year historical average than any of the others. 23.9 10-year average, 33.1 today. Assess that.
So here's what I'd say. I'd say it is the most important report of the week until Wednesday. So you have so much news coming after Wednesday that Microsoft's going to be in the rearview window. So with Wednesday, we've got the Fed, and then we've got three more important tech companies. Actually, take one of those out. Take Apple, because Apple has very low expectations, despite the stock holding up fairly well, and I believe those expectations will be met. But you've got other important companies. So yes, most important of the year, the most important of the decade for that afternoon and for Wednesday morning, and then it's on to other things. Look, you can take a look at a company like Tesla that really disappointed, that really missed, that's much more elevated, maybe not historically, but much more elevated to their growth and everything else than Microsoft is, and that stock's bouncing back since the disastrous report last week. So the market, to Joe's point, is pretty forgiving. I do think there's going to be a constant bid for tech, and Microsoft should have an elevated valuation to what it had, because you're entirely on the cusp of an entirely new product cycle that's driven by AI, and the company's also changed over the last 10 years with this massive recurring revenue stream. So we can parse whether valuation is much too high or whether it's too low, but if you take a view longer than Tuesday afternoon, I think you'll do quite well with the stock over time, as with the others. And that doesn't speak to what I continue to believe is a new population that's come into the market that's less driven by individual data points for more than a nanosecond and continues to like what they know, what's familiar with them. And that's Microsoft, that's Google, that's Meta, which I think is really doing quite well.
Yeah.
So I think the market's okay.
At some point, though, Joe, you've got to decide what you're willing to pay for all of the attributes that Weiss was talking about for, these companies that are betting big on this transformational technology. Sacconaghi over at Bernstein says he struggles to recommend an overweight for tech because they're expensive on an absolute or historical basis. We gave you what the 10-year averages are versus what they're trading at today. Apple is 10 times higher, or 10 points higher. It's 18.9, 10-year, 28 today. Told you what Microsoft is as well. Jonathan Krinsky, BTIG, is saying that the NASDAQ's showing signs of exhaustion, these mega caps are. So the bar's even higher.
I'm not sure I see the signs of exhaustion just yet. I think that there still is, as Steve mentioned, there's demand underneath the market when it appears as though we're about to enter a corrective phase. The buy the dip mentality still seems to be in place. I'm going to say something that I'm sure is going to be greeted with a lot of skepticism and probably a degree of criticism. But we keep looking at these mega cap companies and we keep referring back to the historical valuation of these companies. Maybe that's the wrong exercise. Maybe it's the wrong exercise to think about these companies in the past and not realize that maybe there's a valuation reset going on given the advancement of the innovation.
Well, not maybe. I think your point's well taken and fair. I mean, there obviously has been a valuation reset for some of these companies. The question is, are we putting the cart before the horse? Are we assuming that they're going to reap the rewards and benefits that the market has already priced in for many of these names? Now,
but the earnings have supported that today.
Well, Microsoft and NVIDIA are proving to be able to monetize AI in a way that some of these others aren't. Those rising tides have lifted a lot of boats. Now the proof's in the pudding as to whether the boats deserve to be at the same level with those yachts.
Yeah, but specific to Alphabet, specific to NVIDIA, specific to Microsoft, there's enough clear evidence there to suggest that we might see valuations grow even richer than where they are now, and it is warranted. So I just think, be careful relying on a historical valuation exercise to determine your positioning in a particular mega cap, not the derivatives off the mega caps.
I got you. You want to weigh in on that, Bill? I mean, because you have your top holding is Amazon. Yes. Your number 2 is Apple. Your number 3 is Alphabet. Your number 5 is Microsoft. So you're all over this week. You better hope they go well.
Yeah, I mean, I really do hope they go well. I think they can. And one we haven't mentioned is Amazon. And Amazon's the highest multiple of the entire group. And I really think here, if they've been seeing some really great tailwinds with margins in retail, as well, the juggernaut of AWS. I mean, if we continue to see revenue growth at that pace and better, I think what we're seeing is the multiples will continue to come down as we look out, and those are going to be a continued tailwind for the market, and that's huge for these big names right now.
Well, AWS has really, Weiss, I think, it's changed the game in terms of how you read where Amazon is trading. Amazon's always been at a historically expensive valuation, and in the past, you're like, wow, I'm going to pay 100 times for a marketplace business. I mean, how much can that really continue to grow? But AWS has changed the game enough that the forward PE on Amazon today is 42. It's not the triple-digit one that it's lived with for most of its history.
Yep, exactly. And think about it now. The vanity projects are gone. They've gotten religion, like all the other tech companies coming out of the pandemic, on spending. So Jassy has done a very good job of allocating capital to each business. And when you look at AWS, growth started to pick up again. We had a slowness. All cloud growth just hit a wall last year, but now it starts to reaccelerate as we saw the last quarter. What's lost in this conversation, though, is AWS signed a $10 billion contract with Microsoft to use their tools in their cloud business. So when you take a look at cloud, we've been talking about it for more than a decade, but still, it's less than corporations around the world are still less than 30% of the cloud right now. So you've got that massive transition that's going to continue and accelerate as more computing power requires more cloud usage. So that's a big, big tailwind. But, just go back to my prior comments. I would say to Krinsky that when you cite the numbers to the performance of mega cap tech this year, it's hard to say it's exhausted to anything but. But I do think at some point, it's only natural to see a pause in the acceleration in the market. Will this quarter's earnings give it reason to have that pause? Maybe. But we can't keep going like we are right now. Now, what could make me wrong? What could make me wrong is the Fed really changes their language. Well, what could make me wrong also, on the other side, is if the U.S. goes into Iran, and that'll be a knee-jerk reaction, because then think what happens. That's the real canary in the coal mine, because then oil prices will spike, and what's the Fed going to do? That'll drive inflation. So it's not like it's 100% clear ahead. There are some issues that can cause the market to be disrupted for a short time.
Goldman's Tony Pasquarello, head of hedge fund client coverage, on the idea, I guess, of exhaustion, says this has been one of the most powerful short cycle rallies we've ever seen. The 19% rip in the S&P over the past 3 months registers in the 99th percentile of market history. This type of move usually happens coming out of recessions. Stock operators should give thanks. It won't always be this good.
Excellent note, as always, from Tony. Let's talk about the exhaustion for 1 second for the viewers. The S&P right now is 48.96.
He's not saying it's exhausted. He's just pointing out with the facts like, oh, my gosh, this thing has really gone far away in a short period of time.
So how do the viewers think about Tony's note? How do they think about this exhaustion conversation? S&P is 48.96 right now. We all know that 48.08 to 48.10 was that critical area that Friday morning about 10 days ago. We broke out at 10:30 in the morning. You had all that non-discretionary buying come into the market, algorithms, hundreds of billions of dollars coming in, getting long the market, right? Not even thinking about it. That's the level. That's the point of reference. So to what Stephen is targeting, it would be more than normal, for us to be in a consolidation range, for us to get earnings from mega cap technology, whether they're disappointing or whether they exceed expectations, and for the market to retreat in somewhat of a consolidation phase above 48.10, below 4900, and just basically chop around. Oh. That's a normal circumstance, and that's a circumstance, Scott, that doesn't mean you're getting out of your equity names, because you're not going to be fast enough to get back in when the prevailing bull trend starts up again.
I had a conversation with the Wharton professor Jeremy Siegel on Friday about where his expectations are for where the market can go over the remainder of the year, whether it's too expensive now. I want you to listen to what he told me. Sure, he's bullish, but listen.
I'm still positive on the market. We are selling for 20 times earnings, although, I mean, if you're a growth stock, you're selling at 25 to 30. If you're a value stock, you're selling at 15, 14. So there is a difference.
And S&P's Jordan says regarding
overall,
inflation,
20
the situation has improved. It
is
looks
okay.
relatively good.
It's not cheap. And I still think we can get 8 to 10% for the year. The economy is still very strong. I think we're actually going to beat 242 earnings on the S&P 500. As a result, I think stocks could advance.
8 to 10%. That's the professor. What do we think?
Yep. Well, I think the market, to Joe's point, a consolidation here would be really healthy, but we could still grind higher if a rotation happens. Some of the steam that really drove this, the mega cap tech, maybe earnings pre-pricing themselves in, and then to the Goldman Sachs note, Tony's note there, in order to have such a vicious move to the upside, there needs to be money on the sidelines to fuel that. And why was the money on the sidelines? Because Powell said he was going to bring pain over a year ago. He said he was going to bring pain, and guess what happened? Inflation's come down. So now that we've seen this continual evolution of moving away from needing to bring pain, now that we can have a little bit of a sort of open space, if they make a transition this week and they remove that restrictive note around it, and they really sort of pave way to a cut in March, I mean, what's going to stop this market from continuing to go higher?
They've already, look, the market's moved a lot because of the perceived pivot that the Fed has already made. Jan Hatzius, by the way, doubling down on his call for a cut in March. 5 cuts in total. March probability is now less than 50%, 49. But nonetheless, the probabilities have been coming down steadily as the economic data has remained strong and going in the opposite direction. What do you think about this March idea?
I think
how anchored do you think we are to that?
I think you have to watch the Treasury market, and I think that's what's important right now. Okay, the Treasury market 10-year yield peaked at 4.19. We're beginning to see Treasuries once again, 10 years, beginning to retreat. We've got a 4.10 on a 10-year right now. Watch for the disinversion. That, to me, is the absolute critical indicator in the market.
Tell me this trade you made. You're buying really short-dated calls in the IWM.
Yes.
Small caps as a play of sorts on what the Fed may do this week.
Literally insurance. I think, Bill, you could relate to it. It's literally insurance on the portfolio. Think back to the December meeting, how after that you began to see the broadening out of the rally. You saw the Russell 2000 get some wind behind it, significant tailwinds. Potentially you could have the same thing occur this week. These are short-dated options. These are options that I will hold through the FOMC meeting just in case you get that broadening out on something that the Federal Reserve might indicate, or if you get the disinversion of the yield curve. You've got to watch that 2 to 10 spread. So these are IWM calls, the 198 strike. Like I said, listen, they're not significant in size. They're nothing more than a little portfolio insurance guarding against what happened in December. And by the way, the probability of what I think this will actually occur, I am not incredibly confident on it. That's why I'm using the option market.
Well, I agree with you. I think the Fed wants to normalize the yield curve. And then here's the reality. With the 10-year real rates hanging around 2%, this is the highest level since 2007. If they want to cause a recession, they will keep real rates up here. That is the reason why they're going to be cutting rates.
Well, it only adds to the intrigue of what's going to happen this week. Don't forget the jobs report, too, at the end of the week. There's another Goldman story, by the way, making news today that we're following. It's Jim Esposito. He's the co-head of investment banking and global markets, is going to be leaving the firm. Our Leslie Picker is with us today following the money. I don't know how much of a surprise this is. He's 56, been there almost 30 years. He's done so many things over there, too, and just a really good guy.
He is a really good guy. I was just talking to someone about that. But yeah, you bring up a good point. 56 years in banking is like, I don't know, 80 years in another profession.
Yeah, right.
So it's time. My understanding and speaking with people close to him is that it's time to try something new. He ran that group, Goldman's Bread and Butter, with 2 other co-heads who will continue to manage the unit, which houses investment banking and sales and trading. Esposito will become a senior director, according to a memo obtained by CNBC that was sent by CEO David Solomon to the firm. The Wall Street Journal reporting that Esposito wanted that top job, and in leaving, it's a signal that he saw the odds of attaining a promotion to be a long shot from here. The Journal added, citing people familiar with the matter, that Solomon has indicated to top executives that he's not stepping down anytime soon. So it's bench warming season with the recent moves at JP Morgan, Morgan Stanley, succession very top of mind on Wall Street. But this is, I think that's somewhat newsworthy that Solomon has indicated, hey, I'm not going anywhere anytime soon.
Right.
They had a very good fourth quarter, especially relative to the prior quarters, second and third quarter of last year, where there were some special items, a pretty significant pivot at that firm. There was some negative press, some publicity, some concern that maybe he didn't have the full support of the board. Ultimately, it appears that has all kind of at least simmered down for now, and he's indicating he's not not stepping down.
No, leaving at a time of relative calm after what was a fairly sizable storm around what was happening, not only around Solomon, but with the transition away from some businesses. So I think there's the obvious idea of that's now past, but the inescapable part is looking into the cockpit and saying, well, the lead pilot's not going anywhere. The co-pilot, John Waldron, he's like 55, I think. He's not going anywhere. So what are the chances that I'm going to get to take the wheel here and wanting to have another significant act before the sand runs out?
Yeah, right? And it appears, based on the bench that Goldman does have, that there are significant talented people, should that position open up one day, that they could fill that void. Obviously, Waldron has been floated as a potential candidate. Dan Dees, who is Esposito's co-head of that group, has been floated as a potential candidate, among others. So there are certainly names that get floated around that could ultimately, take that position should it open up. But, based on the journal's reporting, and I've done some reporting as well, it doesn't appear like that seat is going to be open anytime soon.
Yeah. I spent some time with him over in London not that long ago. Seems in a good place.
Yeah.
And just a good guy, as we said.
We'll see what he does next. It sounds like he wants to maybe do something a little different, although he's not sure at this point in time. So definitely a career to follow.
He's still young. We wish him well.
Yes.
Do we, Jim Esposito? Leslie, thank you.
Thank you.
You guys own the stock?
I bought Goldman Sachs recently. I think it's one of the top capital market plays as a shareholder. Yes, obviously, sorry to see such a talented executive leave Goldman Sachs, but I feel as though Goldman Sachs is positioned in the right direction now. Clearly, since December, they had a little bit of a breakout. You're maintaining that even post-earnings. Stock trading at 376. I see the stock going above the November high at 426. I like where they are. And when you're thinking about a capital markets recovery, think Goldman Sachs.
Weiss, you own Goldman too, yeah?
I do. And when you think about what David Solomon has done, he's changed the game plan at Goldman quite a bit. So you could actually be surprised that more haven't left that did so well under the prior business plan, which means he's gone more to an asset management firm. Look, Jim's brother left a few years ago, Mike. Goldman, it's the culture, it's the people, it's the next person up. So I think David Solomon's done a great job. Waldron is unbelievably well liked by everybody who comes into contact with him. And by the way, this is not just Goldman. When Staley left JP Morgan, we said, oh no, there goes the heir apparent. Well, thank God, right? Because of Jeffrey Epstein. We take a look at Apple. They just lost another key person. They lost Johnny Ives. They lost so many key people. It's interesting we don't talk about those companies, which arguably don't have as deep a bench and don't have, have the talent like Johnny Ives in certain people, not expansive. And we focus more on Goldman, which has one of the strongest cultures, one of the longest dated cultures of any company out there. So to me, we had the same conversation about Goldman, the head of asset management, left about 6 months ago, and their stock's higher. So these are blips. These are just the normal turn of events at companies. And look, he's made a lot of money over his time, and he goes and he sees, maybe I want to do something over again. Because when you're a banker, you're also an entrepreneur. So that bug hits you, and particularly when you've earned the money that Jim Esposito has had, and you have that freedom of choice, why not?
All right, another story we're watching as well here at the New York Stock Exchange today. Well, the Super Bowl, obviously, the matchup set there, and right on cue for that, the parent of gambling site FanDuel listing here at the New York Stock Exchange. Who else but Contessa Brewer is here following that? That's Flutter. Today. It's right in your wheelhouse.
So exciting. They had a marching band coming
was
through.
Here, the marching band.
I mean, it's like it was a show, right? Well, so Flutter shares here list for the first time in the United States as a dual listing, as its primary listing is in London, where it's included in the FTSE 100. But May 1st, shareholders will actually vote on making the U.S. the primary listing. Why does it matter? Well, FanDuel is in first place for market share in the U.S. with notable revenue growth and proven profitability. And yet, DraftKings has enjoyed the lion's share of earned media and really captured the imagination of American investors as the biggest / only publicly traded pure play on sports betting. Flutter CEO Peter Jackson told me this morning right here that he's eager to take advantage of all the media coverage, but also to offer domestic investors an alternative. He says Flutter is going to benefit from the liquidity on the New York Stock Exchange, and he's really excited about that moving forward.
How do they stack up to DraftKings in terms of their marketing spend and their, I think what the industry refers to as their customer acquisition costs?
They love jargon, CAC, they call it. It's lower than what DraftKings has been spending by quite a lot.
Does it have to be higher now?
I don't think so. I think what happens is you see the marketing costs ramp up around football because they want anyone who's not already betting to try it out for entertainment purposes, and football is the #1 sport in America. So that's number one. Two, what they see is as states get more mature, the marketing costs, the promotional expenses come down quite a bit. And that's how some of the other competitors, Caesars, for instance, has already had profitability in specific quarters because they really pull back on that marketing spend when they need to. Jeffrey's out with a note that says, given FanDuel's outperformance in the market share, it should enjoy a 20% premium to DraftKings multiples.
I can't imagine that this is all a coincidence that this is happening today after we're sitting here with all of the Super Bowl talk, which is their Super Bowl in terms of where gaming is.
It's so exciting. And what we heard was, in fact, one of the FanDuel executives told me that during the Chiefs game last night, or the 49ers game, they got 60,000 bets per minute. That's 10,000 more than during the Super Bowl last year. And so what you're seeing is more engagement across the board for this. What will that happen? You know, what will we see play out during the Super Bowl? I think these are two teams that they could be really excited about. Big market teams, you know, a history of really performing.
Yeah, spread's close too, so you're going to get a lot of money on both sides of the ledger too.
I think that's true. Can I point out one more thing that might matter to investors? iGaming. We got numbers for the states, 5, 6 states where it's legal right now. Pennsylvania is the first state to make $200 million on gross gaming revenue on iGaming. That's online casino games. The only state that's done that on online sports betting was Ohio when it first launched in January of 23. So the potential growth from iGaming, where FanDuel is now the market leader, I think is really phenomenal and notable.
Oh, good point. Contessa, thanks. Contessa Brewer. All right, up next, our calls of the day. Uber, Costco, AbbVie are all on the move. We'll trade them next.
SoFi.com/TV.
All right, we're back. We're going to do some calls of the day now. We're going to start with Uber. Everybody owns it on the desk today because Bernstein is previewing their earnings, hit a new record high, by the way. Quote, I think it's evident that Uber has graduated from stonk to stock over the past year, and any significant dip will get bought by long-term shareholders who now believe Uber is a must-have core holding for many funds. What do we think?
I think this is a great note. I think it highlights all the reasons why you want to take ownership of this company. Recently added to the S&P 500. It is an industrial 3-year, 41% revenue growth, 14% revenue growth last year. It's a type of company you don't get that type of growth from an industrial company. 56% of its revenue exposure is in the U.S. That's where the opportunity is for the international growth. And we're talking about a stock buyback.
I know how much
Uber?
is priced in, though, right?
Stock
it's up
buyback?
It's up 120% in a year.
No, my response to that you're not going to like, but how high is high and how low is low? No one knows how high is high and how low is low. The momentum fundamentally is well entrenched into this company. It is a core holding.
Why wouldn't I like that?
I don't know.
What kind of answer is that?
They've come.
Bill, you own it too. It's a top 10 position for you.
They've accomplished a lot. I mean, you look back into 2020, negative $3.3 billion free cash flow, now positive 2.2. What they're doing here is in penetrating outside of their traditional business, the final mile, delivery. I mean, they're looking at really, I think the moon is the possibility here. I mean, if you're looking for the stock that the next 5 to 10 years with tremendous upside, it's Uber.
That's a great answer.
Yeah.
I liked it better than Joe's. Weiss, you own it too.
I do. Look, when you think about what the CEO has done, he's not only had to change the company in terms of their operations, he's had to change the culture. Think of how many CEOs have been able to do that. So going back to our conversations and Joe's comments on valuation is going to get a lot cheaper this year, and next year in forecast, you're below 30 times. That's not cheap in the absolute, but coming from last year's over 100 times earnings, you see the progression. So I think the market is much more focused on fundamentals than it really is on a PE basis. The other thing I'd say, certain of their things don't work. Like, I don't think last mile delivery is going to work. They can't make money on it. The drivers can't make money on it, and the vendors can't make money on it. So I'd stay away from that. The other thing I like about this is scarcity. So what do you have out there? You have Lyft. But Lyft is sort of like a pimple. It's a really distant second player. Now, they may turn it around. They may not. Who knows? But right now, we've got scarcity, and I love that in looking at business models.
Okay, Costco maintained a buy at Jefferies. Joe, you have this in the Joe T.
Since inception, this is a core holding, consumer staple name. Clearly, Costco, Walmart, they have figured out customer retention to a degree in which Target is struggling over the last 18 months. Let's be clear on that. They will report earnings on March 7th. I expect another strong quarter from this company. 72% revenue exposure here in the U.S. They are correlated to a U.S. consumer that's out there spending.
Bill, AbbVie upgraded to outperform today at William Blair. So what do you think about that as you own that stock?
They've continued to surprise with the drug coming on in their new pipeline, Rinvoq and Skyrizi. And there still is a disconnect with the street with where they see the growth from these two new drugs to where AbbVie sees them. AbbVie sees growth into the 2030s, where the street really is predicting to 2028. Humira has continued to be a much better participant in revenue than they thought. And then guess what? Hedge funds are short this name. It was one of the largest hedge fund shorts. So as this name is breaking out, it broke a downtrend line, there's going to be short covering that I think that fuels this thing to record highs.
That's a great answer.
Thank you very much.
Again.
Thank you.
You taking notes?
Yeah.
All right.
I do what I can.
I'm learning.
All right, good. Silvana Henao has the headlines for us. Hi, Silvana.
Hey, Scott, good afternoon to you. The U.S. military was unable to stop a drone attack that killed 3 U.S. troops and injured dozens of others in Jordan yesterday because of confusion from the enemy drone approaching the base at the same time a U.S. drone was also returning to base. That's according to a Wall Street Journal report quoting U.S. officials who say so far they have yet to find evidence that Iran directed the attack. 20 years after a rap legend was shot in his New York recording studio. The trial is set to begin today for two men accused of killing Run DMC's Jam Master Jay. Prosecutors say the two men killed the famed DJ over a drug deal in 2002. Both men have pled not guilty. And members of an exploration team believe they have solved one of the world's most enduring mysteries, the location of Amelia Earhart's plane that vanished over the Pacific Ocean in 1937. In a trip to the suspected area of Earhart's crash about halfway between Hawaii and Australia, the Deep Sea Vision team found a blurry shape of a plane using sonar. The team plans to return later this year for
more
a
barrels
closer
to the
look.
oil
We
reserve.
got to solve this.
Yeah, Silvana, thank you. Yeah. Silvana now coming up. We're going beyond big tech. Bob Pisani looking at the big buzz in the ETF world outside of the Mag 7. We're back in 2.
Protect your trades from macro headline risk with Financial Juice Pro. Now only $99 a year for our real-time service.
CNBC.
We are back now to Bob Pisani with today's ETF Edge. Bob, and we're looking outside, rarely outside of the Mag 7, I hear.
It is, and we're interested in trying to figure out where the business is going for the ETFs for the Magnificent Seven. It's a new year, lots of new money moving around the ETF space in the first month of the year. Let's find out where the money's going. Ben Slave, an old friend of my global head of ETFs at BNY Mellon, and you do a lot of the plumbing for keeping the ETF business going. We got to spot Bitcoin. How is it trading? And most of the money seems to be coming for the new ones out of the grayscale and into the new ones. Not a lot of broad retail money, though, going in. How would you describe the first 3 weeks of this?
Well, the headline, first of all, is that the product is working just as advertised. It's tracking, and we're obviously seeing a healthy amount of liquidity and interest from investors. Where we're seeing the money come from has been more on the institutional side, much less on retail. These products are not available yet on models. They're not fully available on platforms. So primarily it's been institutional investors. And now we'll see the real battle of the tickers begin as these products take root in the market.
We've got a lot of buzz in the ETF world about alternatives to the Magnificent Seven stocks. Everybody's nervous again about how top-heavy it's been. Tech sector is what, 30% of the S&P? Semiconductors are a third of that at this point. Equal weight, RSP, there's equal weight tech that's getting a lot of inflows recently. People seem nervous about the top heaviness. Is there a reason to be concerned, and what are you seeing for flows?
Well, certainly it's something we're hearing more and more from advisors, and you can see that in the flow data. They're looking for somewhere else to go that really has been less loved, or at least at lesser valuations. And we're seeing some rotation into certain sectors, financials, a little bit into real estate. And certainly I think something we started to see in the fourth quarter after the big small cap rally, we see money being allocated there as well.
Finally, ETF investors seem to be coming out of the short end of the curve in the terms of bond ETFs. Why is that happening? Where are they starting to put their money right now in terms of bond ETFs?
Well, we saw in 2023 a huge amount of investment go into the short end of the curve, and certainly money markets were also a big story there. Now we're starting to see that rotation going into really the intermediate term of the curve, and that is really looking for yield. And also, as this part in the rate cycle, or at least the expectation on this part of the rate cycle, that you're going to get some capital appreciation as rates continue to move down, and you see quite a bit of retail and advisor positioning into those names.
Okay, we're going to have a lot more on all of these subjects, much more coming up. Ben, with Ben, and where ETF investors are putting their money, that's coming up. ETF Edge at 1:10 p.m. Eastern Time. Ben will be joined by Todd Rosenbluth, head of research at Verify.com. That's etfedge.cnbc.com. Scott, back to you.
All right, Bob, appreciate that very much. Thank you. Bob Pisani coming up. We have more committee moves. Bill. Yeah. Bill? Prefer Bill to Bob?
I'm Bill.
Okay, good. He sold an energy name we need to talk about. We have many other names, by the way, reporting this week. We'll trade a bunch of them next.
a trial.
All right, welcome back. I want to trade some of these names outside of big tech reporting this week. So we said it's the busiest week yet. Nucor is today after the bell.
So I like the setup, not so much in terms of fundamentals and earnings. EPS is going to be down 40% year on year. Revenue is going to be down 12% year on year. You've got labor shortages, which is impacting construction, and they've got pricing pressure. But you're seeing a little bit of auto recovery, some growth there. And the way that these steel names are trading is very constructive, both in the case of Nucor, which is the largest U.S. steel maker, and Steel Dynamics, which we own in the JOTI ETF. Very strong positive momentum.
Okay. AMD is tomorrow. I don't want to do that one because we've talked a lot about that, its relationship with the so-called AI5, et cetera. But so is Marathon Petroleum, which you own.
Yeah, I mean, they have just continued to make record highs. It's in our top 10. I also run a portfolio where I only own 10 names, and it's the only non-tech name in there. They've gone from free cash flow negative in 2020 to like 15 billion plus over the last year. Just a lot of these energy companies have, but the refining margins have actually tapered off in 2023 at the end, and we've seen Marathon Petroleum shake it off and continue to grind higher. I think there's a very, very well-run company, and the refining space is doing terrific.
Wednesday's MasterCard, Joe.
MasterCard and Visa.
So what do we think here after? I mean, these are payments companies, not pure credit cards like Amex is. But what do we think?
They don't have the credit exposure. I expect another solid quarter. They've been delivering solid quarters now since 2020, both MasterCard and Visa. These are two companies in the financial sector that really have become core holdings when you think about, well, how am I owning the financial sector itself?
What about automatic data? That's Wednesday as well. You have that in the JOTI.
We do. That's a stock that's in a little bit of a perilous position, so I'm not going to get too much into that because of the upcoming rebalance.
Okay.
But there are some things that have deteriorated.
Okay, say no more.
Yes.
Bill, so Shell is on Thursday. You sold Shell.
I did. So, I mean, we are overweight energy. Marathon Petroleum are obviously our largest holding there, but when I am a little concerned with growth outside of the U.S. compared to Marathon. Really, 100% of the revenues are coming from the U.S. Shell as well. They've started to kind of just sort of reconstruct a little bit. They're shutting down a refining plant in Germany. They're rolling out something in Nigeria. I'm not really sure the direction of the business as much, and we put it on as a starter position. I want to build into things, and I'm just not seeing the future here at the moment.
Okay. We also have Eaton on Thursday, Illinois Toolworks, and Microchip. You want to take which one you want to talk about?
Let's talk about Microchip.
Okay, go ahead.
That's in the semiconductor space. Relative to its peers, there's been a degree of underperformance. This is going to be an earnings report that is going to be incredibly important. In the case of the other industrials, again, these are quarters where they really have to come forth and show you that the recovery is in place.
Okay. I think Illinois could have a good report, although I don't own the name. Caterpillar setting record highs. United Rentals blew out report last week. Illinois Toolworks could be right in line with something like that.
All right, so we still have to do big winners, big losers, two on each side. SoFi is soaring. We're going to tell you what's up with that. Mike Santoli with his midday words next.
technology.
Senior markets commentator Mike Santoli is at the desk with us today for his midday word. As always, you question whether the market has a so-called high-quality problem, but the premium on perceived quality and whether it's now gotten too expensive.
Yeah, I mean, there's a clear preference in that direction. It's really another way to cut at the, acknowledged winners. A lot of times talk about it as mega cap tech as really winning here, but it really can be more isolated as quality, because even within every other sector, it is the better balance sheets, it's the higher profit margins, the ones that it feels as if they're more predictable. So I'm just really asking the question if people are getting a little bit too comfortable with the stability of those names to the exclusion of everything else. So it doesn't have to be, wow, these things are really, precipitously high and they have to go down. It's really another way that the market shows its lack of confidence in the majority of stocks and in the sustainability of this very benign economic environment.
You use Berkshire as an example, which is interesting. Explain.
So Berkshire, of course, quality up and down in terms of financial strength. It's actually kind of like quality square, because the portfolio of its publicly traded companies are also mostly quality. But right now it's all-time high. It's at a premium to its typical book price to book value range. So if you look at a 15-year spread, it's at the upper end. Again, you're not going to get super hurt by owning Berkshire Hathaway over the long term. The question is, are people crowding in almost by default because they feel there's other things going on? It's got the 6% in Apple. It's, insurance is a great business right now. We can talk about why specifically, but I think it's just a question of, let's examine the assumptions under which we're paying a high premium on quality, which of course is in some ways a backward-looking factor.
Yeah, interesting. You want to give me something real quick?
The relief,
20 seconds.
I think the relief comes to the other area of the market that's not considered quality in its nature in the form of yields.
Yeah. Mike, good stuff. I appreciate it. Thank you. That's Mike Santoli. I'll see you on Closing Bell. Of course, 2 winners, 2 losers. That's next. Talk about 2 big winners today and 2 big losers. Boy, SoFi's having a day. First quarter of profitability on an adjusted basis, that stock's up better than 17%. So that is clearly one of our big winners today. We take a look there. Yep, there it is, about 17.25%. Lucid on pace for its best day since January of a year ago. iRobot's down. Amazon's terminating its iRobot deal. That stock's going the opposite direction. How about Nat Gas? We're not talking about a stock per se. There are a lot of equity plays that relate to Nat Gas. This thing has been incredible, just how low natural gas prices have gone.
Yeah, I mean, you would think with what took place with Russia and Ukraine that we would have seen something sustained, and it just hasn't. We do actually have some natural gas exposure in Cheniere, and it's near a top 10 holding of ours, where they get paid on the volume, but the price of natural gas, I mean, it's just falling apart, but we are getting into Widowmaker season, which is the March-April spread, it's historically called.
Is there a direct relationship? Well, we talk all the time, direct relationship between the price of crude and then oil-related stocks. Is it the same way for natural gas?
Well, for natural gas, if we're shipping LNG, like so Cheniere, they're paid really on the volume of moving natural gas abroad. And so they've actually held out really, really well within range of their 52-week highs, despite what we've seen in natural gas. And then the price-wise, we get one cold front, market kind of spikes. It has a lot to do with expiration and positioning in the market, and that can really drive things. And then once the cold front goes and the roll happens to the next month contract, then the prices have just dissipated.
Okay, quick break. And final trades are on the other side of that. Hope you'll join me. Closing bell, 3 o'clock Eastern. Dan Greenhouse with me today, along with King Lip of Baker Avenue. He owns most of the mega caps, so good time to talk to him. And B of A Merrill's Chris Heisey will be here as well, so I'll see you in a couple hours' time. Final trades. Weiss, what do you got?
Despite the move, Taiwan Semi is the most critical company to every tech company we mentioned today.
Okay,
so I would buy it. I think it goes higher.
All right, thank you for that. Bill Baruch.
AbbVie, looking forward to the report on Friday, long above 160.
We got
Reiterating on Goldman Sachs, and watch that 10-year, 409 right now.
Pointing out Meta and Microsoft running during our show, too. So we'll keep our eyes there as we think about big tech this week, Fed meeting, jobs report, and everything else. I'll see you on Closing Bell. The exchange starts now.
Scott, thank you so much. In for Kelly Evans, I'm Tyler Matheson, and here is what is ahead this hour. It's a big week for your money. We've got earnings, the jobs report, and the Fed's decision on interest rates. A cut is not widely expected right now, but one of our guests says not cutting now is a big mistake, and he'll tell us why. Plus, North Carolina's state health plan will stop paying for the obesity drug coverage that it had been covering, and that may be good news for one company. The CEO of that firm will join us ahead. And Red Sea disruptions could drive demand for one area of the commercial real estate market. We'll tell you where. But we begin with today's markets and Dom Chu. He's got the numbers. Hey, Dom.
All right, so we got a relatively calm market right now for the S&P 500. It's been a relatively tight trading range. It's currently up about 0.1%, up about 6 points, 48.96 the last trade there. We were up roughly 11 points at the high and maybe down 3 points or so at the lows of the session. So at least tilting towards the middle end of that trading range. The Dow Industrial is just about flat on the session, down 0.1%, 38,075. The NASDAQ Composite really pacing the advance, if you want to look at it that way, up about 0.5%, 63 points to the upside, 15,518 the last trade there. A key market that saw a lot of action bullish this morning that has since faded has been the crude oil market. We saw some highs that we haven't seen over the course of the last couple of months on U.S. benchmark West Texas Intermediate. It's currently down 1.5%, but it was actually solidly higher earlier on today on some of those Middle East tensions kind of starting to incrementally get even more intense with soldiers dying from the U.S. side of things in Jordan, close to the Syrian border. That did push those crude oil prices higher at one point, but as you can see there, they've backed off from those levels. We'll keep it on crude oil. And then, as Tyler mentioned, massive week for earnings. Corporate earnings-wise, it will be the busiest week of corporate earnings for the S&P 500, and the names that really matter, the heavily weighted ones, will factor in the most. On Tuesday and Thursday, you're going to get earnings reports from the like of those Magnificent Seven type stocks, like Microsoft, like Apple, like Alphabet, the parent company of Google, Amazon, and Meta Platforms. Each of these stocks is going to have their spotlight on them throughout the course of this week. So, Ty, keep an eye on that mega cap technology trade, a big factor in those fundamental catalysts, either up or down for the markets in the coming days and weeks. I'll send things back over to you.
All right, Dom, thanks very much. See you here in the next hour. Meantime, investors have their hands full with earnings this week, but we're only 48 hours away from the Fed's latest decision on interest rates. Steve Leisman here now to set the scene for us. Steve?
Hey, Tyler, yeah, one way to think about the Fed is this. They've done their final maneuvers on the balance beam. It's now in midair to execute the landing, and no one quite knows if they're going to stick it. Judged by the inflation numbers so far, the past few months anyway, the routine has gone pretty well. All three major gauges, PCE, headline, core, and even core services ex-housing, are at or below 2%. The 6-month annualized core rate has been below the Fed's 2% target for 2 months running now. And all of that has come, surprisingly, with growth above potential and the unemployment rate barely budging. So why not cut rates right now? Well, staying the Fed's hand, judged by what they've been saying, from that immediate cut is concerned about the sustainability of the decline in inflation. Growth in employment still remaining strong, with particular concern about wage growth and risk from, of course, the Middle East conflict, which could lead to a new inflation surge. Hasn't so far. The Fed, most of all, doesn't think it'll help the credibility or the economy by cutting rates and having to reverse course and hike again. So it wants to be very sure. Markets have now given the Fed some flexibility. There's just a 2% chance of a rate cut at this meeting, 49% for March. That is down from a near certainty of around 80% at the last meeting. You can see that certainly rises to all the way to 99% by June for that cut. Now, the Fed's path to its landing is full of uncertainty. Strong growth could give it time to execute the soft landing, but rate cuts need to work into the economy, and you still have those past effects of rate hikes still dragging on growth. And you can do a routine, Tyler, a great routine, as you know, but if you blow the landing, Ty, you could end up off the podium.
It's absolutely true. Let's talk a little bit about the global tensions that you mentioned there. How does the Fed weigh such things as disruptions of shipping in the Red Sea that could affect oil prices and certainly the price of goods coming to market?
You know, there's a little bit of just concern that, you know, we're having the deja vu all over again. The rise in shipping costs was part of the recession, or part of the inflation that happened in the post-pandemic era. But the issue, Tyler, is I think they're going to see this, for now at least, as being isolated. They're going to watch it for a while. I was really interested in Dom's report, because we do keep seeing this, that you have these spikes in the price of crude, and then they come back down. And I think we've talked about this, but the story again is the amount of domestic production we have in the U.S. that seems to keep a lid on just how far up oil prices can go. But the Fed's going to watch it, and there will be concern about some of these higher oil prices, again, feeding into certainly the headline, and they'll watch if it feeds into the core.
All right, Steve, thanks very much, and we'll wait and see what happens on Wednesday. Probably nothing, but it'll be interesting nonetheless. Steve Leisman, thank you. Our next guest says the Fed should be cutting rates this week, but they won't. He sees the ghosts of the 70s and 2021 haunting Jay Powell, but warns that a late pivot could lead to an even worse horror story. You got the picture? Joining us now, Tom Fitzpatrick, Managing Director of Global Market Insights at R.J. O'Brien. Tom, welcome. So what are the historical allusions back to the 70s and 2021 that have you believing that the Fed will misstep here?
Hi, Tyler, and thanks for having me on.
You're welcome.
I think when you look back to the 70s, obviously, and certainly at the start of this cycle, the Fed, and a lot of other people for that matter, focused in on the 70s because that was the last big inflation surge. But there are a lot of material differences. There are similarities, even in terms of the Middle East conflict. But when you go back to the 70s, we saw the oil price surge by a factor of about 17 times. So it was very sticky for a very long period of time. But when inflation got out of the bag this time, that was the reference point the Fed was using in terms of their past mistakes and the fact that they didn't get inflation under control. And this came after 2019, when they were also talking about the mistakes that they made during the global financial crisis, not easing quickly enough and then choking off the recovery, the jobless recovery, too early. So unfortunately, a lot of the times, Fed policy is a function of adjusting for prior mistakes. Now, we saw that in 2019, when in fact they were very impulsive in starting to cut rates and cut aggressively during COVID, as they said that they should do. But unfortunately, that was actually very successful. And the mistake then was that as we saw inflation rise, and in particularly, you saw 3-month annualized, 6-month annualized inflation rates, just as we're seeing the opposite now move up, the Fed, having been very successful in seeing the economy pick back up, the markets pick back up, employment pick back up, should absolutely have reined in much earlier. And ex-Fed member Bullard made those comments earlier this week. And therefore, as a consequence, where we sit today, when we see exactly the opposite, when we see, as was mentioned earlier, 3-month annualized, 6-month annualized rates coming down, when we see the bones of the employment report maybe not as strong as it would be thought to be from the unemployment rate, as we see a situation where nominal growth is falling, it's clear that interest rates are way too high now. They won't cut, obviously, this week. We've said that already. But they have everything in their arsenal to argue why they should cut in a preemptive fashion, because history clearly shows that when you wait too long, the impact of monetary policy changes takes time and you get caught behind the curve. And I think if the Fed does wait too long, they will get the same situation again.
So what I sense you're saying here is that higher for longer, that phrase, is sort of the new transitory, that inflation will be brief and unsustained. And the risk here, just as it was, I think you would probably argue, in the period of the transitory phase, is that they wait too long to take the appropriate action. And in that case, they allowed inflation to take hold at a greater level than it otherwise would. And in this case, it could be to slow the economy past the stall speed.
I think that's 100% right, Tyler. And they said that themselves. When they revisited monetary policy in 2019, they realized that being preemptive was very important in making sure that the least amount of damage was taking place. But we know they don't want to make the same mistake twice. The mistake they made in 2021 was not getting inflation under control. So it's not a level playing field. And they've said that themselves, so I don't think I'm saying anything new. They've said that at the margin, they would prefer to be too late rather than too early, which I think almost guarantees, unfortunately, that they will be too late.
Yeah. Let's talk about if they listen to you and they start to cut, let's say, in March, how many rate cuts would you anticipate this year? Or do you think they'll be very patient and surgical and wait and see what happens? How far down do you think rates could fall this year?
So if they go early, obviously, on the mantra of, going quicker, that should help and could possibly allow them to be more cautious in terms of cutting rates. Obviously, the market has been pushing for rate cuts well in excess of what the Fed itself would feel would be warranted. And when we look at some of the charts we look at, it does suggest levels of yields that are more consistent with an economic downturn than they are with a soft landing. I think the danger is that because we took rates probably a little bit too high and because we have held them up there, and if you look at the feedback loop, inflation is low, but high rates have a lot of negative impacts on the Fed, on its balance sheet, on regional banks, on the Treasury in terms of its funding, etc., that I think are already filtering through, and the soft landing dynamics of the savings rate and the employment picture are drifting away. So I think the danger is, even if they start in March, let's go back to 2001, the first 5 cuts were 50 basis points each. And we didn't even have a really deep recession then. So I think the danger is that already we should be cutting, and it will actually force them to do more. But it's going to be very much on the basis of whether or not this idea of a soft landing is true. I personally think that we're in danger of having something a little bit less optimistic than a soft landing. In which case, let's not forget, as on the way up, we shouldn't look at number of rate cuts always presuming they will be 25. If things do deteriorate, we can get there a lot quicker with 50 basis point cuts without having to see the 6 or 7 interest rate cuts that people are talking about.
Yeah, that is an interesting approach to it. In other words, you do fewer, but you do bigger. Tom.
And you have more information between each of them, of course.
Yes. Tom, thank you so much for being with us today. We'll have you back soon. Tom Fitzpatrick of RJ O'Brien. Coming up, North Carolina cutting coverage for obesity drugs in its state-sponsored health plans. So will more states follow suit, and could it open the door for a different group of drug makers to benefit? We'll speak with one CEO who's banking on that one. Plus, one analyst says shipping disruptions in the Red Sea could drive demand for commercial real estate right here in the U.S. She will join us to connect the dots and tell us where investors might find opportunities. As we head to a break, here's a look at the Dow. Near session lows, erasing a 61-point gain and now down by 33. The S&P and NASDAQ still in the green for the day, ever so slightly. The 10-year yield just below 4.1%. The exchange returns in just a moment.
This is The Exchange on CNBC.
shortly expecting the results of the Fed reverse repo facility.
Welcome back to the exchange, everybody. A big blow for some patients taking weight loss drugs such as Wegovy and Zepbound in the state of North Carolina. Starting April 1, North Carolina will stop paying for obesity drug coverage in its state health plan as the costs soared to $100 million last year. In 2021, the plan was paying for nearly 3,000 people to take weight loss drugs, but last year it paid for nearly 25,000 people. Our next guest runs a company that is hoping to capitalize on some of that news and make some of these people its clients. George Hampton is the president and CEO of Curax Pharma. Mr. Hampton, welcome. Good to have you with us.
Happy to be here, Tyler.
You say, among other things, that this is going to hurt patients in North Carolina a great deal, but it may not really affect your company. It might even help it. Explain.
Well, obesity coverage is pretty rare, right? It's only 1/5 of the commercial patients actually have obesity coverage, and we know CMS currently does not cover obesity at all. And so we've stepped up back in 2019 and created a Cure Access program where patients can actually receive the product for $99 cash per month. And so that's still 75+% of our business. So we're trying to bridge this gap between a lack of access for patients suffering from obesity and until a time when the insurers and the government comes around and starts covering
your
the
treatment
disease.
is a pill as opposed to some of those well-known, whether it's Zepbound or Wegovy, which are injections, right? Yours is a pill. And what have the results been with this pill? In other words, what does the average patient lose in terms of weight?
Yeah, so we've been on the market since 2015, right? So this has been around for some time. In our clinical pivotals that are in the package label, patients lose up to 25 pounds, 4.4 inches off their waist, up to 11+% of their body weight. So it's a very effective medication.
The coverage of medicines depends in large part, doesn't it, on the declaration that a condition or an affliction is a disease. Is obesity a disease or a condition?
Obesity is a disease, and it's defined now as a disease. Unfortunately, we as society do not yet treat it as a disease. And so that's becoming more and more prevalent to do so and start to treat it as a disease in the most recent years, but we still have a long way to go.
Why is it, or does it appear, or why does it appear, I guess is how I would like to phrase that sometimes insurers or programs push patients to the most expensive treatments rather than the less expensive treatments? Why is that? Am I right, or am I full of it?
Well, I think you're right selectively. I think the healthcare system in general has done a great job. Society in general has done a great job of controlling diseases cost effectively, hypertension, type 2 diabetes, et cetera. Right? But we don't start in those diseases with the most expensive medication. For whatever reason in obesity, I think it's probably brand awareness and just the lack of understanding of obesity as a disease. Certain health plans in certain states like North Carolina have decided to start with the most expensive medication, which is contrary to how we as society treat every other disease.
So why is that? Why is that? You mentioned something that occurs to me, and that would be effective marketing on the part of pharmaceutical companies, either to practitioners, mostly to practitioners, but also on the airwaves like CNBC or Nightly News or whatever, where these drugs are widely advertised.
Well, these new meds are exciting, right? I mean, the GLP-1s are going to make a complete sea change in the ability to treat obesity, and they have their place. But as you look to Europe, and we see kind of Europe 3 or 4 years ahead of us, they don't let anyone first line have the most expensive medication. You actually have to go through what we would call step theory in the United States, what they call in Europe more therapeutic-based rationale or value-based type of approach. So I think we'll get there. This decision in North Carolina points out we're behind and we need to learn more about this disease. And I think as society figures it out, we won't have to take drastic measures like banning all obesity medicines or not covering all obesity medicines.
So your drug, your medicine, what is the branded name of it? I'm sorry.
Contrave.
Contrave. Its results are comparable to those of the GLP-1s or not necessarily?
There's not been a head-to-head study. And so we can't compare them head-to-head. In individual trials, the GLP-1s are more effective at driving weight loss. And it's very similar to other disease states. You know, people with obesity don't start in class 2 or class 3 or severe obesity, right? They work their way over time. The disease progresses over time. And as society, we've failed to intervene when the people are early in their disease state. And there's an opportunity to start curbing this disease early with cost-effective medications. And then for those people who are further in disease state, you know, start to use the more powerful medications.
So I asked a question: is obesity a disease or a condition? And you said emphatically it is a disease. What makes it a disease? How does it fit under that definition as opposed to something that is more benign, I suppose, a condition?
Well, I point you to Dr. Acosta at the Mayo Clinic, who's done an incredible amount of work on this topic. And he can identify 4 different types of obesity, the underlying phenotype of a patient that they're going to be more likely to be obese over time. So when we can identify that, it's very similar to the way we diagnose hypertension or type 2 diabetes or any of the other chronic diseases. We're still learning a lot about obesity.
I'm skipping around a little bit, and please forgive me, George. Could your company develop one of these GLP-1 drugs? Are you working on something like that, or something that is next generation to Contrave, the drug you have?
Yeah, great question. So, you know, GLP-1 pipelines are rich in clinical development. I think there's 7, 8, 9 of them right now. Obviously, the 2 largest companies, both Lilly and Novo, have GLP-1s on the market. It's not our intent to develop a GLP-1. Our product works differently than GLP-1s, and so we're reinvesting in second manufacturing sites around the world. We're investing in a once-a-day product because we think that would help patients significantly be more successful with the product. And so we like the space we're in. We like the way our product works. We have a long IP life, and I think the GLP-1s are going to do just fine without us in that mix.
Thank you very much, George. We appreciate your time today. Thanks for answering all my questions.
The US
George
is set to
Hampton
renew the Venezuela
Curax
oil sanctions after.
All right, coming up, we are kicking off the busiest week this earnings season with a look at 3 under-the-radar names, including this one. It's a key barometer for the economy, but excluding airlines, it's the worst name in the transports over the last year. There, I said it. There you go. The worst non-airline transport stock. We'll reveal it ahead. Plus, Alphabet shares are trading near an all-time high ahead of earnings tomorrow afternoon. We'll look at the numbers the street's watching for and one company to watch as well.
Also seeing US corporate bond sales hitting $176 billion, setting a January record there. So to repeat, that's US corporate bond sales hitting $176 billion. That's a January record.
For business.
Welcome back to the exchange. The markets right now, that Dow gain has become really de minimis now, up 4 points, basically flat on the Dow. At its high, it was higher by 61. At its low, negative 48. Let's look at some movers this hour. The hydrogen manufacturing supplier Bloom Energy is down 8% after Bank of America downgraded that stock from neutral to underperform. The firm says it now sees revenue growth through next year as flat instead of accelerating, and that will cap the stock. Remember, Bank of America initially downgraded the stock from buy to neutral last month, saying hydrogen expectations are too high in the near term. Shares are now down 26% since that downgrade and on pace for their worst month in nearly 2 years. On the flip side, here are some of the names hitting all-time highs today. There are quite a few. You know them. Uber is one, Chipotle another, Ross and AutoZone all-time highs. Now to Pippa Stevens for a CNBC News update. Pippa.
Hey, Tyler. The former IRS contractor who leaked former President Donald Trump's tax records to the New York Times was sentenced to 5 years in prison today. Prosecutors say that Charles Littlejohn had abused his position and weaponized it for his own political agenda, sharing private tax data to news organizations. Littlejohn said in court that while he was sincere in his belief, he made the decision knowing he would end up there. Japan's nuclear lunar lander has regained enough power to conduct its mission more than a week after it initially landed on the moon. The lander ran out of electricity because its solar panels were at a wrong angle due to a tumble after landing on the lunar surface. And while she's nominated for her 10th Grammy nomination this year, Joni Mitchell will perform at the awards ceremony for the first time on February 4th. The announcement comes as the legendary musician slowly returns to public performances after suffering a brain aneurysm in 2015. Tyler, back to you.
Some wonderful songs from Joni Mitchell. Remember them well. All right, coming up, one area of commercial real estate could be a surprise beneficiary from the shipping turmoil in the Red Sea. We'll speak to one analyst who will tell us where. That's next. Welcome back to the exchange, everybody. A record $544 billion worth of commercial real estate debt comes due this year, according to the data firm TREP, and loan maturities will only continue to rise, estimated to hit nearly $3 trillion by 2028. Those eye-popping numbers increasing the possibility of defaults as owners are forced to refinance at higher prices. And that is weighing on some of the big commercial real estate players. Shares of Colliers, a global real estate services and investment firm, down about 6% so far this month. But the company still sees plenty of opportunities out there, even in the distressed office segment. Joining us now for more in an exclusive interview is Gil Barak, CEO of Colliers, U.S. and Latin America. Mr. Barak, welcome. Good to have you with us.
Thanks. Good to be here.
Are we overstating the worries about debt maturities and repayments that are in the pipeline?
I think so. There's no question that there's going to be distress coming. The signs are all there. But I also think that we will see banks and other lenders continue to work with borrowers to work through the situation. And we've seen that historically. So the sort of the doom and gloom that's out there, it's not to make light of it, but it is to say that there are pathways that will be less drastic than maybe what we're hearing in the media today.
I guess some firms and banks have worked out extensions of debt and leases. That would be one way to mitigate the problems. Am I right?
That's correct. And we've seen a good bit of that in 2023. And we've also started to see repricing of certain assets. Buyer and seller equilibrium is being reached, which also helps in terms of starting to move volume. It's sort of a more realistic take on pricing, certainly helps the market.
So while there may be some distress, I hear you say don't get overwrought over it.
That's correct. And also, you have to remember that certain sectors like office, which have a secular issue since the pandemic, will be more impacted than other sectors like industrial and multifamily, where the fundamentals are much better.
Yeah, let's talk a little bit about that, because when people talk about commercial real estate, they're inclined, I think, to think of it as a monolith. It definitely is not. I mean, there are all different kinds of commercial real estate. I suppose the one that has attracted the most attention and the most concern in recent years has been office. Tell us how that is faring.
That is correct. And that obviously was against the backdrop of the pandemic when folks were forced to work at home. But over the passage of time now, we're seeing a normalization in office. It's not to say that we've gone back to pre-pandemic levels in terms of office attendance. Everybody knows that hasn't happened yet. But we do see folks coming more and more so coming back to the office, whether mandated or voluntarily, for culture reasons. That's pretty common, that you'll see folks coming back for the culture in the office and the collaboration in the office. And as the economy has slowed, employers have been more likely to mandate return to office because there's not as much competition with other companies that might be more flexible. So it's stabilized.
I'm thinking, too, that the office market is highly localized. In other words, it may be immensely healthy in Houston, where my friend and colleague of yours, Bob Parsley, does business, or in Miami, but it may not be as healthy and robust in San Francisco these days. And then there's the difference between Class A properties and Class B properties. Talk me through the regional and class differences.
Absolutely. So you're absolutely right. And even through the pandemic, just with different cultural phenomenons in parts of the country, the South was always stronger. There was always more attendance, even during the pandemic, in places like Florida and Texas, less so on the coast. And that has continued. And we do definitely see variety across the country. San Francisco, you mentioned, is obviously one of the weakest office markets because there's a lot more work from home. There was a lot more work from home with tech companies there. So it depends on the industries and the locations for sure. But in general, we are seeing improvement in terms of return to office across the board. With regard to asset classes, there was a flight to quality. Class A and even some high quality Class B, high quality meaning good locations, maybe refurbished Class B is also more popular than those that are outdated, like lower Class B and Class C. The flight to quality is such that if you take a city like New York with the new buildings on the west side of Manhattan, they're pretty close to 95, 97% occupied. So they don't have any issues. They're amenitized, they're new, and there's high demand for those types of spaces.
We're going to have a guest in just a moment who's going to talk about industrial properties. I don't know how big Colliers is in that area, but certainly warehousing and data centers and those kinds of properties seem to be doing very well.
Yes, that's right. And industrial, the warehouses, the types of properties you're talking about, did extremely well during the pandemic with the rise in e-commerce and have continued to do well. There is a bit of a pullback, but it's not a pullback relative to historical norms. The industrial markets are still quite healthy. It's just a pullback versus the extreme frothy markets in 21 and 22.
Gil, thank you so much for being with us. We appreciate it. Gil Barak, CEO of Colliers U.S. and Latin America. We thank you for your time.
Thank you.
Thank you. All right, we're going to stick with commercial real estate, as I mentioned there, and a particular segment that could see an uptick in demand because of those ongoing tensions a million miles away in the Red Sea. Joining us now to discuss is Lisa DeKnight, Managing Director of National Industrial Research at Newmark. Lisa, welcome. Good to have you with us.
Thanks, Tyler. It's good to be here.
You heard what Gil Barak of Colliers just said and how he characterized the commercial or industrial space that you're here in part to talk about. Do you agree with what he said? That, in other words, it's healthy, though maybe not as frothy as it was in the pandemic years?
I think that's a perfect characterization. At the end of 2023, we were at 5.5% vacancy nationwide in the industrial market. You know, that is a substantial increase from where we were at all-time record lows during the pandemic, but is still well below the long-term vacancy rate for the industrial market. We're in a very healthy spot.
Lisa, our producer, Jeanette Chen, was trying to explain to me the connection that you see potentially between commercial properties, industrial properties, excuse me, and the crisis or the war in the Middle East and the disruptions of shipping in the Red Sea. Can you explain it to me?
I'll do my best. So what we have essentially happening now is geopolitics is supplanting economic efficiency as the primary driver of goods moving through the global supply chain. So what's happening in the Red Sea with the Suez Canal is actually coinciding at the same time that issues around drought-related conditions in the Panama Canal are essentially causing two critical arteries of trade to experience lots of disruptions. This is driving up maritime transit times and costs. And a general kind of global instability in supply chains is, in the long term, further incentivizing a make where you sell paradigm in the United States and in partner countries. There are short-term implications as well that we can talk through, but the biggest takeaway from what is happening in the Red Sea, what's happening with the Panama Canal, is this is yet another set of circumstances in a long chain that we've seen over the past few years that is going to be driving more domestic manufacturing growth. And I think in 50 years' time, we're really going to be looking back at this early 2020s moment as the dramatic moment where a shift in where goods are produced in relation to where they are sold takes place.
Yeah, make where you sell. That's very interesting. And there are also incentives in some of the recent legislation, the IRA, the CHIPS Act, and so forth, to do that, to revitalize domestic manufacturing. I guess what I'm hearing you say in part is that companies, whether they're manufacturers or retailers, whether it's a Costco or whatever, they don't want to get caught with no inventory because of disruptions in shipping, supply chain disruptions. So they are, A, buying from domestic sources where they can, and B, they're warehousing inventory so they're not caught without it. Am I right?
You said it perfectly, and I'll add to that. The diversification of gateway ports of entry is really important here, and it's driving industrial demand across the board. So, you know, if shippers need to react reactively, I suppose, or proactively in terms of global supply chain disruptions, if you have logistics space in multiple port serving markets across the country, you are able to pivot and be able to bring those goods in and move them to your end consumer quicker. It's a good mitigation strategy.
So one of the things that I suppose we should be concerned about with the issues in the Red Sea is possible inflation. As shipping costs rise, it's true, isn't it, that goods costs are going to rise?
This is something that we're paying very close attention to. You know, a really good metric of global shipping costs across the board is the Freightos Baltic Index. And the Freightos Baltic Index is showing around 153% increase from the end of December to present day. And I think the main concern is that there's really no indication as to when these particular set of disruptions to critical arteries of trade are going to be resolved. So that the longer that this persists, the more likely that these costs are passed on to the end consumer. And I'll add one more thing, because a lot of time-sensitive goods do not have the luxury, let's say, of waiting for a much longer travel time around the Cape of Good Hope instead of going directly to the Suez Canal. A lot of firms are having to pivot to air freight to get time-sensitive goods to the end consumer on time. Air freight is around 5 to 10 times more expensive than containerized shipping. So there are a lot of cost increases that, depending on how long this persists, could have an impact on inflation.
Lisa, you explained that so clearly. I'm very happy. I understand it a lot better. And if this,
I'm so glad to hear.
If this managing director thing doesn't work out for you, you got a future in television. You're good. Lisa DeKnight, Newmark, thank you. Appreciate it.
Thanks for having me.
Coming up, last quarter, analysts said Google search saw no impact from ChatGPT or Bing, none. And shares are up more than 11% since that release. But is that all about to change this quarter with Google reporting after the bell tomorrow? We'll take a look at why its dominance could finally be disrupted. That's next.
Never boring.
A monster week of earnings for tech, with Alphabet set to report tomorrow after the bell, but Google's search dominance could be disruptive as new AI-powered search startups crop up. Deirdre Bosa has that in today's Tech Check. Dee, do you mean to tell me that these startups truly do pose a threat to the dominance of Google in search?
It's a good question. How do you disrupt, one of the greatest business models of all time? But it's more of an existential threat, I would say. Google search is not going anywhere anytime soon, but there are cracks. And Wall Street wonders if that could lead to Google falling behind in this AI race or having that golden goose advertising disrupted. Now, it may not be Bing, Microsoft's Bing, that Google needs to worry about, rather a new crop of generative AI startups that are native Gen AI making a run at the king. We've talked about Perplexity in the past. That's backed by the likes of Jeff Bezos and NVIDIA. Another one just on the scene is Arc. It released Arc Search over the weekend, and we tried it out. We're going to show you a video. We searched Paris Olympics, and it read through 6 web pages and then neatly got them all together, laid out the dates, host city, news, sports, among some other facts. No ads and a pretty clean user interface here. Let's contrast that with a traditional Google search on a smartphone. You'll see that there's a list of Twitter or X accounts up at the top, a lot of the same information, but you got to scroll down. This is more cluttered and it's harder to find. So Google's generative AI experimental search that's available for some users, it gives you a cleaner response, similar to that of Arcs and Perplexities. But Tyler, the point here is that Google isn't willing to go all in, offer this to all of their users right now, because that could potentially cannibalize its business before it really figures out how to incorporate search and what it's going to do with advertising. So yes, these are very, very early days, and neither of these engines, Perplexity or Arc, these new names, aren't going to make a dent in the market share right now, but it kind of tells Wall Street how Google search could be disrupted.
You know, one of the things that I've found interesting as I have played around a little bit with artificial intelligence, whether it's Bard or ChatGPT, is that it seems to excel when I ask it a question like, write me 500 words on the history of the conflict in the Middle East, or tell me about why Paris is a great place for the Olympics. The things that are qualitative in nature in some cases.
So what would you be looking for then? What do you want it to, or I guess are you wondering sort of what's the use case? What is it, where's it actually going to improve businesses?
I'm killing time, Dee. I'm killing time. I'm usually looking to get educated as opposed to actually finding something.
Right. You know what? I was actually texting back and forth with the CEO and founder of Perplexity this morning. I'm saying, who are you really seeing use your engine, right? Because I think, same for me, Tyler, I'm using it sort of as an assistant or a co-pilot when I'm researching. But of course, you can't trust it entirely. So you got to go back and find all the sourcing. But he said that it's knowledge economy workers that are really using the app. And I hear the same thing around San Francisco. People who are using it are actually using it to replace the Google search. And it's not that it's like all that much better than Google Bard or ChatGPT. It's that the interface is so much better. And I showed you the example from Arc. It's just cleaner. Arc. And there's not a whole bunch of other stuff on the screen.
I'm writing this down, Deirdre. I'm writing ARK or ARC?
ARC, not to be confused with Kathy Wood's Arc.
Okay.
ARC and Perplexity. Those are sort of the two that are gaining some traction here in Silicon Valley.
All right. Well, my perplexity will be taken care of after this. Thank you, Deirdre. Thank you very much. Coming up, Whirlpool has missed on revenue 11 of the past 20 quarters. Diageo facing Forex headwinds, and falling freight and port volumes could spell trouble for UPS. We will have the trade on all 3 of those earnings reporters next.
Thuma.
Welcome back to the exchange. And it's not just the mega cap tech names that report earnings this week. We've also got a couple of consumer names on deck. We're looking ahead to Whirlpool, Diageo, and UPS in today's earnings exchange. And here with our trades is Digas Wright, CIO at Decatur Capital Management, also a CNBC contributor. Digas, welcome. Good to have you with us. Let's start, shall we, with Whirlpool, where the shares are down roughly 5% in the past month. Home improvement spending slowing. Whirlpool cutting costs to ease margin pressures. What's your thought on Whirlpool?
Yeah, Tyler, so our thought on Whirlpool is that it's actually scoring the bottom decile for expectations. Analysts have been downgrading the estimates for Whirlpool to the tune of about 11% since November. Also, the profitability is in the bottom decile. Whirlpool has been, revenue has been flat for 10 years. The margins are declining and supply costs are going up. So we actually have a very negative view of Whirlpool because we don't see a catalyst for revenue nor profitability growth.
Some things, sometimes companies that are in the bottom decile are destined to stay that way for quite a while, Digas, right?
Exactly.
All right, let's move on to Diageo. Shares of the U.S.-based alcoholic beverage company down 16% in the past year. Who's not drinking? B of A downgraded the stock to neutral, citing the slowing sales in the U.S. in particular. Consumer trade downs, foreign exchange headwinds. You say, Digas, that this is still a buy for you.
It is still a buy. We saw some weakness also in the Latin American markets. However, the profitability is actually in the top decile. It actually has a net margin of 22%. It has a very attractive 3% dividend yield. And also, let's look at valuation. It's coming in about 15 times, which is well below the 20 to 25 range. And also, it has 7% revenue growth. We liked its strategy of focusing on high margin, premium brands such as Scotch, the vodkas, the gins. We really like the company, and we think it's well positioned.
You think it's well positioned, but what about the trend that people are imbibing less and choosing other kinds of drinks?
What's happening is that they're also focusing on trying to take larger market share. Believe it or not, even though it is one of the top brands, it only has about 5% of market share. So what they're focused on is increasing that market share. And the market is believed to grow about 9% a year. So if they can expand their market share with a growing of about 9%, it will still be a company that's going to generate free cash flow.
All right, finally, let's move on to UPS, which was the mystery chart we showed earlier. Shares falling 16% in the past 6 months since reaching a deal with the Teamsters. And while Barclays notes labor inflation will be more manageable, near-term risks include lower Amazon volumes, increased efficiencies at competitor FedEx, among them. Digas, is there still opportunity at UPS?
It's still opportunity at UPS because we're long-term holders of UPS. And so what we're seeing is that even though with the pullback in the last year or so, it still has free cash flow of about 10 cents for every $1 invested capital. It has a very attractive dividend with a dividend yield of 4%. And so we are seeing that they're focusing on the labor efficiencies and also trying to grow the global markets. So we see as a long-term investor that this could be an opportunity to buy at these levels.
All right, Digas, thank you very much. Digas Wright, Decatur Capital Management. And that does it for the exchange. Coming up on Power Lunch, Jefferies sees 14% upside in a consumer stock that's already up by 40. We'll have the name. Dom Chu getting ready. I'll join him on the other side of this break. Welcome, everybody, to Power Lunch alongside Dominic Chu. I'm Tyler Matheson, and this is Fed Week. Investors getting ready for Wednesday's Fed decision. No change expected in interest rates this time, but the markets are split on what will happen in March. Dom?
All right, plus the stock market, at least the stock that many analysts think is a must-own for any kind of economic environment. It's Costco. We'll talk to an analyst naming it its top pick. And account sharing isn't just a problem for Netflix. We're going to get to that, too. But first, check on the markets right now. It's been a relatively calm day so far, but generally higher. You can see here, Meta Platforms up about 1.5% right now. The other big thing that markets are watching, of course, is big tech. And that's the reason why we're showing Meta Platforms. It's up 1.5%, hitting an all-time high, by the way, ahead of its results. So big tech, Tuesday and Thursday. Those are the days. Those 5 companies in the Mag 7.
Speaking of big tech, you don't get any bigger than Microsoft expanding its lead over Apple in the market cap race. But both those companies will also report results this week. And while those Mag 7 names continue to lead, there's also been a flood of money into other high-quality names outside of the tech sector. Let's bring in Mike Santoli for more on this high-quality problem. Michael.
Yeah, Tyler, I mean, among all the major investment factors, whether it's value, momentum, dividend yield, quality is the one that has performed the best, right up there with growth over the last year. And it's happened as there's been some unevenness in overall earnings growth as the Mag 7 trend has taken hold. But it's not just big cap tech that really is benefiting from this. You guys are going to be talking about Costco. That's a perfect example. High quality within retail and consumer staples, vastly outperforming JP Morgan over the other banks. These are just examples of this. And the question it leads to is, are investors kind of overpaying to own the best financial strength, the best balance sheets relative to what the other opportunities are out there? So to me, it feels mostly a defensive instinct to own these types of stocks. Of course, there's some momentum factor in there, too, with the AI excitement and Eli Lilly on the obesity drugs. But right now, it feels as if you're starting to stretch that relationship. The premium of quality stocks over the rest of the market is at least a one-decade high.
Mike, stay right there as the markets try to balance the Fed and earnings. Our next guest says he is expecting earnings to accelerate for at least a couple of more quarters. We want to bring in Dan Suzuki, Deputy CIO at Richard Bernstein Advisors. Dan, welcome. Good to have you with us. So there are a lot of people who think that growth is going to slow and that earnings may slow along with it. Why do you take the opposite point of view?
Well, Tyler, it's nice to see you. I think eventually you are going to see earnings growth, but I think for the time being, people have been calling for this peak and rollover in earnings growth this entire recovery. But when we look at the data, people forget that we came out of an earnings recession. And so it's actually easy comparisons coming out of the earnings recession. And all of the data that we look at that tends to correlate with earnings suggests that everything's actually quite strong still. So we don't have too much visibility beyond 2 quarters out or so. But for the time being, we think people should be positioning for this ongoing earnings acceleration and the companies that are going to drive that earnings acceleration.
You say as earnings accelerate, you have been investing in companies that are least priced to benefit from that acceleration. In other words, the market hasn't recognized their earnings growth power. Where do you find them?
That's right, Tyler. I mean, I think there's 2 areas of the market where you're really not being compensated for that bullish corporate profit outlook. You know, those 2 areas would be, corporate spreads within the corporate bond market, and then within the equity markets, the expensive, mega cap growth companies. Those are areas that are likely to benefit from the cyclical improvement, but are already pretty much priced perfection. I think all the other traditional cyclical areas of the market out there, whether that's small caps, emerging markets, industrials, energy, a lot of these areas are areas where they should benefit from that earnings acceleration, yet they're priced at historically low valuations.
Hey, Dan, it's Dom. One of the things that a lot of investors and traders are looking towards is this idea that there might be a recession. We've been looking for one for a while. It just hasn't come. Are there any signs out there that a recession could be in the cards sometime down the line? Are you looking at things like bond spreads, credit quality? Are there any warning signs there, or is it an all clear for the time being?
Yeah, Dom, I think it's a really good question. I think it depends on your time horizon. Clearly, economists have been calling for a recession for over a year now, the recession that never came. And so all the signals that they were seeing back then that would put us into a recession, some of those are still with us, right? We have the inverted yield curve that now looks like it might move back into positive territory. We have areas of delinquencies picking up. You have some of these signals. You have the ISM, which has been quite weak. But I think that the reality is, if you look at the levels of the data, most of those areas of data are showing improvement and resiliency. So not to say that you're not going to get a recession. And again, if we're talking back half of this year or into next year, I think that visibility is a bit murky. But everything that we look at suggests that there's no recession imminent anytime soon.
Mike Santoli, Dan makes a very interesting point here, and that is that there are sectors of the market that are going to have good earnings growth, but have not been rewarded for that their valuations are not the same as the mega cap techs. But momentum is sometimes, Mike, a hard thing to break, and the momentum seems to be with, frankly, a lot of those big cap tech stocks, and not with emerging markets, for example, something that Dan mentioned.
No, that's exactly true, Tyler. And also you have this situation where those big cap tech stocks are also providing a huge percentage of the expected earnings growth. So it isn't such a case where they're purely defensive and meaning that they're slow growth and they're not going to hurt you on the downside. They have both going for them right now. But to Dan's point, there are other parts of the market that aren't really given a lot of credit for any cyclical upturn. Maybe we're going to remain kind of in this late cycle mode of just waiting and waiting and waiting for the economy to soften up enough for us to say that a recession might be imminent. I always think it takes multiple things to go wrong to actually get an outright recession. You have to keep watching private sector payrolls. They're kind of decelerating pretty quickly and all the rest of it. But in the meantime, the market seems like it's not really willing to make that leap to say that we're out of the woods. So if you think we are, then those cyclical stocks look like they might be cheaper.
Mike, what about this idea that inflation is still front of mind and that much of the run-up that we saw late last year was tied to this idea that interest rates could be headed lower and that central bank policy could change? How much of that, then, is the driving force behind anything else we see in the market rally that is hypothetically to come? Or is it all going to be fundamentally driven and earnings season is going to be key?
Oh, no, that's part of the backdrop, Dom, no doubt about it. The idea that financial conditions have loosened and may loosen further still, whether that means the Fed's going to cut as much as the Fed funds futures imply right now, I don't think that's the point. The point is yields are off their highs significantly. The Fed is probably going to make its next move lower at whatever pace makes sense. And inflation is, at this point, has some downward momentum that I think the market has feasted off of. So, in the last 2 months of last year, that meant an everything rally. All stocks went up. This year, it's been much more about that narrow group of acknowledged leaders that's still carrying things.
All right, Mike Santoli, Dan Suzuki, thank you very much for being with us, both of you. Thank you.
Thanks, all right, as mentioned before, bond yields are falling today ahead of the Fed's two-day policy meeting. So what are the traders looking for out at the bond pits in Chicago? Rick Santelli is joining us now from there with the action. Over to you, Rick.
They're looking at everything, pretty much everything. Today, 3 o'clock Eastern, the Treasury's going to let us know what their borrowing needs are. But the real announcement for the February refunding will be on Wednesday. And everybody knows that we're going to be at higher levels. In the year 2021, right post-COVID, we saw big supply. That's when we saw 61 billion twos, sevens worth over 60 billion. These sizes haven't been around very long, and they're coming back. Now, if you look at the last Fed meeting, D11 and 12, look at a 2-year. 2-year yields have dropped down. The notion of Fed easing. But look at a 10-year. Much stubborn, more stubborn, being a little less more resistant to the notion of what rates are going to do. Even if the Fed eases, we have lots of debt. The 2-10 spread is almost 30 basis points less inverted since the last Fed meeting. Let's go talk to a trader. Jason.
Hey, Rick, how you doing?
Very good. All right, we have a Fed meeting this week. We have jobs report. We have the Treasury announcing the refunding on Wednesday. We get some notion from Treasury today on borrowing needs. What should we be paying closest attention to?
Yeah, it's a busy week for sure. Over 20% of the S&P is reporting earnings this week. All the big names, Microsoft, Google, Amazon, Apple. We're going to have a lot of data points that the Fed can look at as far as how is the economy doing. Can they, finally start lowering rates, or do they have to stand still and stay status quo and just wait? So
now, do the traders and sources that you talk to, do they think that the Fed is going to just go with the recent trends in inflation? Do you think they need to wait till it actually gets to a 2% level?
Well, I think the market is anticipating, 5 to 7 cuts, while the Fed has said we're only going to have 3. So it is this push and pull, and overall, I think they're going to wait for more data. and we'll wait till March to have a real chance for them to cut rates.
Are we seeing a big build in volatility, considering that March, of course, is the big quarterly expiration? I remember at the end of last year, Dees really built up some pressure. Are we starting to see that, considering March is a quarterly cycle, and, of course, it's when the next Fed meeting is? That really looks like a possibility of a rate cut.
You know, the VIX is currently trading right around 13.6, and over the last few weeks, anytime it has hit this point of like 12.5 at VIX, we have seen an immediate pop. So there's plenty of people out there calling that there is a bottom and that something probably should happen in the near term, and I would anticipate some fireworks in the future.
Excellent. Jason, always a pleasure talking to you. Tyler, back to you.
Well, Rick Santelli, thank you very much. In the latest front in the economic battle between the U.S. and China, AI, growing concerns that regulation could cost the U.S. in the long run. That story is next when we return on Power.
Dave. Welcome back to Power Lunch. Regulators in Washington, D.C. have been looking at ways to rein in artificial intelligence, but doing so in a way that will not put U.S. companies behind their Chinese rivals. Our Megan Casella joins us now with more on that burgeoning conflict in AI between the U.S. and China.
That's right, Dom. The Commerce Department issued a new rule today that would require tech companies to disclose to the federal government any time a foreign actor uses their cloud to train a large new AI model. The agency has also asked companies in a separate survey to share safety results and data anytime they train a new AI system. Commerce says the new rules are aimed at preventing what it calls malicious foreign actors from using U.S. cloud technology to undermine U.S. national security. And essentially, the concern is that a country like China could access our AI systems and then use them against us as they train their own models. So that's what this would prevent. While Commerce has already issued export controls to try to block China's access to physical technology by way of semiconductors, this is a new step aimed at regulating the cloud itself. The new actions stem from the executive order President Biden signed in October, and at the time, the pushback from big tech companies was that too much regulation of U.S. companies would stifle innovation and hurt their competitiveness. And while these rules would require U.S. companies to disclose the information on their users, the goal in doing so is to stop China and other foreign actors from outpacing the U.S. Dom?
All right, I'll pick it up from there. Megan, thank you very much. Megan Casello reporting from Washington. So with Washington pushing for more regulation of AI, are U.S. companies going to be hampered by it? And will this give China the lead in the AI race? Here to discuss is Jonathan Crane, founder and chief executive officer of Crane Shares, a major player in the investment world in China, among other places. Jonathan, welcome. Good to have you with us. Is the U.S. still ahead of China in AI, or do you disagree with that?
Yeah, I mean, first of all, AI is a transformational and probably the most impactful innovation of the century. It's compared to like the steam engine before. And I think countries, will develop AI and there'll be multiple leaders out there. Obviously, everyone compares U.S. and China, and I think U.S. will be a leader. China will be a leader. I think Europe will be a leader. Even Israel can be a leader. A lot of AI is really developed it's data driven. So when you have a large population, 1.4 billion people in China, you have access to a lot of domestic data. And a lot of this is going to be organically developed. I mean, every company in the United States, every company in China has to have an AI strategy. The employees across all these.
Whoop. Looks like we lost him. Jonathan Crane of Crane Shares. We'll try and reestablish our connection with him. But meantime, we're going to take a quick break. We'll be right back when we figure things out. Thanks.
crash courses.
Let's bring back Jonathan Crane. We've reestablished contact, founder and chief executive Crane Shares. Sorry about the Pardon the interruption, Jonathan.
We're back.
Yeah, that's good. So I guess what I heard you say in answer to my first question is China may not be leading in the AI race right now, but they have certain advantages there. Does the rulemaking out of Washington enhance the ability of China to compete, or do you think it will be helpful? And can the U.S. and China cooperate on AI instead?
Yeah. So absolutely. So, China advantages are their population. It's 1.4 billion people feeding all the data. Also, very strong government support to develop AI. Okay, so they will be a leader out there in AI, like the United States will be a leader. And as I mentioned, Europe can be a leader too. So there'll be multiple leaders all creating AI domestically, organically. And that's for positive AI to help corporations and efficiencies. But it also countries need to cooperate. And the U.S.-China relationship around governance of AI is going to be very important, that we're working closely together to prevent anything around negative AI in terms of uses of AI. And I think the U.S.-China communication and relationship around AI in terms of global governance is going to be very important, and that includes all countries.
Hey, Jonathan, it's Dom. There's one thing that's very clear right now is that the U.S. is trying to regulate and throttle back access to technology that could help China gain even more of an advantage in artificial intelligence. I'm talking about computer chips, right? Yep. There's going to be export controls and everything else. How long does it take China, hypothetically, to grow its own semiconductor business that could rival the likes of our chip giants here in the U.S.?
Sure. So obviously the measures that have been put in place around not allowing China access to U.S. High-end chips is actually forcing China to actually develop their own industry faster. Okay, so that's the response. But I still think there'll be some cooperation. I mean, you had NVIDIA CEO recently was in China meeting with various companies there like Baidu, and they're going to come out with China-specific versions for AI chips. So I still think there'll be some cooperation, from trade between U.S. and China. But look, I mean, with the race around AI, I do believe it forces China to develop their chip industry very quickly.
If I want to invest in artificial intelligence through domestic stocks, which would they be? Would they be the big household names we've heard of, or something a little more below the radar?
Yeah, I think it's both. I mean, I think the larger companies that are developing AI strategies, these could help those companies grow even faster. And that's both in the U.S. and China, but then also early stage companies that are very focused on certain types of applications. Those companies also have great growth opportunities, and we're seeing that both in the U.S. and China. Each country will have its version. Baidu, for instance, which is a leader in AI in China, their ChatGPT version is called ErnieBot, and they've quickly have over 100 million users and counting. So I think you'll see a lot of innovation out of both U.S. and China, and a lot of opportunity to invest in stocks in both those countries.
So we put up Chinese internet stocks. I'm not sure that those names are ones necessarily that you endorse. They included Baidu, Alibaba, Tencent, I believe. Yes, Tencent and JD.com, excuse me. Are those ones that you would say would be investable for U.S. investors? I mean, the Chinese market has kind of stunk lately.
Yeah, I mean, and that creates the buying opportunity. I think the China market is oversold, and a lot of it is not fundamental. So those companies, Baidu, Alibaba, Tencent, a lot of the K-Web names all have AI strategies, and they all play into, the 1.4 billion people providing data and fueling the AI. in China. So I think those are very good opportunities.
If I'm persuaded that these are good opportunities, am I best served by trying to assemble a portfolio of individual stocks on my own, or going with a fund like the one you run, which is U.S.-China Internet, Crane Shares, or what? What would you suggest I do?
Yeah, I think you take a portfolio approach. KWeb, which is Crane Shares China Internet, is the top 31 companies in China Internet using AI. So that's a good way to approach the China market through a ETF that has the whole industry.
All right, Jonathan, thanks very much. We appreciate it. Jonathan Crane of K-Shares. Thank you. Oil falling today despite violence in the Middle East over the weekend. Pippa Stevens here to explain what is happening. Oil was up early, then lost its
Yeah, so earlier it hit 79.29 on WTI, which was the highest since November 30th. That came, of course, after the drone attacks over the weekend in Jordan that killed 3 U.S. service members. And then also on Friday, we had a Russian fuel tanker hit, a fuel tanker carrying Russian fuel. And Houthis claimed responsibility in what was really the first instance of a major energy tanker.
Who owned the tanker?
It was on behalf of Trafigura, and so it was transiting in the Gulf of Aden going up. And so far, we have the majority of the attacks have been on the container ships, and energy has largely been left out of that. And so that was definitely surprising. But ultimately, what we saw today is that it's still not enough to outweigh the fact that no supply has been taken offline. And John Kilduff at Again Capital said that this market can absorb a lot of strife just because it is very well supplied. Of course, we also have the Chinese property developer with Evergrande, the liquidation there. China is the world's largest crude importer, and so that's also having an impact today.
Do you think as though this is a situation where the supply picture is about as balanced as it can be given the price action, or is it just going to be predominantly to the downside no matter what geopolitical risks happen in the Middle East?
Well, based on the estimates that are out there, it seems to be a very well-supplied market, and I think that the rebound in Chinese demand was what was driving so many of the gains last year, and that never came to fruition. And so that's still very much a wild card. We are going into the Lunar New Year, and so we should see strong demand there for jet fuel. But I think just right now, until there's actually a disruption, and we did see some Ukrainian drone attacks on Russian oil infrastructure, so that could be something to watch going forward. But until supply is taken offline, it seems like a very well-balanced market.
All right, Pippa, thanks very much. Pippa Stevens.
All right, let's get over to Contessa Brewer for a CNBC News update. Good afternoon, Contessa.
Hi there, John. The PGA Tour is reportedly on the brink of finalizing a $3 billion investment. The deal from the Strategic Sports Group, which includes Red Sox owners, the Fenway Sports Group, along with New York Mets owner Steve Cohen and former Milwaukee Bucks co-owner Mark Lazary, could have additional investment from the Saudi Public Investment Fund, according to Bloomberg. It could reportedly value the PGA Tour at about $12 billion. Meanwhile, the White House announced $3 billion to combat homelessness today. The fund will go toward more than 7,000 projects that provide housing assistance or support services for people who are unhoused. Federal data released last month showed the count of homeless people in the United States is now at its highest level on record. And the legal drama Suits just beat The Office's record for the most streamed title in a single year. Viewers streamed Suits for 57.7 billion minutes in 2023, according to Nielsen. That eclipses The Office's 2020 record of roughly 57 billion minutes. Some of the other top shows last year were Bluey, NCIS, and Grey's Anatomy. I mean, Grey's Anatomy, it would take you that long probably just to get through. How many seasons are there?
I remember Suits when it first aired on USA Network, which is, of course, a NBC Universal property. It's amazing that on Netflix it's found a new life.
Yeah.
Contessa. Thank you very much for that news update. After the break, Jefferies is naming Costco a top pick, citing the fact that its business model is still working hard and it's holding up. We'll speak to that Jefferies analyst coming up next.
So seeing NYMEX natural gas February futures settle at $2.49. Gasoline February futures settle at $2.23. Diesel February futures, they settle at $2.83. NYMEX WTI crude March futures, they're settling at $76.78 per barrel, which is down $1.23 or 1.58% on the session.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%.
.com.
Welcome back to Power Lunch. Costco hitting all-time highs just this past week, and our next guest thinks it can go even higher. He maintains his top pick rating for Costco this morning, upping the price target to $782, over $100 above the street average. After meeting, by the way, with Costco's CFO and visiting some of the locations to channel check things himself. So joining us now to tell us what he's learned is Corey Tarlow, equity analyst at Jefferies, covers many of these names. Corey, we wish you were here in office. You've been here before with us, but we'll forgive you for this particular infraction. Take us through why the power lunch for Costco is the $1.50 hot dog or $5 rotisserie chicken.
Yep, thanks for having me, Dom. And what I would say is that last week we spent some time with the Costco CFO, as well as their head of IR and financial planning, and we walked away very positive. And bottom line, the company feels very healthy at the moment, and we feel comfortable buying shares here because we see a lot of upside to numbers ahead. And it's really driven by traffic. And so the company's traffic growth has been up 7% in the last month or so. And if you look at across retail, many retailers are seeing traffic up, maybe it's low single digits, some are up mid-single digits, and some are even negative. And so I think this is really a function of member growth. And the membership is now at 72 million with strong renewal rates that are now at all-time highs, 93%. And so the one-liner here is really simple. More people are going to Costco more often, and they're continually renewing at higher rates, which should drive upside to numbers ahead.
Hey, Corey, what exactly is driving the upside in membership? What are they doing differently, either from a marketing perspective or from a product offering perspective, that is getting more people to want to sign on for Costco memberships?
So I'd say it's two things. The first is the ongoing focus on value that Costco always tends to drive. So their prices are among the best. They have about 3,100 units or different items in their store. And often for those items, people know that they can get the best value for the price that they're paying. And so that value offering that Costco has tends to drive a lot of continued visits and stickiness among a lot of what the consumers want. And having food, which is about 60% of the business, and general merchandise, another 40% of the business, is very key to driving that balance. So people go there for things they need, and then they also have the other side of the box, which is the things that they want at very good values. The second component to this is auto renewals. And auto renewals, as people sign up for a membership, it automatically renews year over year. So you get a natural accretion as more new members sign on.
Yeah, I think that's a big thing. I was going to mention that because I belong there. But once you're in, inertia takes over, and you're likely to stay in, particularly if they automatically renew and the charge hits your credit card or whatever it is. But it's very, how big are they? Because I honestly don't know, Corey. How big is Costco overseas, outside of the U.S., and is that an opportunity for them?
It's a very significant opportunity over time. So the business has about 800 clubs. 600 of those are domestically focused. And we spent a lot of time in my meeting with the CFO talking about the domestic opportunity because, frankly, most of the new openings of the 30 or so openings that they're going to be doing this year are going to be focused on domestic infill opportunities because the demand at some of these units that it has is just so strong, and they need to build new units to be able to alleviate some of the pressure on the existing units that are just performing at such a high level. On the international side of the business, that's the other 200 units that they have, are performing more broadly very well. And we've seen some promising data points out of geographies like China, Mexico, and the UK, as well as Spain. So, and they've talked positively about all these regions recently. And there's also the benefit of slightly higher margins in some of these regions too, because of lower labor costs.
Hey, Corey, like Tyler, I too am a Costco customer. I'll be fully transparent about that. The one thing that they've done that I've noticed over the last several months is they no longer just check my ID at the door. They also check it when I'm checking out as well and match my picture. It's the password sharing crackdown, that sort of thing. How much is that? Yes, and they do all of these things. Is this going to move the needle for Costco, this idea that they want everybody to get their own independent membership and they can't just share it with other people?
So it's interesting that you bring that up, Dom, because when I visited the warehouse that is nearby the corporate campus, I actually got a first look at one of the new pilots that the company is running. And this is a member scanning technology that where you at the door where you walk in, it's basically like signing into a concert using a key at a concert or a ticket at a concert to sign in and basically get checked at the door. So it'll hopefully alleviate some of that potential friction at checkout, bringing that out front with this new member scanning technology pilot, which is now in 3 stores with the potential to roll out more broadly.
Corey, it looks like somebody cleaned out your office while you were away.
It's my brand new office.
It's your brand new office.
You need to go to Costco.
Well, you need to go to Costco and furnish it up, my friend.
Correct.
Thanks for being with us. Corey Tarlow, Jefferies. Did you notice that?
I did.
There was nothing in there.
He needs more stuff.
Yeah, he didn't get the memo yet.
Get a good cheap LED TV.
Come on, Jeffries, give him some furniture. Let's go. All right, still ahead. Running out of time. LVMH's first ever Watch Week is underway in Miami. But could cooling demand mean the brand is a little too late to the luxury watch party? Our own Robert Frank has the details when Power Lunch returns. Some of the watches really expensive.
CNBC.
Welcome back to Power Lunch, everybody. LVMH trying to attract attention for its high-end watch business. And what better way to do it than by renting a Miami mansion? We sent our Robert Frank down to Miami to check it out. Hi, Robert.
Tyler, those shares up again today after rising 13% on Friday. So LVMH can afford to rent this $50 million mansion on Star Island off Miami Beach. Now, the company is really making a play for the global watch industry. Those sales rising to $28 billion last year, expected to go to $37 billion worldwide over the next decade. LVMH already owns 10 watch brands, including Tag Heuer, Zenith, and Hublot. But what they really want is to crack that top tier that includes Rolex, Patek, and Audemars Piguet. Now, executives say that while overall sales slowed last year a bit, they're already seeing positive signs that 2024 will be a rebound.
The beauty of America is that the cycles are very short. We go through ups and downs and all that, but I can reassure you today, Zenith is definitely on a positive upstream and definitely with good traction within the U.S. markets.
So today marks the start of LVMH Watch Week here in Miami. All the top executives are flying in from Switzerland and France to show off their latest models. Tyler, you were talking about how expensive they are. They start anywhere from $2,000, go all the way up to the millions. We've seen watches here that are released that are $500,000 where there is a waiting list. So at that very high end, demand remains strong, but that is the market that all these watchmakers are trying to crack right now, guys.
Wow. I mean, are these are these collectibles, or are they kind of ready to wear?
That's a great distinction, Tyler. What they really want are collectible, investable watches. So if you look at Rolex, Audemars Piguet, Patek Philippe, those watches typically gain value after you've bought them. And some of these top brands do if they're limited production, but what Tag Heuer, Zenith, and Hublot really want is to have a watch that when you buy it, it's worth more 1, 5, 10 years later. And that's not really the case now, but that's where they want to get to, where you can call it an investment, not just a timepiece on your wrist.
I didn't know that at all. That's fascinating that they go up in value. Robert, thank you. Robert Frank in Miami. And Robert is not the only one in Florida today soaking up the sun. Melissa Lee is in Miami Beach at the iConnections Global Alts Conference for a special edition of Fast Money. Got a first look, Melissa, at the big hitting lineup you got tonight at 5 o'clock. Tell us about it, Melissa.
Sorry you couldn't join us here, Tyler. You feel a little left out, I'm sure. We're here at the Fontainebleau Hotel in Miami Beach for the iConnections Global Alts Conference. It's a who's who of hedge fund managers, wealth managers, VCs, a lot of asset allocators also, all together in one place. We'll be joined by Altimeter Capital founder and CEO Brad Gerstner to lay out what to expect out of big tech earnings this week. It's like the Super Bowl of tech earnings, right, with Alphabet, Microsoft out tomorrow. We'll find out where he sees tech heading next. You'll be surprised at who he thinks might be poised for a pullback. We'll also hit the sports betting boom on the back of the NYSE listing of FanDuel parent Flutter Entertainment. DraftKings investors Rick Heitzman will weigh in on this debut. And something a little spicy, the co-founders of hot sauce company Truff, how they landed an investment from Kim Kardashian. We'll also do a little taste test of our signature blend there. Guy Adami and Dan Nathan will be with me for the entire hour. Jam-packed 2 days for us, Tyler, all here in Miami Beach.
That sounds terrific. And
I
Brad,
use Truff.
You use Truff hot sauce? Is that right?
It's good stuff.
Oh, good. And Gerstner is always terrific. Melissa, we'll be looking. We'll be watching. Thanks. All right, coming up, SoFi just posted its first ever quarterly profit. Shares are up a whopping 22% as a result. So is now the time to get in on the stock? Our trader will tell us how he's positioning on that name and a couple of more next.
trial.
All right, folks, time for today's three-stock lunch. We look at three big movers of the day, and here with our trades is Boris Schlossberg, BK Asset Management's Managing Director of FX Strategy. He's also a CNBC contributor. Up first, let's look at SoFi Technologies. The stock soaring on earnings, the company reporting, well, its first ever quarterly profit. The stock up as much as 22% today. Boris, your trade on SoFi, the fintech company.
SoFi is a really interesting story. It's clearly proving that an online-only bank is starting to resonate with consumers quite a lot. Growth has been tremendous. They added about 550,000 new customers, about 41% growth rate. They've recovered most of their loan book to student loans. So I think business is really cooking on all cylinders right now. Management is also, I think, very conservative in terms of how they forecast their numbers forward. Now, stocks really run, so definitely very expensive at this point. But if you have, I would say, a 2-year time frame to 225, it's probably going to very much catch up with its earnings because it's now starting to enter that stage where it's actually going to really pretty much every additional dollar is projected to produce about 20 cents of gross earnings. So I think it's very, very feasible that you could see by 2025, you could see $10, $11, $12 on the stock, given its growth potential.
All right, Boris. So that's the trade on SoFi. From fintech to media, let's go to Warner Brothers Discovery. Wells Fargo analysts are downgrading that company from overweight to equal weight on what it's calling a risky earnings setup. Shares are down about 3% or so, as you can see there today. What's the trade on WBD?
So I probably have a little bit more of an out of consensus view. I think this could be a value trap for a lot of people. And I know the bullish case on Warner Brothers is they're the second biggest spend on content right after Disney. They have a stellar library of assets, so on and so forth. But the bottom line is they're basically still in the broadcast business, and the broadcast business is just dying with the actuarial tables. I mean, one of the great examples is that when you look at news ratings for the election season this year, they're 50% down all across all the networks. Literally nobody's watching TV anymore. And I think that's a very big problem. And the old adage that content is king, I think, is false, because what Netflix, I think, is proving that in the streaming world, it's actually subscribers that are king. You can always buy content later. And I think that's the danger with Warner Brothers. So I would be a hard pass right now on the stock.
Hard pass. All right. And bad news for television watching. All right. Finally, ResMed shares, except for CNBC. I mean, come on, man. Give me a break. All right. ResMed, shares of that company moving as competitors' sleep apnea products are pulled from the market. ResMed CEO also saying that weight loss drugs have not lessened the need for sleep apnea treatments. Shares of ResMed up about 1% today and 12% so far this year. Your trade on ResMed.
Right. So this has been, I think, actually a gift to investors in many ways, because they are in a business that is very, very much going to be in demand going forward. The company projects that there's almost 1 billion people across the world that have various sleep disruption problems, including sleep apnea. So the demand going forward is just going to be very steady. And I think the fear that the GLP-1 drugs were going to essentially eliminate the need for this product is proving to be very false. Even in the worst case scenario, it may be just a 15% hit to the overall market. But what they've actually found when they did a study is that most people who actually took GLP-1 drugs actually increased the demand for these products, probably because they want to just maintain their overall health once they get to a sort of a better position. So overall, this has been a great scoop for investors. It's actually bounced quite a lot since then. But again, I think a long-term, very, very steady, almost a recession-proof business, obviously, because this is sort of a demand that's completely outside of any kind of consumer taste.
So it's not a snore.
I see what you did there.
Talk to me about where you see the market headed. The Fed meets later this week. If it, as most people think, does nothing, what does that do to the market, if anything?
Not much. I think the market expects the Fed to do nothing. You know, I think the Fed is going to be far more cautious. I mean, everybody in the world has already talked about the fact that the market is anticipating way too many rate cuts than what the Fed is actually going to do. But I don't know if that's really going to matter, because at this point, if the economy continues to chug along and we still continue to see earnings growth, it may not matter as much for the Fed to cut rates. They will probably ease at very minimum. It's in everything in the markets is a matter of relativity. The fact that they stopped tightening has already created a lot of loose conditions for the market. People are already saying that lending is much better. So all of that should actually point to a more positive market move in the near term.
The mind spins. Don't sleep on ResMed, says Boris Schlossberg. Thank you, my friend. Still ahead, the San Francisco 49ers, Dom Chu, are officially set to take on the Chiefs of Kansas City in the Super Bowl, and Taylor. But just how much will it cost you to see the big game in person? We'll break down the prices next.
So keep in mind, in 5 minutes' time now, at the top of the hour, expecting comments from RBNZ's chief economist, Conway.
All right, we've got 3 minutes left in show, and there are several more stories that we want you to know about. First off, Amazon says it will not move forward with the planned acquisition of iRobot, the two companies saying there was no path to regulatory approval for this deal. The Roomba maker also announced it would lay off 31% of its employees and that its CEO would step down effective immediately. The future for iRobot, what is it going to be?
I mean, that looks like heading for the exits, investors.
I mean, self-cleaning is one thing. Maybe it's lawnmowers, they said, other cleaning type products. But, you know, what's the path forward?
All right, Reddit is being advised that its hotly anticipated IPO should consider a target valuation of at least $5 billion. This according to a report from Bloomberg. The social media site filed for its IPO in December of 2021. It was then valued at about $10 billion in a funding round it completed that year. So now half that amount.
What does the comp look like? What's its competitor? Is it Meta? Is it, you know, like it's Snap?
I guess. Yeah.
How do you value that, right? That's going to be the big one. Well, anyway, New York City's return to office trend gained steam at the end of 2023. The average visitation rates at 350 Manhattan buildings in December rose to 67% of the 2019 levels. According to the Real Estate Board of New York, that's up from 65% recorded in November.
Visitation rate mean that I've gone there to visit a colleague or visit a friend? What is that?
Oftentimes they look at turnstile swipes and things like that, but a lot of Wall Street firms are getting their customers and employees to want to go back to physical locations.
Yeah. All righty. The mobster who confessed to stealing Judy Garland's ruby slippers from The Wizard of Oz was spared prison time. You don't look good in the slippers in prison, man. Terry John Martin stole the slippers in 2005 from the Julie Garland Museum in Minnesota. He thought they were worth $1 million. He didn't look like $1 million in those slippers, man, because they were adorned with real rubies. They're not. It's just glass. But Martin is very ill and on hospice care. So prosecutors agree he should be spared prison time.
I don't know where to go with that.
I don't know where. I think I've just
cost
myself a job.
I want to talk about football. I'm going to talk about football. The San Francisco 49ers are set to take on the Kansas City Chiefs in Super Bowl 58, and tickets to the big game, they're going to cost you a pretty penny. According to Ticket IQ, the average ticket price for all tickets is a whopping $10,752, which is the highest ever average price for the Super Bowl 16 days ahead of the game, except for 2021 when the stadium was at reduced capacity. The most expensive single ticket, $80,130 for a suite at the 30 to 35 yard line.
Wow.
Go Niners.
You're a big San Francisco. Thanks for watching Power Lunch, everybody.
All right, closing bell starts right now. FTTB.
$202 billion in the April-June quarter, assuming an end-June cash balance of also $750 billion.
Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make-or-break hour begins with tech earnings, the Fed meeting on deck, and how best to position ahead of all of that. Surely to be market-moving events. We'll ask our experts over this final stretch. In the meantime, here's your scorecard with 60 minutes to go in regulation. It's been a mostly mixed day for the major averages, though we are getting a little bit of a pickup here. Take a look at the NASDAQ. It's leading the way today. Investors are assessing what really is at stake over the next 4 days. Should let you know, too, S&P is above 4,900. It's going for its first ever close above that level, and we're going to keep our eye on that closely. NASDAQ, I said, has been the outperformer. Meta and Microsoft each hitting new highs. Been a decent day as well for the Russell, as small caps are catching a bit of a bid ahead of Wednesday's Fed decision. All of it takes us to our talk of the tape. Whether the 3-month takeoff for stocks still has room to run, and if so, how much? Lots of answers likely coming this week, but let's ask Dan Greenhouse of Solus Alternative Asset Management. He's here with me on set. It's nice to see you again. What's on the line this week between tech earnings, the Fed, jobs reports, and Treasury news? Feels like this is make or break, perhaps?
Yeah, it's a really important week for both the macro and the micro. The Treasury borrowing estimates are out now, which maybe we'll touch on in a second.
But
before we get into that, let's just take a look back, because I know the premise of the segment is the rally at risk. But when you look at what's happened already, I know obviously there's a lot of focus on the dominance of tech earnings in the context of the larger market. But there's an article in the Wall Street Journal this morning about the strength in retail and how rent concessions have basically gone away. SL Green reported the other day, reported its second consecutive quarter of Manhattan office occupancies moving higher. United Rentals, the leasing company, 13% rental income growth, strength in all end markets. And then you've got all the different card companies. There's a lot of focus on credit metrics from Capital One and Discover. But Visa reported, I own it personally, have for 10 years or whatever, but as a macro indicator, their commentary continues to suggest that they see nothing from the consumer side of things that suggests recent trends are likely to change. Altogether, that's a pretty good backdrop heading into this week.
You're pretty positive? I mean, because even as, you know, as the market continues to, you know, elevate, theoretically, it just raises the bar, if not the pressure on these companies to deliver what their valuations would suggest they have to, right? Yeah, their valuations have been increasing on the idea that these are the ones you can count on.
Yeah, I think that's right. I mean, I don't mean to dismiss the importance of these names or their contribution to either the performance of the market or earnings. But yes, I think there's obviously a lot of focus on these names given their strength. But listen, Microsoft always beats by a couple of percentage points. There's going to be a lot of focus on AI, on Copilot signups, which might become a new metric that we have to follow on a daily basis. I think that it's not as if these companies are not performing and valuations are expanding. They've done quite well on balance. I mean, obviously Apple has some trouble in China and at the top line, but on balance as a group, Tesla aside, they've delivered quarter after quarter. And so, as we said and everyone has discussed, they warrant higher valuations, and that's effectively what they've gotten.
So Marko Kolanovic today, just a short time ago from JP Morgan, he's been negative for the last many, many months. And he says today valuations look even more stretched. So how do you sort of take that view? Look at that. A few bad inflation prints would likely upset both bond and equity markets as risk markets, could again start pricing in the higher probability of a hard landing. What do you make of that argument? Because even somebody who's really bullish, like Jeremy Siegel, says, I mean, 20 times is not exactly cheap.
No, it's not. And listen, PEs leave you little room for error. That's true at the single stock level, and it's true at the index level as well. But listen, we came in last year, granted at a lower multiple, thinking EPS this year we're going to be somewhere around, I think it was 225, and then for the next year, which is now this year, we're going to be somewhere around 250. Both those numbers have come down by about $10, let's call it. And obviously the market had a terrific year last year, largely on the back of valuation expansion, which you're unlikely to get this year. But the linkages between valuations and multiples and market performance can be differentiated from one year to the next. But I think what you're saying is entirely true, that when you're trading at 20 plus times forward earnings, you have little room for error. Now, fortunately for the broader market, these companies have quarter after quarter delivered more or less. Now, obviously, Tesla has fallen by the wayside, and Apple has the troubles that we discussed earlier. But fortunately, again, for the market, they've done quite well. Now, listen, is 25, 30, 35 times earnings too much? I mean, that's for the market to decide. But again, fundamentally, I think they've delivered.
What about the speed in which and the strength in which the market has gotten to today? Tony Pasquarello runs hedge fund client coverage, Goldman Sachs, always has thoughtful notes, and I like to read them and let our viewers in on kind of what the conversation is with the big money out there. He's like, this has been one of the most powerful short cycle rallies we've ever seen. For the avoidance of doubt, the 19% rip in the S&P over the past 3 months registers in the 99th percentile of market history. Goes on to say, like, enjoy it, because it ain't going to last like that.
Well, yeah, so you're not going to go up at this rate ad infinitum. And listen, the market from a relative strength index is classically overbought here. And so you certainly could have, maybe it's the Treasury Department news, although it seems like we're hanging in there right now. So certainly you could have some level of a digestion, although the strength of the rally historically doesn't necessarily automatically mean it. But I don't think Tony makes incorrect points.
Hang on 2 seconds, because, I mean, we see the market jumping a little bit on the S&P, and you referenced this announcement out of the Treasury Department. Let's go to Megan Casella, who has that news for us. What are we learning, Megan?
Thanks, Scott. We're learning about Treasury's borrowing needs. The Treasury Department is estimating that they're going to need to borrow $760 billion for the current quarter, the January through March quarter. That's a little bit less than they had previously thought. They had previously thought about $55 billion less than that is what they would need to borrow in privately held net marketable debt. They're also looking forward a bit. They're looking to the April to June quarter, and they're estimating that they'll need to borrow $202 billion in that quarter. And that's a pretty significant jump. That is a quarter where we see some variability. It depends on individual taxes and corporate taxes that are coming due. It'll be the lowest amount of borrowing per quarter, if that holds true, than we've seen since April through June of 2022. So we are seeing that jump there both times. Treasury is expecting for both of these quarters to hold about $750 billion in cash on hand, but they are seeing that $760 billion in borrowing for the current quarter and $202 billion for the next quarter. Scott?
Yeah, I appreciate that. Megan, thank you. That's Megan Casella down in D.C., as you see. We were talking about this. Yields are down, and the S&P's up, and presumably it is on this exact news that we're talking about here. They're just going to borrow less than anticipated.
Yeah, I mean, listen, I'm reading through the report right now.
Yeah.
I think that the second quarter, they provided their first estimate for the second quarter. That's a quarter, as Megan alluded to, that has variability because of tax payments. That number looks a little high to me relative to what I think the street was looking at. But in the short term here, I think you have a lower number than expected for Q1, and that's going to calm people down a little bit. But, again, this is separate from the larger story here, which is we're running $1.5 trillion deficits ad infinitum, a recession not in the forecast. These numbers, auctions for 2s, 5s, 7s, 10s, et cetera, are only going up from here.
Sure, but there was a point in time in which the market surely seemed a lot more concerned about those facts than it is today. We figure that, even, a couple of the auctions of late that have been a little squirrely, that in total, we're going to be able to absorb all of the supply that's coming on in the market. And that maybe is why we've had the cooling of fears around this topic.
Well, listen, when the news first broke last year, there was a concern that maybe after 40 years of people worrying about this, that this was going to be the moment that people woke up and imparted some fiscal restraint on the government. That proved to be obviously short-lived. And now we find ourselves in a moment where this headline comes and actually the market's rallying on it. And it looks like we're at the highs of the day. We are. Despite an exceedingly large number of borrowing that the government's going to have to do. Treasury auctions, the 10-year Treasury auctions already call it $40 billion. That's probably going to be on Wednesday when we get some of the details, going to be closer to 42.
You know about the relationship, obviously, between yields and both the NASDAQ and the Russell 2000. So let's put up an intraday as well of the NASDAQ here, because you're going to see a similar chart response as we're looking in the S&P 500, because, as yields have come down in these last moments, the NASDAQ has added some as well. It's up near 1% now, and the Russell 2000 is up about 0.75%. That's a near 15-point gain there. By the way, Jan Hatzius over at Goldman Sachs, since we're on the topic of rates and the Fed, and we're going to get the decision on Wednesday, of course, he's sticking with his March cut, kind of doubling down on that belief that the Fed is going to cut in March. What do you make of that?
Yeah, listen, I have not been in the March camp. I want to make a quick point to the viewers at home. If you're an average investor, whether they cut in March or in May or in June is largely irrelevant to you. The fact that they are cutting, and they're cutting presumably for the quote-unquote right reasons, to borrow a phrase from The Bachelorette, that's ultimately what matters for performance. But I haven't been in the March camp. I think they're probably going to use, the data might be too strong, some of the inflation data and certainly the economic data. And the truth is, if I have them cutting in May or even June, the larger idea for the broader market is irrelevant. The bias is to the upside, and the fact that they're cutting is a positive.
Glad you have a life outside of finance. Your primetime viewing habits are interesting. Thank you very much for that.
I didn't say I watched The Bachelor.
No, I appreciate it very much, obviously. Nicole Webb of Wealth Enhancement Group joins the conversation now. So what are your expectations heading into what is undoubtedly a critical week, as we do have a spike in stocks, as I ask you that question?
Yeah, thanks, Scott. Last time you and I spoke, I delivered kind of some criticism of this equal weight S&P. All we need is a flexible Fed. We have disinflation, more disinflation in the pipeline. To Dan's great point, it doesn't matter when rates come down, they're coming down this year. And look, the economy is stronger than expected. And Dan made great points around credit cards, the consumer. And yet, and it's not a but to take all that away, it's an and this has not translated into earnings per share growth. And so to us, it's not just a necessary given. It's a story, again, of kind of two distinct markets. One where, as one of our analysts put it so perfectly today, you have this scarcity premium on how to participate in AI. And you're seeing that play out in the NASDAQ and specifically in megatech. And then you have the rest of it, the rest of the market, and curiosity around, in a backdrop where we have deglobalization and the cost of doing business is higher, and we've used the strength in being able to pass along pricing. Can that all really translate into growth, and specifically revenue growth and keeping up with margins? And for us, that's still what we're watching carefully for through this earnings season.
But what am I supposed to do if I was expecting the broadening out of the rally to continue, but yet I've seen this return back to so-called quality, which obviously means mega caps? Am I thinking that that's just the way it's going to be for a while, and this week is only going to underscore why? Or is the Fed going to give us reason this week to think that maybe now really is the time to diversify and broaden out away from the mega caps exclusively?
And I'll go back to saying it's both. This is an incredible opportunity to be a long-term investor where you have the ability to still purchase what you didn't buy in 2023, because there's a lot of laggards there. And so one should participate. And just because megatech hit it out of the water last year doesn't mean it has to do poorly this year. Yes, it's crowded. Yes, it's expensive. And there's still momentum to the upside. And until we see more names come public that specifically are in this AI area, you're going to see investors, both institutionally and on the retail side, looking for a way to participate. And so it's this moment in time where we're going to see the front end of the yield curve come down this year. We have trillions in money market, and both sides of the market look primed for investment.
I'll also add that the outperformance of large, if you will, is not exclusive to technology. It's true across basically every sector. I think the only two sectors where large is not outperforming small are industrials and materials. But if you take out Boeing in the case of industrials and Newmont in the case of materials, then it is the case. So you've seen investors flocking to large more generally, and I can't help but feel that that's something to do with passive flows. I can't bear it out, and it's not part of my job description to do it, but I can't help but feel that the fact that more than 50% of AUM right now, give or take, is directed to passive flows is just going to perpetuate this continued inflow into the large names, particularly tech.
Let's talk about then the most active of investors ourselves, right? Do you agree with Nicole that this is a great opportunity for both? I mean, do you think people should be looking more towards the broadening out trade or not? I mean, we came into this year thinking like this is going to be the place to be.
Yep.
New regime of the Fed, they're no longer hiking, they're cutting, economy's hanging in, soft landing, no landing, says the economy's going to remain good. Now's the moment for small and mid caps.
I thought this into the end of last year, correct. I thought that coming into 2024, not correct.
You're not alone, but that leaves us in this quandary of what to do now.
But I would take issue with the word great because valuations are high. Certainly inclusive of mega cap tech, but even if we X them out for the 493 or the equal weight, these valuations are not cheap, so we can dispute whether great is the right adjective or not. But I do, listen, I mentioned a whole bunch of companies earlier, and then there's a whole bunch more. With respect to the narrowness of the rally, you've got names as diverse as Cigna, Chipotle, Uber, Eaton, that are within 1, 2, 3, 4% of their 52-week highs. Mm-hmm. It's not as if these 7 names are doing all the work and everybody else is languishing or down. Certainly it's not as broad as you quote-unquote would like, but I think there are plenty of opportunities outside of large cap tech to get large returns. A sector I mentioned repeatedly last year, and I'm sort of involved in myself, look at the hotels. Pull up a chart of Hilton or Hyatt or Marriott. Obviously this is consumer, this is travel, and this is story is played out, if not playing out, but you didn't need to be in large cap tech to be exposed to any one of them.
Yeah, there's an intraday at least. You can pull up a longer period of time if you want to continue to show that. Nonetheless, Nicole, of the mega caps that are reporting this week, you own Microsoft, Alphabet, Meta, Apple. Which one is the most important, do you think? Dan Ives made the case today that Microsoft is. Sounded like Dan Greenhouse was backing that view, and I had a couple of investors on halftime today doing just the same. You agree?
Yeah, we do. And, I think Microsoft is incredibly positioned, well diversified. We can talk on and on about the strength, what we're going to hear out of Copilot. And I'll go back to something that you've heard us say before, which is we really do believe that Google had a fire lit under it in kind of the race against ChatGPT and the army of coders behind their large language model, and then overlaying that onto their enterprise system, not to mention the capacity for which YouTube can grow from where it is today as really the largest media company in the world. And so, Alphabet continues to be really interesting to us. And as we talk about mega tech, I think it's also to kind of go back and look at the sum of the parts and the parts of the sum, and then one can really make strong cases for their valuations.
I mean, but let's take the valuation, because you made the argument, I think I heard you correctly, suggest that they're not expensive. Microsoft, let's just say its 10-year historical average is something like 23. It's at 33. So yeah. How do you justify that, even with the excitement around AI, right? Excitement can get out of hand as well from a valuation standpoint. We've learned throughout history the hard way when that happens. Unfortunately, it's hard to see the signs as it's building.
Yeah, and Scott, it's not to say that they're inexpensive or cheap. They are crowded and expensive. I'll go back to what I said before. And they are in momentum to the upside, and investors are going to continue to look for how does one participate in AI. There's so much buzz around it. Add in the cap-weighted passive flows and then go deeper. Okay, can I substantiate being a buyer of Microsoft? Can I substantiate being a buyer of Alphabet? And this is where we look at the parts of the sum and can create some justification behind, yes, it's expensive, yes, it's a little bit crowded, and what they are bringing to the marketplace today has the highest likelihood for continued growth, at least looking forward through 2024.
And you think earnings are going to ultimately justify this move, and you do believe in the January, the so-called January effect. As goes January, often so goes the year, allegedly.
Yeah, I mean, listen, when you dig in the data, it certainly works. There's no doubt about that. There's the first 5 days, and then there's January as a whole. There is a 900 basis point outperformance between an up January and a down January with respect to the subsequent 11 months. No other month of the year shows anything similar to that in terms of its quote-unquote seasonality. So, yeah, I think an up January is better than a down January for sure. But to the point about Microsoft and the valuation, I'm making no argument one way or the other for the stock, but like, what is the OpenAI investment worth? What is Bard worth? What is Einstein worth? Like all these companies, and not just these, there's ServiceNow, there's Adobe, there's Salesforce, a number of other ways to play this. I don't think anybody really knows what the valuation is going to be on some of these businesses in which they're investing and ultimately rolling out.
No, but at least you can, I think you can more credibly, at least with some of these names, look at the path to monetization, if you will.
Yes.
See ones that are already doing it, like a Microsoft or NVIDIA.
Yep.
The others are a bit of a guess. And even these are somewhat of a guess in terms of the magnitude of the monetization that you're going to get. But at least there's tangible evidence and money and data behind these moves to at least justify them in some respect.
Entirely fair, and we're going to probably hear about that on a bunch of the calls. What I will say is historically with a lot of these names, when you're trading at 20 or now 30, 35 times earnings, the assumption is that earnings are not correct. And that ultimately over the next 3 years, it's actually in retrospect going to be looking considerably cheaper than it does in real time.
Let me just steer you back. Let me just remind our viewers too. Let's show the S&P 500 again. We are going for our first ever close above 4,900 today. And barring a surprise in the last 40 minutes, it looks like we're going to get it because we continue to get a spike in stocks here over the final stretch. You take a look at the S&P here, 49.25 just about. And that is on this news, apparently, that the U.S. has cut its borrowing estimates, the Treasury has, from the January to March period. Yields fell, stocks took off. S&P, the Russell 2000 and the NASDAQ as well. But the Dow's up near 200. You want to just give me one more note on why the market is viewing this in such a favorable way and what is a critically pivotal week?
Yeah, so as I look at the data here, so what this report is, it tells you how much the government has to borrow on a quarterly basis, and then they follow it up with the size of the Treasury auctions I mentioned. Everyone's been on edge about how high and how large those Treasury auctions are going to be. I'm looking at the 10-year here. You're down, called 7-8 basis points, closing back in on 406, 405. And when you think back to the end of last year, when did Treasury yields peak out and begin moving lower? The end of October. When did stocks bottom out and begin moving higher? The end of October. And while growth is a very important component of equity valuations and earnings, et cetera, so right now are yields. And so it's not unusual and not surprising at all to see this relationship on the heels of that Treasury.
Well, just remember also, I think the midpoint of last week, if we have a 1 week on the 10-year note yield, you know, we were marching back up in the so-called wrong direction, right? You were, 4 in the teens. And now we, as you said, have just dropped down back in you could see it, right? We were almost approaching 420.
Yep.
Yet again on the 10-year, it made people a little bit nervous, and that's why the market last week took, a 1 step forward, maybe 2 steps back at certain occasions. But this sort of calms or takes it off the boil.
Yeah, if I can paraphrase Dave Chappelle, yields. It's a heck of a drug.
So we'll continue to watch that over this final stretch. See if we can get that close, that first one ever over 4,900. Nicole, thanks. Dan Greenhouse, we'll see you soon. All right, let's send it to Julia Boorstin now for a look at the biggest names moving into the close. Julia?
Hey, Scott. Well, SoFi is soaring after swinging to a profit in its fourth quarter, beating estimates on both earnings and revenue. The company is also expanding some of its investment options to include mutual funds and money market funds. And iRobot is in negative territory after agreeing to terminate its planned merger with Amazon, with the two companies saying they have no path to regulatory approval of the deal. iRobot's CEO is also stepping down immediately, and the company plans to lay off 31% of its employees, around 350 people. Scott?
All right, Julie, we'll see you in just a bit. Julia Boorstin, we're just getting started here. Up next, more of your big tech setup. Apple, Alphabet, Amazon, Meta, among the big names reporting this week. We'll hear from a top tech strategist with how he's navigating this crucial week for the mega caps just ahead. We're live from the New York Stock Exchange. You're watching Closing Bell on CNBC. S&P, 49.25. Dow's up almost 200. We're back after this.
Dave.
We're heading towards quite the finish for stocks on that Treasury announcement just a short time ago. We're at the highs of the day across the board. Dow's good for a little more than 230 points as we speak. S&P 500 going for its first ever close above 4,900. Looks to be on the way to doing that. And then, of course, as yields are coming down, the NASDAQ is starting to rip a little bit as well. 15,627. It's the outperformer today, up better than 1%. Speaking of tech stocks, they're moving higher to kick off this busy week of earnings with all of these mega cap stocks reporting their numbers this week. Microsoft, Alphabet, Amazon, Meta. You know who's reporting at this point, along with Apple. Let's bring in King Lip of Baker Avenue to discuss. So these are at the top of your holdings as well. What are your expectations?
Our outlook is still positive on all of these names. So overall sector positive, but we do recognize that a lot of these names have moved quite a bit already, and it's been just a couple of weeks in the year. So some of this good news may very well be already priced into some of these shares, that are reporting this week.
So how do you judge that versus the fear that there's just little room, maybe not even little, no room for error?
That's a good point. I think it has to do with valuation. So names like Microsoft and Apple, for example, have relatively high valuations relative to their 10-year historical valuations, which you just showed us earlier on. So they really need to see sort of strong beats and raises on those types of stocks. On the other hand, stocks like Meta, Amazon, Google have relatively low valuations or inline valuations relative to their historical averages. So from that perspective, there's a lower hurdle to beat for those names.
Talked to a few people already about what they perceive to be the most important one. Microsoft seems to be at the very top of most lists. Is there one that you're most concerned about? And maybe Apple's the easiest one to pick on. It's flat to start this year. Questions about where the revenue growth is. What about your concerns, if any?
Yeah, I would say Apple is the low-hanging fruit, pun intended. It is actually a little bit of a concern for us just because there are some channel checks that show the iPhone hasn't been particularly robust. China weakness has been a concern. Valuation, as we just mentioned, the shares have lagged. However, longer term, we still like the name because the ecosystem is extremely valuable. The services growth is still extremely strong. Potential for new products is always lurking for Apple. And the strong cash flow. I think there's catalysts for the shares should the company decide to increase their earnings dividend.
You tempted to trim any of these? Because I guess I asked that in the context of even investors that I've been speaking with, whether it's this show or halftime, who, one in particular sold Meta, still loves it, but just can't ignore the fact that it had the best year ever in 2023. Now, I know that was after the worst year ever in 2022, but the stock has ripped a lot.
Protect your trade from.
Yeah, the good thing about the way we manage our tech positions is that we trim along the way. So as long as we like the name for the long term, we'll continue to hold them. But we do trim along the way to take some profits, to diversify the portfolio. So for those reasons, we still hold those. Those are our top holdings in our firm. If for any reason the sort of long-term story is no longer attractive, then we'll completely sell them out.
Is there one that you have your eye on that you don't own? That I've also had some suggest that we need to move away from the these magnificent 7 names and look at more of a so-called AI 5 and include names like Broadcom and AMD, for example, within that mix. I don't think I see those on your top holdings. That doesn't mean you don't own them, but enlighten us further if you could.
Yeah, one that we've been following that we're starting to build a small position is Adobe, actually. And the reason why we like Adobe is we think its generative AI business is extremely compelling. It makes content publishing, content creation that much easier for creatives, and it doesn't get as much AI sort of highlights as the other names, but it's a company that we think will see extremely strong earnings growth for the upcoming quarters.
Cool. King, I appreciate it as always. We'll see you soon. King Lip. Up next, positioning your portfolio. Bank of America's Chris Heisey is back with us. He'll tell us how he's breaking down how to navigate this crucial week for your money just after the break.